Morning, everyone. Thank you for joining us. People just wandering on in at the moment. But we thought we'd get going. We've got some online viewers with us today, so we're going to start more or less on time. So thank you very much for joining us at OMFIF's Sustainable Policy Symposium. We're very happy to have you with us in person and indeed online and on demand if you're watching it back later. I'm John Orchard, OMFIF's CEO, and you're in very good company actually. We've got an extraordinary group of people coming over the next couple of days from across public and private sectors and from around the world here with us today, both as speakers and delegates and on to tomorrow afternoon. So do keep with us. It's a terrific agenda as you'll see. We've got central banks, of course, our home turf. We have also commercial banks, asset managers, rating agencies, multilateral development banks with us watching and in the room. And I think that's a good sign since we need all of these entities to solve for the complexities and intricacies of reaching net zero and challenging process, but actually gathering steam now. All for you to vote in as well. Thank you, Emma McGarthy and team for putting a really excellent agenda together, and thank you also to AWS, Ceres and MSCI for supporting the event. From China, where this theme came up in every meeting. It happens to be one, fortuitously, to be one where a global conversation can still take place, and needs to, of course, while bifurcation arguably sets in elsewhere, as you'll see in the news from Russia overnight. But in the meetings in China, everybody raised the importance of net zero and engaging with the rest of the world to achieve it, given the materiality of China on the carbon issue. Of course, is dirtier energy in the short term, but the idea of big changes being possible in this field has been proven, I think, and the case for self-sufficiency with renewables in playing a major role in that is clear, and which the EU is already helping to co-finance, and I'm sure we'll hear more about that. The US, meanwhile, has gone big, which we wouldn't have predicted 2 years ago, say. The Inflation Reduction Act is controversial for plenty of reasons, and I suspect we'll go into those, but it's also putting real money into the development of renewable energy technology in the US. Meanwhile, we talk at OMFIF every day to central banks and debt management offices about green bond programs, and we'll hear some of that over the next couple of days, and internationally financed programs to protect the environment, including the sea and infrastructure projects and so on. So it's a truly global discussion. It's not the same discussion every place, but it is global, and indeed those discussions about taxonomies and standards, they're important and will remain important, but that is not the core focus of our discussions over the next 2 days. There are now plenty of committed GSS sovereign bond issuers, and we'll hear from those, as I said. Transition finance has now taken off, though it has its growing pains, and we'll explore that. Answers are now being found for the difficult data challenges in this area, and asset managers are learning to live with a variety of approaches, issuer criteria, and investor preferences. We'll explore all of that. And we also won't neglect the murkier side of sustainable finance. We close our conference tomorrow with Desiree Fixler, who blew the whistle with her. She's a very lively, interesting and informed person, so definitely listen into that if you can. I think you'll quickly consider corporate culture issues listening to Desiree, which would help not just support the sustainable finance arena, but protect financial institutions and the economy at large, I would say, in the form of regulators and central banks, who in the end determine pretty much everything in the world of money. So David, over to you.
So thank you very much, John. And the first session is called a Fireside Chat, so you have to really imagine a burning log fire. But we'll be having a discussion amongst the three of us here, but we would like to have some audience participation as well, if that's possible. And so I will be certainly looking for the fabled show of hands that John was speaking about to get things warmed up a bit. So we have here Clara Raposo, who is the Vice Governor of the Banco de Portugal, who has got a particular affinity for these matters. Clara also, she was telling me just now, she actually has been in London, or at least in the UK, quite a bit of time, and she was at the Side Business School before they even had a building, working out of the Radcliffe Infirmary in Oxford, which might be quite a good place for central banks to be at a time when there's some problems in the world banking system. I would have thought the Radcliffe Infirmary would lend itself to this. And Barnabas Virag, who is the Deputy Governor of the Magyar Nemzeti Bank, Hungary National Bank. So we've got two central banks here which are members of the ECB. Both are shareholders, but one is a member of the Euro system, whereas Barnabas, your country is still in the waiting room, shall we say. But the door is always open to Hungary joining the ECB fully. But you're both members of the European system of central banks in different senses. So clearly Europe will come a lot into what we're talking about now. So we can start off in a fairly broad way. As John said, this issue is really coming up every single moment of the day in all the conversations we're having with central banks and public institutions. Yesterday I was in Frankfurt just for a few hours. We have Joachim Nagel from the Bundesbank coming over today, who's keenly interested in this subject. And one of the things the Bundesbank does, I'll just throw this out, it's actually a very important part of its job on top of the supervisory side and on top of its own reserves. It manages about 100 billion of reserves for third-party funds, public sector funds like the Baden-Württemberg Pension Fund or for the Nordrhein-Westphalia Pension Fund and other parts of the German public sector. And every single one of these mandates that the Bundesbank now covers for those third parties is actually covered by some sort of sustainability or ESG mandate. So it's very important, I think, in the asset management operations of central banks, not just in the monetary policy or in the supervisory policy. So, Clara, why don't you tell us about how you see this from a high level, the role of central banks? Is it interfering with your prime mandate of keeping down inflation? To what extent could there be conflicts of interest? And we'll come into some of the more detailed nitty-gritty areas as we go on. But first of all, Clara, over to you.
Okay, so thank you so much, David, and thank you for inviting me to be here at the SPI event. And first of all, a little disclaimer. So I've joined the central bank only 3 months ago. What a great timing. And in my previous life, I was professor of finance, I still am, and the dean of the University of Lisbon School of Economics and Management, where I could see the enthusiasm of younger generations in these topics of climate change and what it is that businesses and the financial industry can do to improve quality of life and actually life expectancy in the future. And on the other hand, I was also the chairwoman of one of the largest Portuguese companies in renewable energy. So that's an industry that I know reasonably well. And I think in these different countries that will be presenting their opinions and views and the roles of central banks and what our mandates are, etc. That also depends a lot, the perspective we have depends a lot on how we see the economy itself or the real side of the economy itself going through the transformation that we all know is required to deal with the changes, with the recent changes. Now, let me start with, a little citation, a quote from Marcel Proust, actually, which I think sets the tone in a nice way for us to start today. Well, Proust once said that a change in the weather is sufficient to recreate the world and ourselves. And to be honest, he didn't have in mind the situation that we're going through, that what we're actually facing is a period of, well, quite a few shocks that the whole world has been going through. So we've had the pandemic that has affected our economies tremendously and the way we live. And we've had central banks playing an important role during that period as well, coming from a long decade, more than a decade of quantitative easing, etc., that we all know. Then suddenly we've seen some changes as well. We've seen some shocks in the energy sector and changes in energy prices, etc. Then joining this, we've had war in Ukraine, still ongoing, and there are many, many pressures. Suddenly, the upsurge in inflation, and now more recently, even some extra turbulence in the banking industry, with some regional banks in the U.S. showing signs of stress, the Credit Suisse as well showing some difficulties, and of course central banks need to be paying attention to all these different crises and demands. Now, regarding many of these elements that I mentioned here before, like the pandemic, etc., the truth is that to some extent we see them as temporary, or as something that we can solve with the right persistence and tools and policies, etc. We are able to, for a longer period or in a shorter period of time, to achieve some results and to see progress being made. In what concerns climate change, though, this is something that has been ongoing for a long time, and the big difference right now is that we are aware that it's something that is persistent, that definitely requires action, requires coordinated action of many, many countries, different parts of the world, and that we all need to do our part if we care about the future of mankind, basically, in our planet. So that's something it's a kind of concern that's different from all the others that I have just mentioned before, because it has this persistent effect, and it affects everyone, to be honest. So when we talk about climate change, we're talking about all the things that we've heard about, so basically caused by the greenhouse gas emissions. We have physical risks of different kinds, so we have persistent chronic changes in the way our weather conditions are behaving. We also have some extreme weather events that basically change a lot the risk profile of our economies, of our businesses, and so on.
I mean, I was just sorry to interrupt. I mean, I think that is all very true, and everybody would accept that. And the litany of events and problems that you mentioned, it makes one think, why does one get up in the morning, basically? But the thing is, you go to work, you've got a panoply of different questions.
We do.
How do you order this?
How do we order this?
Where do you put that in your order of priorities?
Okay. So, at central banks, at the Bank of Portugal, and basically in the Euro system, let's say, we don't have climate action in our main mandate, so it's not the main focus of our business, let's say. So we, of course, have a special role trying to guarantee price stability and financial stability. And in that sense, of course, climate change is also dealt with our policies, right? Because it is impossible to achieve financial stability in the long run without taking care of some of the elements and the risks and the vulnerabilities to which our economies, our businesses, and then our financial sectors are exposed to, given those big changes. So climate change produces risks in our businesses that need to be considered in terms of macroprudential policy, in terms of the way in which we supervise banks, for example. And so that's something that it has become a new risk, let's say, in the list of risks for which we must have a notion as to what extent is our financial system exposed to, how can we control this, are we giving the right incentives to the banking sector and ourselves in our own behavior, in our central banks, in the way in which we design our monetary policy, in the way in which we are designing our macroprudential measures as well? Are we giving the right incentives for banks and the economy to behave well? Yes. But we don't take the leading role in this.
No, just before we go on to Barnabas, I just wanted to ask, and later on we'll go into some of these more detailed technical questions about moving away, say, from market neutrality in your asset management. Exactly. But one point just before going over to Barnabas, do you have the right people, either at the Banco de Portugal or in the Eurosystem as a whole, to really work through these different issues, say from an accounting point of view?
Right.
Or are you on the lookout for many more staff to be able to do what you've just told me you want to do?
Okay, that's an issue. That's an important issue, and this is true for central banks, as it is for many other kinds of organizations and for banks themselves, not just central banks. So one thing we have, which is very important, because the difficulties that sometimes we find in fighting this climate change is not just lack of will, or I don't think that's really a concern in Portugal or in the Eurosystem, quite the contrary. or even lack of the strength to go and make the transition costs and put in the money and make the investments when required, despite the fact that we have, lots of other pressures to deal with. But we still have difficulties with data. There's a data gap. It's been difficult to truly measure carbon footprints of different industries, different companies, our portfolios, etc. But a lot of progress is being made. So in the central bank,
you need people who are number crunchers.
But we do have, not just number crunchers. So it's a translation from the ecology and the environmental vocabulary or terminology that needs to be properly considered in terms of euros and pounds and dollars, etc. But that's something that we're doing. So we don't have as many people as we would like to go doing this, but we do have brain power, and truly, both at the European Central Bank and in the Bank of Portugal, we do have an interesting group of people in different departments working in these matters.
Good. Okay, well, that's something we will
that's
deepen.
very important.
We will deepen
that's
this, not just in this discussion now.
And that's actually a contribution that central banks can have, right?
It is, and we will be deepening this in the course of the day, I would say, and anybody who wants a job, please do see Clara afterwards. But Barnabas, the one part of the mega banks' deontology is really we do things differently. You do seem to have a different line in monetary policy in some ways, and also, for instance, in terms of things like investing in the renminbi, you were a pioneer in that. I believe you are also in the area of this greening of central bank policy. So could you tell us a little bit about how the Hungarian Central Bank handles these technical issues?
Yeah, first of all, I would like to also thank the invitation to this panel. It's a pleasure to be here. I can say generally that the Central Bank of Hungary was a very proactive central bank in many fields in the last couple of years, and it's also true for the green issue. Why we think that the green central banking will be one of the top issue for the central banks in the coming decade? Because we strongly believe that those very comfortable and convenient decades we had after the 90s is getting to the end nowadays, and some of the big megatrends which supported the stability in macro level is getting to the end and starting to move into other directions. What are these megatrends? These megatrends are the demographic trends globally and also in a country level. The other issue is the future of globalization and the future of the geopolitical scheme, which started to move into another direction, especially in the last years. And the third element is the climate issue and the whole energy transition, which is needed to operate our economies in a more effective way in the coming years. I think all of these megatrends will generate a big, challenge for the policymakers in the coming years. So that's why I'm saying we step from the era of great moderation to the era of great tensions or great volatility. And I think if you would like to give the right answers, not only in the short run but also in the mid run, you have to think on the new mandates of the central banks. Yes, as David mentioned, we opened our thinking on green central banking somewhere in the last years of the last decade at around 2017, 2018. We published our first green strategy in 2019, making and publishing the directions for the commercial banks, how to think about this whole green transition, how to support the green transition, and now we are the first central bank within the European Union who has the legal green mandate in the central bank.
Can I just ask you on that particular mandate issue? It's such an important question. Do you see yourself deliberately as a pioneer here? Because Hungary can move forward by itself. the other 20, other 19, other 20 members of the EMU cannot do that. So do you see yourself as a bit of an icebreaker?
Yeah, of course. So I think it's linked to those talks you mentioned in your introductory remarks, that we are still outside the Eurozone, so we are in the waiting room, so it can generate more room for those central banks who are
You
outside.
could be more
the Euro-
creative, perhaps, if you're in the waiting room.
We can be more creative, and we can test. I think it's very important that we would like to share all of those experiences we got from these projects with other central banks, with ECB, because again, I strongly believe that the green issue will be one of the top issue at the agenda in case of the central bank.
Well, also something I've discovered with you, you don't mind criticism either, do you? If you get something wrong, I mean, that's why there may be some ladies and gentlemen in the audience who say, look, I think you've got this wrong,
absolutely.
and you welcome that. And I think that's actually very good in terms of forming a different thought process.
Yeah, that's absolutely true. So I can say that it's also a learning curve for us. So of course, when you
so that's an invitation to you to ask questions.
When you are in a pioneer in a road, it's always a tough game to make the first steps. And I can say we learn a lot from our own projects. I absolutely agree with Clara that the data issue is one of the key. So that's why behind the scene we made a lot of common work with other authorities, have a lot of data like the taxing authority, like the Central Statistical Office, to have wider and wider databases to assess these projects. But it's pretty clear that in the first steps, one of the key issue for those authorities who are active in that field is the data availability. And
that's
the
exactly what I want to
issue.
go back to in a moment with Clara. But just before I do that, a question to you, Barnabas. I mentioned China at the beginning, that you've had a role in building bridges as a monetary authority with China. John mentioned right at the beginning that this shone through a real live issue when he was in China at the beginning of this month. And it's also one of the few areas where the US and China can absolutely categorically agree, that they both agree on the importance of combating climate change. So do you see your own role at your bank in terms of dealing with the Chinese authorities as also helpful to build a bridge between China and the Western countries in this very crucial area?
I think so. So yeah, we have relationship with many Chinese investors, many Chinese banks who are active in Hungary, and I can say that they are pretty open to be involved in those infrastructure projects linked to the energy.
Could you give a concrete example? Because we're very interested in concrete examples here.
So I said that we are in the first phases. So we got our green mandate in 2021. So now we have the dialogue, how to say that, with the Chinese partners. But I can say that the first impressions is that they are pretty interested in those projects. In which also the Hungarian authorities and also the Hungarian central banks are interested.
Okay, well, so the next time that John Orchard or Frank Scheiding, who I see sitting down here, member of our advisory council, go to China, they can take you, or when you go to China, you can take them, and you can build these bridges together. Now, I'd like to suggest that here. You heard it here first, ladies and gentlemen. So let's go back to you, Clara, on this question about market neutrality. Now, this is a big issue about whether or not in the asset management operations of central banks, whether you're going to somehow override the usual market criteria, say in the purchases of corporate bonds that the Euro system has been doing. Do you see yourself as a pioneering force there in not investing in companies which somehow contravene some ESG standards?
Actually, I mean, it's the ECB itself approved and published in last year its climate agenda, and actually monetary policy tilted towards this more climate-friendly stance, let's say. So it is already a reality that for corporate bond investments there is a climate-related assessment, there is a scoring of corporates in which our central banks invest. So that's something that we are taking seriously and should actually affect in the way you would like, the way the constitution of our portfolios and the way in which we invest. So that's important. And even the collateral required for lending, that's also subject to different shades of green in the way in which we assess those collaterals. So that's an important step forward in the way in which central banks will be investing and lending to, etc., and accepting collateral. That gives an important sign to the banking industry and the sector. So that's number one, that's important. The other thing that I think is probably worth mentioning, at the Eurosystem level, and of course then the Bank of Portugal is also affected by, and happily so, that it's actually next week that we are disclosing for the first time the carbon footprint of our portfolio. So it is the first time.
Sorry,
it is a very important.
When you say our, do you mean the Bank of Portugal
Bank of
or
Portugal
the
and the
Eurosystem?
Eurosystem. The ECB is. I think it's on the 27th, actually, the date, 27th of March, that the ECB is publishing and discussing the carbon footprint of its own and of the Eurosystem's exposures.
So we're talking here about corporate bonds, aren't we?
We're talking here about, yes. Well, mostly that would be it, yes. Looking at whatever we invest in.
I simply ask because there are some studies underfoot.
Sovereigns.
And we may well be talking about that in the course of the next day and a half on
Right.
whether you can actually attest a carbon footprint to a sovereign bond. Now
Right,
that's
another issue. That's
altogether.
interesting as well, right? So, and this is important. Why? Because it's the first step. It's very important when we are discussing topics like the ones you care about, that we all care about, that climate change and what can we do, that we are able to start measuring and control and set, reasonable targets to achieve. Otherwise, at some point, we are so ambitious in setting targets of things we cannot measure that we lose hope at some point. And then this is a very big change. And it's not that I'm particularly ecstatic with the results that we are finding, but those are the first numbers. And the minute you measure them, it makes you think twice. It makes you improve the way in which you measure things, and it makes you improve on next year.
Well,
I want to do
exactly right.
better.
And
I
I
want
think
to do that.
The fact that
So
you've
that's
just been,
number one.
the fact that you've been in the job just for 3 months, I think that gives you a license, doesn't it, to do a lot of things which maybe
No, but this is not something. This is not me. This is not.
Okay,
It's on
but
the
you can ask
wonderful work.
questions.
Absolutely.
also-
I do that. I do that.
But I want to just ask you one more thing, but then we'll go to Barnabas, and then we can see some questions. I can see hands being raised in a surreptitious way already, so we'll go to the audience in a moment. But I just want to ask you something very concrete on the ESG question on the corporate bond portfolios. Now, over the last 12 months, for all the reasons we know about, the shares and the bond prices of the companies which are heavily fossil fueled orientated have zoomed astronomically. Shell, BP, the big American oil majors, those stocks and their bonds have done disproportionately well in the marketplace because of the rise in the energy price, because of the shortage of energy after the invasion of Ukraine. So if you were to say we're going to mark down those companies, and also we're not going to buy them, we're going to discriminate against them, you would not be doing your portfolio any great favors. Are you saying you're willing to override the short-term issue of a fall in the value of your portfolio because you're discriminating against those companies? Or you're saying that the overriding good is actually to go full speed into an ESG type portfolio where you will be discriminating against what you might call brown companies rather than green companies?
I think we need to be very serious about this. So for climate change to be effective, we need investments to be made, financial investments to be made properly, but we need investment in energy, we need new technology, we need to make sure that there is sufficient clean energy in the world to support our economies. And right now what we see is that the investment made in renewables, etc., has improved a lot the mix of energy that we are able to use nowadays in the world, but is still insufficient. And that's something that it's not a central bank or a group of central banks on their own alone that are able to change. So the policies that actually will be more effective in making that transformation are policies that combine strong investment in R&D, in low carbon technologies, to make sure that those are developed in time to achieve our bigger targets of net zero, etc., etc., etc. And simultaneously, we must set, carbon pricing is probably still the most effective way of penalizing, let's say, the polluters.
You haven't actually answered my question.
And,
I mean, that is correct what you said.
Right.
But would you be willing to take into account some short-term losses in your portfolio if you felt you were doing good in the longer term?
It's not something that I would decide on my own exclusively,
Let's
etc.
just say you could decide by yourself.
But in a way,
let's just imagine you could.
But in a way, the monetary policy stance says something that at some point we should be willing to pay some price for this change in
I think
in
that's
the
the right
economy.
answer, actually.
And I think, I think that's
Yes.
if we really want to do it. Of course, it's not the core of the activity of central banks, and I think, but being realistic to the point that it's not just sufficient to penalize the ones who are the highest polluters. Simultaneously, you need to find technological solutions to improve the energy mix. So it's this double and so that's why I meant that it's like in the Oscars night, right? It was just last week, right? You have a leading role played not by central banks, but of course we can play and should play an interesting and excel in this supporting role
You can be
that
the
we are
best
ready.
supporting producer.
Best supporting producer.
Good,
Yeah.
okay. Well, but Barnabas, and then could we have a microphone down for Mr. Scheide, who's got a question in a moment. Let's have some roving microphones here. And now, this question which Clara is bringing up about supporting technological progress and so on, in Central and Eastern Europe, there clearly is a big effort underway to try to wean the countries off Russian gas, because you're closer to the pipelines. You've relied a great deal on Russia in the past. The pipelines, the direction of the gas is now turning away, isn't it? There's some gas now flowing from west to east as well as east to west. That requires investment. There's all sorts of other things which Clara was mentioning in the field of renewable energies where they do require investment. They require state backing. Is the Central Bank of Hungary willing to play a role in something which might not be thought of as part of conventional policies? But if anybody's going to do it in Europe, the Hungarians will be there first.
Yeah, so of course within the current environment, the key issue is the pretty high inflation. So
You've got to say that. Yeah,
Yeah,
we all
yeah.
agree on that.
So
That's the holy grail.
So I think that's the key, and now within the whole region, the inflation rate is near to 20%. So with the 20% inflation rate, there is no chance to grow anyway. Looking ahead, so that's why now I think the key task for the central banks is to control the inflation and drive back again to a low territory. But in midterm, you are absolutely right. So I think we need an active central bank in that field. Based on our experiences, I think in the first phases of this green central banking steps, we will put more emphasis on the carrots. So we have to provide preferential rates to the society, to those investors who are
Basically
willing
to crowd in
to
private
put money,
investment.
to put money into the green issues, and of course at the end of the day it can generate some some losses in case of the central banks. And now we are, and I think with that point we getting again to a very, very important question of the current years. How do we think about the capital position of the central banks? Because if you look at the past couple of years, the central banks made a lot of efforts to provide the stability during the COVID-19. So now we are facing with the huge inflationary shocks. So now they increased the interest rates very rapidly. So in the last 2 weeks we saw it can generate additional waves in case of the financial intermediation and the financial stability. So I can imagine that it can generate also new costs on the central bank side. So I think in midterm we need an absolutely new or more flexible thinking on the central bank capital position.
Maybe that requires some legal changes as well, because I think your law at the moment says you need to be recapitalized if you make losses.
Yeah, of course. So I'm happy that the BIS in the last couple of weeks raised this question and put into the agenda, because I think if we would like to move from one steady state to the other into another steady state, within this whole transition in the energy field. I think we need a more flexible thinking on our rules.
Yes. Okay. Well, look, Frank, you've got a question. Please put the question to Clara, and then we'll ask her to answer it. And you can say anything else you want to say as well at the same time. So please stand up so everybody can see you, and use Frank Scheiding as a bit of an example. When you ask a question, he's going to do it in a very succinct, pithy, and understandable way.
Yes, good morning to you. Clara, it's the second time for me. I have the pleasure to listen to you. Last time we met was in Vienna at the Austrian National Bank, end of last year, and you pretty much follow your road, what you were referring to. My question to you would be, at the same time, when you release a carbon footprint of your portfolio, of your action, investment activities, is it not in a contradiction to what you really want to achieve? You were talking about transition, more or less. This is what you should aim for, and you led as the central bank of the European central banks, more or less, at least of the Euro Club, you led by example for many others. You have Frank Elderson around, NGFS, and formerly he had a great mission as well when he worked for the Netherlands Bank. But reality is we have far overdone a practical usage of our, obviously, Euro taxonomy, and we all recognize that this is very difficult to use it in practice, in particular if we're dealing with emerging markets and developing countries. But now here it comes. When you are just measuring your carbon footprint, and that holds you back to invest in companies, like my dear friend Marcus Prach is always referring to, the bigger effect you have there where in the corner of the brown part of the economy, or brownish one, if you support them to become at least more towards to the green side, even there are dirty industries, they might never achieve that. But even if they just meet in the middle, the impact could be so much more, instead of making someone who is light green these days dark green. That is what Marcus always liked to refer to over the past years. And I can't be more than agree. So you as ECB and all its members, you should, to my personal opinion, more led by example to live the transition and to help those also particular SMEs, not the large companies where the big volume is in, and led by examples together with the local ones like Banco de Portugal, Deutsche Bundesbank, and you name them, and show them, because they know better than anyone else their own local SMEs.
Good. Well, that's a very good
and
question.
that would be a good one.
Let's hear from Clara, and there'll be others, I'm sure, in the audience who want to take this up. So thank you.
Thank you,
Transition
Clara.
finance, very important point. Thank you, Frank.
Excellent question. Interesting, of course. And let me say that I fully agree that it's not, and I actually mentioned that you cannot transform the economy suddenly without the necessary technology, so that brown businesses are replaced by green ones, or become greener at some point as well. So I'm not discriminating or criminalizing browner industries that used to be perfectly acceptable years ago when this wasn't an issue, etc. And still we don't have the solutions for all the problems, so that we have sufficient clean energy supply for all kinds of businesses and industries so far. What we do regarding support to SMEs and to transformation of the energy mix and the way in which different companies, browner or greener in different areas, are developing their activities, have their operations set, etc. What we do is nothing directly as a central bank. It's not in our mandate. We should not do that. What we do is a lot of support in terms of advising support to the government, to the national authorities. That is part of our mandate. So what we do is we put our research department and we put our people studying these topics deeply, and we provide a lot of support to other national authorities that have responsibilities in fiscal policy, and it's in the interplay of all this policy that we give our advice, and we definitely help in looking at European taxonomy and directives, etc., and how we translate them into Portuguese law, and what the effects are.
Really I want to ask
and that's what we do. It's not something that we find that it's the Bank of Portugal that has role. We do a lot of work also in terms of literacy for those companies, etc., but not direct.
I think the burden of what you're saying is whether the Euro system should have a separate bucket, if you like, for transition finance, which I don't think you have yet, but maybe you will. Would you like to comment on that? And then we've got Stephen here from Ceres with a question, and let's have 3 or 4 more questions, rather quick ones, before we close in about 7 minutes. So let's be fairly quick here. Barnabas.
Just a quick reaction to the question. So I think again, so now we are in the first stage of the learning curve. So I think there are no final solutions for this issue, and based on our experiences, I think we need different approach in different sub-markets. So for example, in the last 2 years, we opened green programs for the households. It was a credit easing program at a preferential rate.
Sorry, I didn't catch that. For the first one, green, did you say health zones? No, what did you say?
So that was the Green Home program, where we provided funding for the commercial banks at a very, very preferential rate, much below the market rates, building new energy effective houses. So I can say that this program was very, very popular. But for example, in case of the corporate sector, we opened the bond purchases program, where both the green issues and partially those companies who operated in the brown area were involved. Because of that, we would like to see that not only the new companies who are active in the green field, but those companies who are nowadays active on the brown area is getting start moving into a more greener direction.
You're doing what he's telling you.
Yeah. So that's why I think we need a different approach in different sub-markets.
Good. Okay. Well, Stephen, let's have your question, and then please put up your hand. Anybody else who'd like? Yes, please. And we'll take a few bundled together. Please, over to you.
Stephen Rostin from Ceres. First, thank you for the great leadership. 2 related questions. Where are you, each of you, in terms of requiring climate stress tests for the banks? And do you think the current crisis, where the public is talking a lot more about stress tests, creates more of an opportunity for climate stress tests or less?
Right. So thank you for that. And just going back, I will address that immediately. Just a second to say that in the case of the Bank of Portugal and what we could do for the economy, etc., I wouldn't say the Bank of Portugal, but the country itself went through a big change years ago. I was still young at the time. And
you're pretty young now, I would say.
I'm always young, yeah, at heart. And so with a huge investment in renewable energy, so we did have strong public policy developed for development of renewable energy in the country. That changes the mix of energy that our companies are using compared to what happens in other European countries, for example. So in that sense, that's a very good example of what we need to do again, and more countries doing that, and with new technologies as well, so that
Are
this
you saying
spreads
that
to
there
the
is
company.
a better opportunity now to use these stress tests in a
Now,
positive
for the stress
way?
tests, so we are fully participating in the stress tests that the ECB and European Banking Authority has been conducting. They are actually, well, what we have seen so far, they are still, they are first steps, right? It's very important that we go through these processes, because it's, the first time we talk to a commercial bank and we say, now you need to measure your green asset ratio. You need to measure the exposure of your balance sheet to different types of climate risks.
So I think
we
your
are doing
answer
it properly.
is
We are
slightly
doing
in between,
it.
It's slightly in between positive and negative.
And
Sorry
we are not
sorry to
stopping.
interrupt,
What I'm saying
but
is that
we've
we
got
are not
other-
stopping that
We've got
because
other
of the current
questions
crisis.
coming up, and I'd like to ask Barnabas just to answer that, and then we've got time for 1 or 2 questions.
So
still.
I have to say that I'm absolutely agree with Clara. So I think the current environment is a good chance to improve further our stress testing approach. I think the key is still the data issue. So I think we have a lot on the data gap.
I think data shines through all this. Gentleman in the 3rd row, please. Again, could you stand up so everybody can see you, please?
So, Markus Ingholt, Danish Central Bank. So this is a question for Mr. Varek from the Hungarian Central Bank. Could you say a bit more about your experience with these targeted green lending programs? both in terms of what they meant for the transmission of monetary policy and if there was any fragmentation of the money markets. And secondly, if they achieved anything that couldn't have been achieved via, say, green government lending programs or other public investment support for your home refurbishments and stuff like that. Thanks.
Yes, so as I mentioned, we introduced our program in 2021. So I can say 1 year before this terrible war started in Ukraine. So I can say that the first experiences were very, very positive. As I mentioned, we focus mainly on the residential housing market because we found that if you look at the energy mix of the country, the energy usage of the Hungarian houses is pretty poor relative to those standards. We're looking at green efficient. So during the program, we put around 1% of the Hungarian GDP through a very preferential rate funding to the commercial banks. So we can say it's not a direct lending program; it's an indirect lending program. So we provide the money for the commercial banks. At the end of the day, the banks will decide about the loans. So I think it's pretty important to mention that it's not a direct lending program, it's an indirect lending program through the commercial banks. So I can say the first result was that the share of the green and energy efficient housing started to increase within the new flows. So that's why I said the experiences were pretty positive. But of course, we have to know that at the end of the day, these programs are monetary easing.
Well, I think the second part of your question, the more philosophical part, we'll maybe have to wait for the coffee break for you to have a separate conversation. I'd just like to...
Just one sentence.
Okay, one sentence.
Of course, when your inflation jumped to above 20%, it's pretty hard to continue a monetary easing program. So that's why we start to exit during this period.
This is my final question to Clara. I'm going to use this as the sign off because we've run out of time now. But in 5 years' time, Clara, when we look back at this period historically, do you think people will be able to say that the central banks have got the right balance between defeating inflation, which is very high, particularly in Central and Eastern Europe, and this generational, this epochal issue of climate change? Do you think we're on the right line to getting the right balance between these two very big and partly competing priorities?
What I can say is if today I did not believe that, I wouldn't be doing this job. So that's why I took this job, and that's what I think we should be doing, keeping the right balance on this, of course, not forgetting our essential mandate of bringing those prices under control, bringing price stability, because without predictability, it's very hard to decide on investments, it's very hard to get the right public policies, fiscal policy as well. But those the energy transition has to be done as well, so we need to keep this balance. And I think, despite current little turbulence here or there, I do hope that we are on the right track, and in 5 years' time, I'll come here and
you'll
tell you
be here
about
before that time, Clara, I can promise you that. Barnabas, final words.
Yeah. So David, I think we have to find this optimal solution, because again, the mega trends are changing. The mega trends are pointing to more volatility, higher inflation in midterm. So if a central bank would like to regain the price stability in our economy, we have to find the right solutions for these green issues, because without that, we will not be able to drive back the inflation again to the low territory.
Well, thank you. A very good parting word. So a round of applause, please, for Clara and Barnabas. And then back to John Orchard.
if you're talking on this panel, do feel free to come up and join me on stage. Yeah. Emma, do we have New Zealand online? Aha, there we go. Hello again, everyone. I promised you an hour ago that we wouldn't be talking about first principles today, but based on what I've just heard, I think we still need to talk about them a bit, alongside all the other interesting things that central banks are doing. We've just also been reminded that they have a very difficult day job at the moment, and maybe that's difficult to reconcile with some of these. We'll explore these issues and others with an excellent panel. Joining us online, virtually. In fact, in your manifesto, Simone, there's talk about business travel. Perhaps we can come back to that. But Simone Roberts, Assistant Governor and General Manager, Strategy, Governance and Sustainability at the Reserve Bank of New Zealand. We have with us Chuchi Fonakia, Deputy Governor, Financial Supervision Sector at the Central Bank of the Philippines. We have Eric Boye, Manager, Product, Knowledge and Research at the World Bank Treasury. And we have Franco Panfili, who is Deputy Director General, Directorate General for Markets and Payment Systems at Banca d'Italia. So welcome everyone. We've just heard a mixture of some very concrete activities of central banks, but also a discussion actually of fundamental principles which seem to me not quite to have been resolved in many ways. I'd like to first ask each of you about the work streams that you're carrying out as central banks, not the World Bank, but as central banks, either in your portfolios or as bank supervisors. Obviously, both things are very important. So we'll go to each of you in turn, then we'll go on and explore all the issues. So, Simone, why don't we start with you, and also perhaps if you can talk a bit about your work in the NGFS. I promised not to use alphabet soup today, but we're going to have to. So starting with you, Simone.
Thanks very much. And look, thank you for the opportunity to participate in the discussion today. So just check you can hear me, John? Is that
Yeah, maybe a shade louder if you can, but we can. Thank you.
Louder?
Yeah,
Certainly.
great, thank you.
So look, thank you for the opportunity. So I mean, Reserve Bank of New Zealand, we're a full-service central bank. We've got stability at the heart of our mandate. So stability in terms of monetary policy, but also in terms of the broader financial system, so financial stability. So anything, obviously, that challenges that financial stability and our economy is our core business. So, you know, as a society, we're reaching net zero by 2050 requires us all to think about the way our economy is organised. It's about changing those large-scale flows of capital, not just away from the carbon economy, but redirecting those capital flows into adaptation. So as a regulator and a supervisor across the financial system, and as New Zealand's central bank, the signals we send on readiness and our collective understanding on climate-related risks and what we're doing about it are crucially important. So our climate change strategy has three components. So the first is really just managing our own climate impacts, so getting our own house in order, if you like. The second is mainstreaming our climate considerations into our core functions, so getting those settings in place. And then the third is leading through collaboration, so showing the way. At the Reserve Bank in New Zealand, in our work to target climate change, we're currently focusing on a couple of key areas. So under getting our house in order, we've been reporting our full scope 1, 2 and 3 emissions since 2019. We recently set emissions reductions targets for our heat, electricity, waste, and business travel. We're working to address emissions not currently in our targets, such as currency production, currency freight, procurement, and a few others. We're also starting our own disclosures based on the Task Force for Climate-Related Financial Disclosures, so TCFD, which you've already covered this morning, I'm sure.
And Simone, perhaps you call all of those things
Yes.
leading by example, I suppose, as an operation rather than as a central bank per se.
That's right. So that's right. And look, we can't ask our regulated entities to be doing all these things and upskilling and building their capability if we're not doing them ourselves. So that's really the stance we've taken there. And then on the supervisory toolkit side, we've built climate-related questions and topics into our standard supervisory toolkits. We're building our capability, but alongside our other fellow domestic regulators, as I'm sure is happening in Europe and the UK as well. And we've incorporated climate-related risks into our stress testing, which I'm sure we'll come to a little bit later. And then on the collaboration side, there's a range of ways we're doing this both internationally and domestically. We're a long way from many other jurisdictions, as you know, but the forum probably most familiar to those listening today is the NGFS, Network for Greening the Financial System. So we're co-chairing that obviously with Banco d'Italia, the work stream on net zero for central banks. So we're really, really thrilled to be helping out with that work stream. And again,
so,
3 parts.
Perhaps we'll explore the NGFS in a little more detail a bit later.
Oh, perfect. Yeah, perfect. So we can come back to that. So look, I'm happy to leave it there, and we can talk about perhaps our involvement in the government policy agencies here and policy setting here in New Zealand as well as we go on in the discussion. But thanks very much for the opportunity to make some introductory remarks.
Well, great to have you with us. I'd certainly like to explore your supervisory role as well. I think that's a super important component of leverage that central banks have where they are regulators. Franco, tell us about, you're obviously part of the Eurosystem like Portugal. Tell us about what Banca d'Italia is doing in this area.
Thank you. First of all, thank you for the invitation, and apologize for the level of my voice, but I caught a bit of cold yesterday. I think it's a confirmation that there is a big difference between London temperature and the Rome temperature, unfortunately. So apologize for the inconvenience. What we can say about our work streams? I think the Banca d'Italia tried to play an active role in sustainable finance through the various activity, the various function that the Banca d'Italia performed. So as investor, as a supervisor, as a monetary authority, and as a research institute for the bank. Our contribution include also public discussion and research that are based on internal analysis conducted to improve understanding and to raise the awareness about the importance of measuring and managing sustainability profiles. In particular, we try to get support for intermediaries, investors, and also policymakers in this area. Recently, in 2022, we decided to further boost our sustainability action and decided to set up a climate change and sustainability committee chaired by one member of the board. And at the same time, we set up a climate change and sustainability hub that is a sort of a core center for all sustainability activity of the bank. Just for giving some words about the different functions of the bank. As investor, we decided in 2019 to take sustainability profiles into consideration when making our investment process. And probably in the next other question, we try to do more details about that.
Perhaps, Franco, what might be helpful for those not familiar with the Eurosystem, what agency do you have that is distinct from the ECB? So where are you implementing ECB policy on ESG, and where do you have room for manoeuvre in your own jurisdiction?
I think we have to distinguish between our role as investment, where our margin of maneuver is quite larger, because the investment process is completely under our control and under our power. About supervision, of course, it's different, because because we have the duty of control and supervise the so-called less significant bank.
Yes.
And in this case, for example, the bank issued some supervisory expectation for this less significant
You
banks.
haven't got any SVBs in Italy, hopefully.
Exactly,
Yes. Yeah.
exactly,
Yeah.
exactly. Of course, it's perfectly in line with the same expectation taken by the single supervisory board at the ECB. So I think it's in terms of a monetary policy. Of course, we participate through the committees, through the governing council, to define also the greening monetary policy. Our Portuguese colleagues before, I think, detail in a very precise way which is this roadmap that I think is quite important. And in this sense, it's of course the monetary policy of the Union is a common a common power between all central banks around the
Of
Europe.
course, and Italy is, of course, is also a key recipient of NGEU funds, which are aimed significantly at green projects. We won't spend time on that, but Italy has an important part of that story. We'll come back to that and other things in a moment. Chuchi, back to the other side of the world now. Of course, you're entirely sovereign over your own jurisdiction, but tell us what your work streams are in the Philippines.
Yeah, thank you. We thank, of course, FIF for this opportunity to also provide what's happening in that side of the world, in Asia. Actually, we are all aware of the global call to action on as far as the climate change is concerned. And each of us would have a role to play, whether as monetary authorities, as supervisors, and even as individuals. And so we can actually contribute to this cause. And so on the part of the Bangko Sentral ng Pilipinas, the Central Bank of the Philippines, our response to that is our Sustainable Central Banking Program. And that program, adopted in 2019, is one actually of the strategic thrust of the central bank. And in developing and embracing central banking, sustainable central banking as a strategy, we are mindful of 2 points, in that first, it's really the primary responsibility of the national government, although that is not to say that the central bank can also play a role towards achieving, of course, the nationally determined goals. And second is that the role of the BSP in this space are actually still within the scope of our mandates, that of maintaining price and financial stability. So the strategies embedded in our Sustainable Central Banking Program features the central bank's role as enabler, mobilizer, and doer. Now, we were able to come up actually with 11 strategies, 11-point strategies, action points. And so as an enabler, we, of course, focus on issuing enabling regulations, and that our expectation of the banks, as well as other supervised institutions, is that they would embed sustainability principles in their risk governance and risk management system. For us in the BSP, we, of course, strive to embed these sustainability principles in the regulation as well as in supervisory tools, and that's with due regard to proportionality, the principle of proportionality. And that these enabling strategies would also include, of course, our collaborative arrangements with other regulators and with other supervisors in the region, and of course globally as well. And our role as a mobilizer is that we aspire to shape and change the behavior of our stakeholders, those within the sphere.
Tell us a little bit about how.
We aspire, because we really intentionally have the strategy of, at the onset, having these expectations from our supervised institutions, the banks, that they would have the buy-in. So we started off with high-level principles so that it would be a tone from the top for the supervised institutions, so that it will not be taken to be as just a sort of compliance, but rather they are really heavily invested in this endeavor. So that's the way we've been really very intentional as far as in the issuance of our regulations. So we would like to, of course, influence the behavior. And in turn, these banks would as well influence the behavior as well of their borrowers.
Course. Does that go as far, in your case, of leaning heavily on the banks via risk weights for brown assets and things like that? I mean, that's you can really apply pressure through that kind of thing, or are you more talking about culture?
It's really more of the culture, but this is not to say that we, of course, have started to conduct our vulnerability assessment, as well as on the transition risk, the physical risk, since Philippines is in the typhoon path. So we'd rather have that approach to be started and grounded first with the data, and then moving from there, we would maybe later on have some mandated, let's say, ratios. But at this point, we wanted this really to start off with the board and senior management having a buy-in first.
You're preparing potentially to act later, I think. So we'll explore that more in a moment. Eric, the World Bank, obviously not a central bank, and has played a material role in ESG finance from the beginning. It likes to be a groundbreaking institution at the Treasury, doesn't it? It likes to issue derivatives before everyone else, green bonds before everyone else, and so on. Tell us what the World Bank is doing, both as a lender and a borrower and influencer.
Yeah, so thank you first for the invitation. Yes, and I will focus on what we do at World Bank Treasury. You know, I will not take the broad World Bank perspective, you know, which is much larger. So at World Bank Treasury, we have a 360 degrees approach of sustainability. As you mentioned, we are an issuer, we are an investor, but also we are an advisor. So let me tell you on the advisory side, and maybe I can tell you also on the issuer side. As an advisor, so we run a program, and here we have some members, which is called the RAM program for Reserve Advisory and Management Partnership. It's a program where we have more than 70 members, and if you look, and mostly central banks, and we help them, you know, with the management of their reserves. And what we do on the sustainability side is that we share with them central bank sustainable investment practices, and we offer them, for example, peers comparison. Something else we do with central banks is that we help them to design sustainable investment policies. So we work on beliefs, you know, ESG beliefs or sustainability beliefs and objectives. You know, we use case study with them, so you know it's very practical. Another example, and you know I can develop further later, but for example, we worked with them on building sustainability-informed strategic asset allocation. You know, how to use economic models like integrated assessment models, how to use NGFS scenarios, because of course you have NGFS scenario available, but how do you use these NGFS scenarios into your reserve management can be a challenge. And of course we are part of the different NGFS work streams. Yeah.
And is this advice that you give to central banks, it reflects also policy in terms of your lending? Would that be fair to say?
No, it's I think you raise a very good point. Yes, there is some consistency between the both, but you know, this is run by different teams because I think it's important to have you know, independence on both sides.
Fair enough.
But As an issuer, I think you mentioned it just to give the big picture to people. I think we are the issuer for IBRD and IDA. We issue roughly 50 billion each year, AAA, very liquid bonds. And we have been a leader in the ESG market. We at World Bank Treasury, we have contributed to increase transparency and defining best practices. I think you mentioned earlier, yes, we were the first green bond issuer in 2008. And, and we have, with that, we created a blueprint for sustainability across markets. And more recently, we have taken a holistic approach to label bonds. All the bonds, we issue are sustainable.
Yep.
And we call them sustainable development bonds. And probably we have set up a standard, in the, across the MDBs, the multilateral development banks.
Thank you. And certainly the labelled bonds I know we'll explore elsewhere, and there's a complicated discussion. But essentially the philosophy of the World Bank, I think, is that if you lend in a sustainable way, your issuance is also sustainable.
Yes, exactly. Yes, that's exactly the philosophy, and I'm glad to say more later.
Okay. Well, perhaps we'll come back to. I don't say it's a standard debate at these events to discuss which is the right approach on that. I wanted to, before we come back to look at real action that can be taken on bank supervision and reserves management and so on. I wanted to go back out to the issue of the relative importance of this area. Chuchi, I think, suggested that actually this is as much a job for government as it is for central banks. Central banks have a very difficult day job at the moment. Simone, perhaps first to you, do you think the net zero imperative is, from the point of view of central banks, subordinated at the moment by the market and economic turmoil? I said at the beginning in my introductory remarks that it isn't being, but maybe it is.
Look, it's a very good question. I mean, for me, no, this heightens the urgency, accelerates our will to manage an orderly transition. I think if you look at the IPC synthesis report, I mean, it highlights issues such as financial inclusion, just transitions, making sure regions that are underserved currently need to be brought into the climate transition adaptation conversation very soon. Here in New Zealand, we are dealing with floods, cyclones, very real problems for some of our regions. So these are very live discussions. So no, I would say now is the hour to really grasp this. We don't have a lot of time, and this is a good opportunity for us to just step in. So yeah, I think we need to avoid locking in our carbon-intensive ways of operating.
Okay. Franca, I mean, you're lucky not to be in Switzerland, but Switzerland has other headaches at the moment. For example, you can imagine this issue being regarded as important but not urgent.
I think it's a good question, but what I can say that is many times we are faced with the dilemma of whether long-term goals should be in some sense sacrificed to solve a short-term situation. And I think we have been experiencing the last 2 years exactly this situation. On the one hand, the need to continue on the path towards a net zero. On the other side, the current energy crisis and the turmoil on the market and the tragedy of war. Don't forget that with really human and economy damages. Of course, this situation could, I think, hamper the path towards net zero. But I think there is some apparent contradiction for my point.
Right.
Why? Because at first glance, it seems that the current emphasis on energy security could, in some sense, jeopardize the energy transition. that of course we need to tackle climate change.
Or speed it up.
Yeah, okay. But I think it's just an apparent contradiction, because at the end, energy security and the transition are not juxtaposed, but are completely interconnected between. So I think we need to have, I can say, a more long-term horizon, long-term approach. In a sense, we have to isolate ourselves from the turmoil, from the short terms. And I think that when the current energy crisis is faded away, the public policies need to be designed with a clear objective in terms of net zero. Also, in this sense, also the energy price signals that are currently in place could be available in the long run, because and in the long run, I think must be replaced by fiscal signal such as carbon pricing, for example, and taxes, of course. So I think the path to net zero is a mandatory for the humanity.
I think in short, I think you think no, it won't be subordinated by the current problem.
Exactly.
Chuchi, would you agree in the Philippines that this important issue will be pushed aside by urgent issues in the central bank's day job?
Yeah, actually, it's really an important issue, and we're working that as well, of course, with the national governments. So we have this interagency task force that's tackling this climate change. So it's a whole of government approach. And for us in the central bank, our regulations are really largely principles-based, because we deem it to be that the approach to be more flexible and that risk-based as well, since it focuses primarily on the varied risk appetites as well of the banks, to give them flexibility, as well as, of course, dependent on the business models of the bank. But we would like to underscore, again, on the tone from the top. And so on the private sector side, the banks would really be the one driving the net zero transition.
Okay, now I want to come back to them in just a moment. Has anyone got a question so far? Please raise your hand if you do for any of the panelists, and I will get a mic for two. Gary Smith. You don't need to say who you are, because I just have, but please put your question. Thanks, Jess.
Thank you. Eric, I think you said that at the World Bank you use NGFS scenarios to help with managing ramp portfolios. Presumably, the vast majority of the bonds in a ramp portfolio are government bonds. Can you talk a little bit about how NGFS scenarios can impact on a sovereign bond portfolio?
Yeah, sure. And let me be a little bit more precise. We are helping central banks to run NGFS scenario for their own portfolios. But we are doing for ourselves too, but I think most important it's what we do for, in supporting central banks. As you know, there has been the NGFS scenario for some years now, and we had the latest batch, which was, I think, at the end of August, beginning of September, and revised again. I think it was early October and November, because there were some adjustments that were needed. And what is very interesting, if you look at the NGFS scenario, it provides you, if I simplify, 6 scenarios for the next at least 50 years. And the question is, what do you do with these scenarios to see what would be the impact of your fixed income portfolio? And the beauty of these scenarios is that you have interest rate scenarios. So you know what will be the path of interest rates, let's say over the next 10 years under these different climate scenarios. Then it's very easy to come up with what we call capital market assumptions, is that you can build expected returns and expected risks for this, for your portfolios, under these six climate scenario. It's what we have done with some of our members of the RUM program. We did a research paper on that we presented a few months ago. We have our flagship event, which is a research conference we do with BIS, and we did with Bank of Canada and the Bank of Italy. It was a few months ago. So I will. It's a side discussion, but I will be very glad to share that research paper.
Gary, which portfolios did you meet? Was the central banks are quite big buyers of government bonds, or have been?
Really what I'm driving at is, how do you differentiate between a Bund and a French OAT, or a US Treasury, or a gilt, in terms of these six scenarios? And then, how do you manage your benchmark risk? You're inventing a new benchmark effectively, or you're running big basis risk versus a traditional benchmark. How do you manage this?
Interesting question.
Yeah, the beauty of an NGFS scenario is that you have different paths for both macroeconomic and financial variables for different countries. So then you can really do what you'd like to do, what you mentioned. Now sometimes you may not have all the financial information. I think you were talking about credit risk or spread risk. That may not be an information you get directly, but that's an information you can infer from macroeconomic variables.
Are you suggesting, Gary, that this might oblige uneconomic decisions?
Well, it goes back to your previous question, and maybe the answer that I think Carla gave, that this could be ultimately the economic consideration that we should have over the very long term. But short term, we're going off benchmark, basically. Right. So we are running measurement risks by going down this route. And so how do we bridge across the two?
Okay, thank you. Interesting. I want to come back again to, as I say, to the supervision of banks. I think there's an enormous amount of pressure that can be applied through the financial system from central banks via that. But Simone, we've talked a bit about the NGFS. What are their key work streams at the moment? What's top of the in-tray at NGFS?
Thank you, John.
And is it effective?
The piece
does it work?
that we are most involved in is the net zero for central banks. So we're looking there at three pieces. So the sustainable and responsible investment for central banks. So helping central banks integrate SRI principles into the management of our own portfolios. Likely to produce some guidance on the back of that work stream, I think towards the end of this year. And the second bit is the central bank's own disclosure, so a little bit about what I talked about that we have started on in New Zealand, so climate-related and environmental risks. And again, based on TCFD, trying to inspire central banks to lead by example and then demonstrate some accountability through our own disclosures. And the last piece is really greening our own corporate operations. So more of a forum to share experiences, methodologies, the challenges that are particular to central banks, like the issues related to resilience of our operations, your payments and settlement systems, the particular currency issuance, whether digital or physical, transition plans for central banks, and then the payment systems pieces that I've mentioned. So those are sort of the three heads, and obviously NGFS by its nature is very transparent in what it produces, so any guidance coming out of these will be available to central banks and supervisors and all members. So
would it be fair to summarise those work streams essentially as leading by example rather than applying pressure in the financial system per se?
That's right. And I think a lot of these emerging mandates, if you like, whether you're looking at disclosure or SRI across portfolios, we need to lead by example. We don't have all the answers. We're sharing a lot between us as regulators and with our industries that we regulate. So absolutely leading by example, but also learning and building capability together.
Okay, thank you, Sumit. Chuchi, I've detected, I think, a slight reluctance from central banks so far today to interfere too much in commercial bank business models, perhaps. And I'm wondering why that might be. Why don't you as supervisors lean on the banks more heavily to divest brown assets or to incentivize, actually as the Bank of Hungary was talking about earlier, investment in green assets?
Yeah, I think it can be done in phases, but not outright. That's why at this point there's appear to be a hesitation, but it's not really more of not adhering to that or not contributing or driving the result for the commercial banks, but we're more concerned, of course, on the impact of on their balance sheets as well.
Right.
So it's also on the financial soundness of the institutions. So at this point, we wanted it to be done in phases.
Okay. What do you think about that, Franca? With the ECB's got interesting sustainability policies, including green QE and so forth, but it's also a major supervisor of banks. Should it not lean more heavily on their business models in this regard?
Yes, I think it's about. I'm not an expert of supervision, but looking to the monetary policy consideration, I think the Eurosystem came out in 2022 with the concrete steps in this direction. I think there is a very important caveat on this issue, because
it's more complicated under the surface.
Yes, of course, because the application of a sustainability measure must not impede the achievement of our quantitative targets. It must be very clear, or create a distortion in the bond in the market.
How are they intentioned?
Of course.
No, but how are they? In what way are they in contradiction?
Seems a contradiction, but I think the climate change and the risk linked with the climate change, they have a risk for financial stability and also for price stability. So I think it's completely internally to our mandate. But I repeat, we can proceed step by step, but with this caveat that our roadmap must be coherent with our quantitative targets, and we have to avoid the distortion in the bond market. So in October, since October 2022, the Eurosystem has titled, as you know very well, the share of its purchases of corporate bonds towards the company, those perform a better climate, that they have a better climate performance. At the same time, we decide to disclose also our portfolio that is exactly in line with this roadmap. Last February, the Eurosystem, together with the beginning of the partial reinvestment of our policy portfolio, the Eurosystem decides to increase the overweight of purchases of low-carbon corporate securities to confirm its commitment. I have my personal opinion. This is a personal opinion. I don't know if it's the opinion of the bank, that we have to pay strong attention about the strategy that we want to implement, not only for monetary policy but also for investment. Because when I hear strategy in terms of exclusion,
right,
I think there are really very, very big risks. Which is the risk? The risk is that we can sell some sector of the economy, and it's, I think, a very important risk. So we are trying to help the companies to decarbonize their product, and we have to have available capital for that. If and of course we have to help the best in class in this company. So
which the Bank of Hungary was talking about.
In this sense, I think a key point is the transition transition plan of the company.
Okay, transition. I want to come to you on this, Eric. Obviously, you're not a central bank. I hear a lot of trepidation in this area. So after the Lehman crash, commercial banks had their core capital requirements doubled. There were penalties put on risk weights for securitization and things like that, all pretty hard. There seems to be a lot of hesitation in this area, which you could argue would be less onerous for the commercial banks. What's going on?
Yeah, I think the question is that will there be a Basel IV, that will take into account, all these sustainability questions.
Right.
And probably if it's decided to go in that direction, it probably will solve, many of the issues you mentioned.
Okay. So in other words, you agree with me that they're hesitating and they shouldn't?
No, I think it's exactly the same issue as when you are a reserve manager, is that you have to balance between your investment objectives, where you have liquidity, safety, return on the other side, on one side, and then you want to be sustainable. So how do you balance between two frameworks?
Okay. Implicit in that, Simone, perhaps you might want to comment, or even the Bank of Portugal, perhaps if you'd like to come in as well. Implicit in all of these replies is that there is a tension between an economic investment and a sustainable investment. Would you agree with that? Simone?
In terms of our banking sector,
yes.
Yes, yeah. I mean, it is tricky. I mean, people do point to the risk weightings as a tool to help us accelerate progress in this area, but it is, it can be quite limited for affecting change, and some banks can already incorporate green variables in their assessment, so in their models. So I think, yes, some acceleration would be very helpful, but it's not the only tool. And I can't underestimate the power of disclosure once our institutions are all in a pattern of disclosing what they are doing and how they are investing. That will be very powerful.
Okay, fair enough. We'll move on to or rather back to the labelling of assets topic briefly. I'm sure we'll talk about that again throughout the conference. Perhaps back to you then quickly at the World Bank. Perhaps we can go into more detail about whether it's important for the investment community at large to do due diligence on every single issuer to decide whether they're sustainable or not, or we should develop an ecosystem of labels that will save them the work. Which is the better approach and why?
Yeah, I can tell you, what has been our approach, at World Bank Treasury. We have this holistic approach where, all the bonds we issue are sustainable development bonds. And how we do that is that we link them, to all the projects for which, we land, at the bank, the World Bank. So, in a sense, that answers part of your question. Now, another way to answer that is that, yes, we believe in label bonds, and we have done many innovations recently, in that direction. So, for example, I don't know if you have seen it, but we issued the first wildlife conservation bonds in 2022, where we connect wildlife protection outcomes in South Africa and performance. Another one we did just recently, we have done an emission reduction linked bond in earlier this year to help finance water purifiers for schools in Vietnam. Another one, also on top of that, and something we have done for some time now, and it helps to address physical risk, and especially chronic and acute physical risks. We have been working on cat bonds to provide insurance against natural disaster, and in few countries there are Jamaica, Philippines, and Mexico.
Okay. Chuchi, in your reserves management team, in as much as you know, would they be happy to buy a World Bank bond? I don't know if they do, but if they did, would they be happy to buy it on the basis that the issuer is sustainable rather than the labelled bond?
Yeah, actually, for the BSP Treasury, we've started already some considerations as to sustainability matters. So actually, we started in 2019 to invest in the Green Bond Fund managed by the Bank for International Settlements, or the BIS. And then our investments there have grown actually now to around $550 million. And we believe that apart from advancing our sustainability initiative, green bonds provide also higher returns and diversification for our portfolio. So there are, of course, diversification benefits to that for our foreign exchange reserves. And also in February of 2022, that's last year, we also invested in the Asian Green Bond Fund, which helps to channel funds to green projects in the Asia-Pacific region. Okay. So we are reviewing actually also our strategic allocation of investments with the end view of course, further aligning with our sustainability objectives. In fact, our Treasury is working towards becoming a signatory of the UN Principles for Responsible Investment.
Right.
And is considering the development and adoption, of course, of a responsible investment charter.
Okay, I think that's very helpful.
Something on the green bonds.
Yes, I'll come right back to you in just a sec, but I'll come right back to you. Simon, just from the point of view of your own investments, reserves and elsewhere, pensions maybe, do you take the approach of buying labelled bonds, or do you do due diligence on the issuer as a sustainable issuer?
Like I can't speak to the actual strategies myself, but certainly very similar to our previous panelists, that we're at the quite early stages of looking at our strategic asset allocation across our portfolio, and making sure that we can meet our policy and liquidity requirements. But obviously realizing the world is changing, the range of investments is changing rapidly, and we need to move with this. So again, quite early stages, but the team is really committed to making some progress on this in the coming year.
Okay, thanks very much, Simon. Please.
Yes, just a few words about the green bond portfolio, because we decided to use this strategy in our reserve management. I think it's a good alternative and possible.
Which strategy?
The strategy to buy a green bond, respect to use in the investment decision for Govi.
Right.
Yeah, it's exactly what I would like to say.
Yeah.
Could be a good alternative to, in some sense, overcome the problems linked with the government that many times during this panel appear, because don't forget that the government bond is a very important, in our case, is the largest share of our own funds.
Right.
But I think it's normal, because if you think the function of a government bond for the implementation of monetary policy, for financial stability, and the other institutional function of the central bank, I think it's really very, very difficult to say that we can apply strategy as a best in class that we can easier apply for the stock, for equities, for corporate bond. But I really see a great difficulty to apply to government bond. The problem for green bonds, according to our experience, that is difficult to find green bonds in the market.
Right.
This is another problem.
Which will make them uneconomic as well.
Yes, because I think also talking with our Minister of the Treasury, Republic of Italy issues its first green bond in 2021. Up to now, the Republic of Italy issued just only two issues. The problem is the management of this revenue, because the green bond, the standard of a green bond, in some sense, put many constraints for the using of these funds. And so I think for the treasury around the world, it's very difficult to issue green bonds. So according to our experience, it's difficult to find government green bond with the level of credit risk current with our limits. It is our experience.
Okay, so you, just to simplify a little, you wouldn't regard an Italian government bond as a green asset unless it said it was green?
Yes, in this sense, yes, because of course in the European market, the leader of a green bond is Republic of France, is France. Italy started, I said before, not so far, just 2 years ago. Probably one possible new market for government in the future could be sustainable bond respect to green bond, because probably it's much easier to manage.
Yeah, you know. I'm sure we'll definitely talk about that more over the course of the conference. We're soon out of time, but I want to ask the audience if you've got any more questions that you'd like to put. You'd be very welcome. We've got a couple of questions. So, Amy, here first, please. If you could say where you're from and put your question. Thank you very much.
Absolutely. Hi, I'm Emily Homer from Robeco Asset Management. What struck me throughout the discussion, and John, you pointed to this, is, you know, you're doing a lot, but it's now 2023, and the Paris Agreement was in 2015, so that's now 8 years on, and it still sounds like you're very much working through your asset allocation, working through supervision of banks. And so my question to all the panelists really is, what is needed to accelerate the work that you're doing so that you do remain leaders and the financial sector can follow central banks?
Why don't we, Simone, perhaps we'll start with you. So back to the leading by example theme.
Yeah, look, and it is a great challenge. We are well aware that we have catch up to do. We're bringing our banks and regulated entities, insurers, etc., along as quick as we can. So in New Zealand, we now have legislative mandated disclosures based on TCFD, and they came in January. We do think that will accelerate our progress on adaptation, mitigation, transition plans for our entities. So I am hoping we'll see some real progress this year. We are also seeing, as you are all experiencing, more frequent severe weather events. So this is also sharpening the minds of our policymakers here in New Zealand. We know we all have to act quickly, so I'm hoping we will see a lot of progress in the coming months. But thank you for the challenge.
Thank you. And that comes back to the theme that we're concentrating here on the supply of information most of all, rather than economic decisions by the central banks per se, I think. But there was a question at the back.
Thanks. Thanks, John. Jahangir Acker from Neuberger Berman.
Yeah.
One of the things that BlackRock has experienced in the US is being bashed by the political system for assuming that they had the right to come up with a definition. So John, you've been referring to labeling. The problem is not everyone agrees on what the label is. So there are different definitions of it. How do you feel that you can create enforcement action of any form when this ends up becoming a political movement? How do you deal with that element of it?
Excellent question. We might start with the World Bank on that one.
Thank you.
And I'm not going to say why, but maybe it sounds like some people are guessing.
No, thank you for giving me that difficult question.
Yeah, my great pleasure. But it looks like your institution is responding to exactly this issue. That's why I'm putting the question to you.
Yes. Again, I just can talk about what we do. For example, on the issue one side, and it's related to what we do with our counterparts. And how we work with others, how we cooperate with others. So, for example, we do a lot of cooperation with investors, to develop best practices, to improve transparency. We work a lot with reporting entities, internally. And sorry, I will use many acronyms again, but they are quite well known, I suppose. We work with GRI, with CDP, with TCFD. Also, we work a lot with, on both the issuing side and the investment side / advisory, we work a lot with ESG scores company and looking at either convergence or not, what are the differences. We did a study a few years ago where we look at the ratings, the ESG scores at sovereign level from the different rating agencies, and we could find that a lot of information was publicly available already. So I think it's more about harmonization. It's more about collaborating. Frankly, we are at the beginning of the journey. So I think that's why your question is very tricky.
The question is essentially, is this issue still too politicized to make financial decisions as a global asset manager, for example?
Alors, something we discuss with our members, our RAMP members, is that because you're talking about the political aspect.
Yes.
If we make an advisory with, let's say different central banks from different countries, what sustainability means can be very different across countries.
Yeah.
And it's where, we used to have this concept of investment beliefs, and now we have this concept of sustainability beliefs. And it's more about, how to extract these sustainability beliefs.
In the Philippines, how does it look there? So the question is whether this issue remains too political to make a neutral policy on it for financial institutions, which is true in the States to an extent for reasons that we can go into. But how does that look in the Philippines?
Yeah, in the Philippines, we have this, what we call as the Financial Sector Forum. So it's composed of the different regulators. There's the BSPs, the central bank there, of course, and the Securities and Exchange Commission, the Insurance Commission, as co-regulators. So we're working on a taxonomy and to harmonize as well the regulations from insurance to the capital markets and to the banks. But I think from a supervisory standpoint, quote unquote, the label market as a starting point would provide as a baseline which can serve as a guide for investors. So I think moving on from there would be something that can be as well maybe globally be adapted, but on a per jurisdiction basis, it would be good for a uniform way of treatments. That's why taxonomy for a jurisdiction is important, and that can be connected as well with the other in the other jurisdictions in the region and globally as well.
Okay, Jenga, does that answer your question?
I think we've got lots of work to do.
Yes.
Yeah,
okay.
definitely.
I think that's probably right. We're out of time, and you're well overdue coffee, tea, and Danish pastries. So thank you very much. It sounds to me like it reminds me a little bit of the central bank digital currency discussion, where there's some excellent papers and lots of very useful conversations, but not everyone's quite ready to act just yet, I dare say. But extremely useful conversation. I'm very grateful to the panelists for taking the time to talk to us and talk about their own jurisdictions. So thank you very much, everyone. Enjoy the coffee and tea, and do come back, Emma, in 15 minutes for your panel on an orderly transition. 25 minutes. See you in a moment. Thank you very much, everyone. Thank you. Bye-bye.
Thank you. Hello? Perfect. Welcome back, everybody. I hope you're suitably refreshed. Please do bear with my voice. Seems to be a common theme today that people have colds and coughs, but we'll push through. So this session is going to be looking at preventing a disorderly transition. So we'll be exploring scenario analysis tools, risk frameworks, and stress testing. So a deeper dive into how we manage our risks. Just to highlight, there will be a poll question which will come up during the discussion, which is going to be asking, does your institution have a clear understanding of the risk implications of climate to your assets in your portfolio? So our virtual audience, please do partake in that. To our in-person audience, if you go on the OnFifth event app, it will come up there, so please do participate in that poll. So I'm joined today by some excellent panelists. I have David Jan Jansen, who is economist of financial stability at the Netherlands Bank. I have Stephen Rostein, who is Managing Director at Accelerator for Sustainable Capital Markets at Ceres. Satoshi Ikeda, who is Chief Sustainable Finance Officer at Japan Financial Services Agency. Livio Straka, who is Deputy Director General of Macroprudential Policy and Financial Stability at the ECB. And hopefully joining us virtually is Elias Albagi. Hi, Elias, who is Director of Monetary Policy Division at the Central Bank of Chile, and is also their Chief Economist. So welcome all, and thank you so much for joining me today. We've already talked a little bit about the risk implications of climate, but I think just to set the scene and to kind of go into this discussion, I think it'd be great to hear from you on what you see the risks associated with climate change are, how your various institutions, obviously we have 3 central banks here, are dealing with those risk implications. We'll go a little bit later into the stress testing methodologies that are being utilized, but yeah, perhaps David, I'll get to you first, just to introduce yourself and touch upon how you see risks in climate change.
Many thanks. Thanks also to OnFifth for the invitation and putting together this great event. My perspective, I think, that I can offer to this particular panel is very much indeed a financial stability perspective, and within that, let's say, the whole discussion on scenario analysis and or stress testing. So that's also very much, let's say, the experience that I have at the Nederlandse Bank, starting a few years ago, and I think. Perhaps 1 or 2 things to say there by means of introduction, and then I think we can always dive deeper later on. So I think to me personally, I think I've seen throughout the couple of years that I've now worked in this area great progress. I think from a setting where we sort of had the notion that we need to think more about these climate shocks and these climate events and the bigger trends surrounding climate change, because we think they are at the end of the day financial risks also, and I think I do see, let's say, a journey where we've made, I would say, progress, and perhaps even great progress in terms of going from that qualitative discussions to quantification, so that we now have, let's say, different sort of examples, exercises that we've done where we actually have, to the best of our ability at present, run the numbers and can have, let's say, a conversation based on those initial insights. I'm sure that throughout the panel we will touch upon the different types of climate shocks that we can consider, whether it's transition or physical. So perhaps I can sort of leave it here for the moment. Thank you.
Lovely, thank you, David. Elias, maybe I can come to you next for quick introductions and how the Central Bank of Chile is seeing the risks of climate change and dealing with that.
Thank you. Can you hear me?
Yes, can hear you well.
Great. Well, thank you very much for the invitation to participate in this panel. Before going in detail in what the Central Bank of Chile is doing, I think we need to clarify an important concept, and it has to do with how we understand our notion of risks. So something that might be a financial crisis, right, is developing in the world right now. We're in the middle of the monetary policy report that involves doing forecasts. And when we do forecasts, we typically start with a baseline. The baseline is the most likely scenario. And then we study deviations from that scenario, typically lower probability event associated with, for the most part, with negative consequences, that we call the risk scenarios. But unfortunately, this is not the way in which we talk about climate change. I think we're misusing the concept, because we talk a lot about climate risks, but if you see the report that the IPCC put on Monday, the synthesis report that basically summarizes the sixth assessment report, they basically say that in 10 years, our baseline is that the temperature will have increased by 1.5 degrees in 10 years. So basically that's the Paris Accord. We basically did not meet the Paris Accord. That's what the report says. And it says that towards the end of the century, the temperature is gonna be between 2 and 3 degrees warmer, given our current trajectories and our current commitments. So just to kick off the discussion, my point here is that the baseline that the scientists are telling us is what we would have think 20 years ago was a pretty bad risk scenario. So I think we need to stop talking about risks and maybe change the language to impacts. What are the impacts on the baseline scenario? Those impacts are not good. They're not good given the trajectory that we are already in. And at the bank, let me just say something for something more general, and then we can dive deeper into the details. We are working hard on trying to assess both the macroeconomic and the financial risk implications of these scenarios, right, of these impacts, by what I would call a top-down approach, which is a little bit different from the bottom-up approach that is more commonly used, and I can get into the details about this later on. But essentially, it starts with scenarios, say from the IPCC or the ones considered by the NGFS, and then starts from the macroeconomic implications, working ourselves down to the level of firms, the exposure of firms to both physical risks and transition risks, and then how that maps into the condition of the financial intermediaries that provide loans to these corporations. Let me just stop there, and perhaps we can go into detail in the next round.
Yeah, thank you, Liz. I think that's a great way to kick off the discussion, and indeed we can go a little bit more into how we measure the transition versus the physical risks and what the results have been and our understanding of those. But Livia, maybe I can go to you next just to introduce yourself. I don't know if there's anything to add to what Elia said there, and what the ECB is looking at in terms of a risk assessment.
Yeah. So first of all, again, so thanks for the invite. I'm also impressed by the room and the paintings. So I find a lot of wisdom in these people in the paintings, and let's so to be equally wise or wiser maybe in the case of climate. So the ECB was already mentioned in other panels. So it has a clear strategy with a number of actions. I would say some of them are totally uncontroversial. For example, it's investing more in models, in understanding climate risk in models and so on, in data. Others might be slightly, less than controversial, which is like, it was already mentioned, tilting the bond portfolio. Actually, the Eurosystem has also two types of portfolios. There is a monetary policy portfolio and a non-monetary policy portfolio, and those follow different rules. The second one is more decentralized at the level of the national central banks. The monetary policy portfolio is more centralized, but so there are several. So I think this action is is multi-pronged and is a considerable part of our work. But I would also emphasize that there has been also a debate of it's a bit about the mandate. So whether this is allowed, or even some people say mandatory based on the European Treaty. So if you read the European Treaty carefully and with a certain interpretation, you could even argue. I personally, tend to believe that the treaty even kind of forces the central bank to at least to cooperate with the other authorities on climate, not to be the climate policymaker, of course, but to cooperate with others. As you know, the treaty says that the ECB should also support the other policies of the European Union, which is contained in Article 3 of the treaty. And Article 3 of the treaty also mentions environmental protection. So you could argue that this is even mandatory. I mean, not everybody agrees with that, but I would say is at least not inconsistent with the legal mandate. But of course, it is a fine line again. So in the range of possible actions, there are some that are totally uncontroversial. everybody would agree with it. There are some where there could be debate. Those are where probably more debate is needed. But that's what I would summarize this stage.
Yeah, no, thank you. And I think it's a good point. We all are in agreement that risk is a part of central bank's mandates, and it's very clear that climate does pose a risk, which is why I think a discussion like this is very fruitful, but also we hopefully will see some real progress in this as well. I think there has been a lot of progress. So, Satoshi, maybe over to you from the Financial Services Agency perspective and your role. How are you seeing risk, and what are you integrating into your assessments of this?
Thank you for that question, and thank you for having me today here. Well, Financial Services Agency is a supervisory body for the banks and the insurers. So we do not necessarily have a kind of reserve management as the central banks do. But in terms of our mandate, certainly the securing the soundness of the individual financial institutions and securing the financial stability of the financial system is certainly a mandate, and we view that the climate change issue is very much relevant with that mandate. And so our starting point is that the climate change is a source of financial risks, and certainly it doesn't necessarily create a new risk category, but certainly a risk driver for the market risk, credit risks, all the kind of risk that the financial institutions are exposed to. And also putting into that discussion a certain time frame angle, that creates a certain interesting question. First of all, Mr. Malkani put forward the concept of the tragedy of the prison. And that is certainly very much relevant with the financial stability discussion we are taking in terms of climate change. And if the people or the economic actors are ignorant of the climate risk, whether it's a transition risk or physical risk, then all of a sudden maybe risk perception changes, as well we witnessed for some Silicon Valley Bank or something like that. So climate change could be one of the trigger factors for the financial stability in that sense. So we need to deal with that. And also, well, in the normal practice of risk management, we tend to separate, short-term and long-term. And usually the short-term risk management practices deals with the 1 year time horizon of the risks. So in that sense, it resonates with how we design the capital adequacy ratio requirement and so on and so forth, and how we can incorporate the sort of long-term consideration into our overall risk management framework. That is a challenge. And actually, I remember that some of the panelists raised the issue of Basel IV, the new capital regulation framework. But certainly that could be an idea for action in the future, but I stop here. Thank you.
Thank you, Satoshi. And Stephen, I came to you last, mainly because you are the non-policy maker here, I guess, on the panel, and I think it'd be really interesting to hear what Sirius is doing, how you're working with the policy makers, and again, how you're seeing risk and progression that you're seeing in this space.
Sure, thank you, and thank you for hosting this, and get so many smart people in one room. So first, Sirius is a nonprofit. We do a lot of research and advocacy in this area. I guess 3 quick points. First is the investment. We have investors that are part of our network. There's over $60 trillion of assets that have made net zero commitments. They want the companies, and they're literally putting their money in their mouths. Despite the question earlier about politics, politics is not going to drive the market. The market is still moving in that area. So investors are wanting more opportunities, number one. Number two, we've done research on the banks. We took the top 24 banks operating in the US, but many of them operate in many of your jurisdictions. And we looked at using the ECB methodologies that physical risk, transition risk, looking at derivatives, there is hundreds of billions of dollars in risk for climate. Let me put it another way. There is many times more risk on the bank balance sheets today than there was in 2008 because of subprime housing, many times. So third quick question is, well, that's the big banks. Small banks while they obviously have a much smaller base, they tend to loan much more locally, and they are disproportionately risk because if there's a fire, flood, or a transition, so that the small banks, again, while the asset size is small, the disproportional, so there's risks on a variety of these, and appreciate the leadership, and all of us, Ceres included, all need to do a lot more faster.
Thank you, and an excellent, excellent point there. So I guess my first kind of question is, how can we adopt current risk models into climate? So how can we use current stress testing tools to understand our climate risk, and what are the challenges with that, and what are the progresses that have been made? Livia, maybe I can go to you first with this.
Yeah, so obviously, climate change is a slow-moving process, highly uncertain. So it's not easy to quantify in the standard term. You could call it 90 uncertainty or whatever, but it's certainly not. Not a clear distribution. So also, climate is both climate and economy are complex systems, and there is a technical definition for complex system, and they also interact. So it's a complex system squared in a sense. So that is tell you the scale of the uncertainty. So we regulatory community, but also private sector, we use scenarios as a way to obviate to this high uncertainty. So we imagine possible futures. We say that these are let's design, as the NGFS does, 6 possible futures. At least they are internally consistent. So the stories are stories. So they are not forecasts; they are stories, but they are internally consistent stories. It's like a movie where there is no, let's say, no discrepancy. So if you are watching a movie on ancient Rome, you will not like to see a watch. These are internally consistent futures, and then you can see how different variables move around these possible futures. Yeah, that's how we cope with this high uncertainty in this environment.
And we've heard a lot about the NGFS already today. So how has the NGFS supported the development of stress testing and scenario analysis understanding? Has it kind of become the benchmark? Maybe, Olivia, I'll go to you on this, and then
Yeah, so first of all, so the NGFS scenarios are they've been mentioned already, and so just also let me mention the DCB is now leading the work on the scenarios. Is part of the reason why I'm here also is to communicate on that, and also if you have also questions on the NGFS scenarios, you also encouraged to reach out to us. So we have a team following that, and there's also the secretariat in Paris. So I already kind of mentioned what the scenarios are. So the NGFS scenarios are possible futures that are internally consistent. They bring together climate scientists and economists, and the conversation not easy sometimes, because they speak different languages. So when I attend these meetings with the climate scientists, I'm always puzzled in the way they reason or they speak. But that's obvious because these are different communities. I guess there are perhaps we can go later in more detail, but there are a few key questions. So one is, so how will the transition take place? So what policies? Because up to a couple of years ago, I would say carbon taxes. Everybody was expecting a kind of global carbon tax and so on. I think especially now after IRA in the US and so on, I think the discussion has been shifted. So now there is more discussion about subsidies more than taxes. So this is a kind of a key question which also informs a little bit the scenarios as well. So we design scenarios with subsidies or carbon taxes, the key tools. That's one key question. The other, probably a couple of other key questions. One is how to model physical risk. So if you were to design a stress test now, then the current risk of a physical disaster now is probably not very influenced by climate change. Because we expect climate change to happen in 50 years, in 30 years. I mean, it's already happening, but we expect the bulk of the effects to come later. So how do we reason now if we want to stress the financial system? So do we use the current climate and the current probability of events or the future one? So that's the other probably the last key question is the short term. So the transition, the energy crisis was mentioned already earlier this morning. So how is the energy crisis making the transition more or less likely? My point there would be that the economics of it should make it easier. But the politics may make it harder. So there is a conflict between economics and politics. So what kind of short-term scenarios can develop out of this energy crisis? And this is part of the new work we are doing under the NGFS scenarios. So we are working on short-term scenarios that address a little bit this question. But perhaps, I stop here because otherwise I could speak for very long on the NGFS. It's better that I stop here. Thanks.
No, thank you. And I think we can definitely come back to some of those points as well. Elis, maybe I could bring you in here just from the Central Bank of Chile, how you've been adapting your current stress models to integrate climate, the challenges that you face with that, use of NGFS, and also whether the NGFS has kind of taken in more kind of local jurisdictional capabilities and understanding, and whether there have been challenges with that as well, whether you've adapted things yourself a little bit in terms of the NGFS scenarios.
Thanks. Well, that's a lot to unpack. So let me start with what more concrete example of what we have been doing at the bank. So there are basically two ways of going around stress testing or the assessment of climate risk, or what I would call climate impacts more generally. The first is the bottom-up approach. Essentially, that relies on asking firms, be it the non-financial corporates or banks, to do an assessment of the exposure that they have with different methodologies, and they report this assessment, and you aggregate this to some level that is appropriate for the question you want to answer. The other approach that is much more data intensive, and due to data limitations, it's not very often performed, is the top-down approach, which you start with, say, a scenario from the NGFS, for instance. You start with the macroeconomic implications, you downscale that to the sectoral level, and then you try to make an assessment of what the risks, the physical and the transition impacts from climate change are in specific firms of those sectors. So for example, in the case of Chile, with this methodology, we've identified that the main sectors exposed to climate change, not surprisingly, are agriculture, mining. It also is some important asset classes, essentially residential and commercial properties that are exposed in coastal areas, also sort of jump as a yellow or red flags in some cases. I think it's important for me, that's the ideal approach, right? Because it has the main advantage of being a common metric that doesn't rely on self-reporting, and therefore is, I think, robust to some incentive issues that appear when you just rely on data that firms self-report. But it does require a lot of data, and it does require a lot of working modeling. So probably the ideal situation would be to have both approaches, right? So what firms or bank reports, and you can contrast that with the analysis, with independent analysis that you perform yourself, say as regulators or as a central bank, and then you have something to contrast what the risk assessment that you're getting from the self-reporting side. Let me just very quickly say a few words about the NGFS. So we are also part of the NGFS, quite active actually. I myself am now part of this monetary policy group, in particular the model and analytical approaches subgroup. And what I can say about the work of the NGFS first is that it has been hugely influential and very useful. As was said here before, there are basically self-contained, internally consistent scenarios. And I think that's a very good starting point. But that's important to understand that they are starting points. They are not the definite answer for a specific country. I don't think they're meant to be, right? They are a useful guide so the countries can say, okay, this is a way to start. These are models that I can get started. But in the end, there's no substitution for doing your own homework, given the realities of particular jurisdictions. And just to finish up, the other thing that I would say about the NGFS, which is also a disclaimer that the reports of the NGFS, they make it quite plain. There are some things, important things, that are not included in the models that are used, and therefore do not show up as climate impacts, but they are nonetheless very important. The main one is that the physical impacts of climate change are probably underestimated. And they are underestimated because it typically uses linear effects. And we know that the effects of climate, especially when you start, deteriorating ecosystems, start to become nonlinear, and you can even cross tipping points. And those are very hard to model and therefore are not modeled there. But like I said, the authors of these reports are very open about this. They give this as a disclaimer. And this actually shows up. I mean, when you do your analysis at the country level, you are really pressed on finding large effects. Like I take a drought that lasts 5 or 10 years in the central region of Chile, sure, it'll show some effects on some regions, but in general, given that we're estimating these models with the last 40 years of data, the effects are not that large. And I think the reason is that we have been living in sort of the linear part of the effects, and now we are shifting, actually quite fast, I would say, into the non-linear part. And that's an important challenge, because when we are predicting the future, the next 5, 10, 20 years, I think we need to do a better job in trying to calibrate the non-linear part of the effects. And that for sure is going to amplify the impacts of any scenario that we input into these models. Let me just stop here.
Maybe a big question, but how do we factor that in? How do we adapt to those changes and to the bigger shocks that are seemingly coming? That was for you, Elias. Sorry, not letting you go yet.
Well, so that's a good question, and let me tell you something that we're trying. So what you could try is to use like extreme events, right? So there are many climate events, like the average event that, as I was saying, doesn't have, in the last 40 years, doesn't have a big impact. But then you can find some extreme events that in some particular, grids of the country have actually been quite strong. And if you take that subsample of very extreme events and estimate reactions and the effect on ecosystems and on economic activity, for instance, on the firms that are located in those specific regions, then you can get closer to effects that look a little bit more nonlinear. And our preliminary results are actually giving us, of course, stronger effects in that regard. And we are struggling on how to use these sort of parameters to calibrate a more general effect that we could expect at the economy-wide level going into the future as we start hitting these non-linearities.
Thank you. Satoshi, do you have anything to add to this and the use of the NGFS as a model and how you've integrated that at FSA?
Sure. Certainly the NGFS scenarios have been very instrumental in harmonizing our work among the many supervisors and regulators and central banks in attempting to stress test banking banks and insurers in terms of climate change. And well, when it comes to the issue of risk modeling, in a simple term, conceptually, in order to assess the transition risks, we changed certain parameters around the carbon price. And we build a certain path of carbon price scenarios, provide a path for that carbon price. Carbon price is a kind of expression of the certain strengths of the climate-related regulation, not only including a certain real carbon price, and that certainly helps. And also in terms of assessing physical risks, the information provided by NGFS scenarios are very much instrumental, although, we would like to, if you are to quantify the physical risks, we would like to have a certain model that that connects between temperature rise and then how weather system would change and how that will create a risk of natural disasters or sea level rise and so on and so forth. But unfortunately, we don't have that kind of a comprehensive risk model for physical risk. So we need to feed very specific individual information on the physical risks into the risk modeling. So while NGFS scenarios are very helpful framework for designing our stress testing exercise, but there are still many gaps to be filled in the future. And also, as Elias mentioned, in terms of physical risks, we do not necessarily incorporate certain non-linear risks into our models. So that is certainly a challenge. But without those elements, with the stress testing exercise using those NGFS scenarios, we can have a certain sense of the overall magnitude of the potential risks to the financial system as a whole and also financial institutions. So while there are many things we must work on still, but NGFS scenarios are very helpful too, I would say. Thank you.
Yeah, no, good, thank you. Stephen, from Siri's perspective, kind of what developments have you seen from a stress testing or a climate stress testing perspective, methodologies that have been used and the results that you've seen, and how are you supporting those developments as well?
Yeah, I think, and climate stress testing, we have to look clearly a longer time frame than others. And some, again, here are doing it very well. Some, there's still more work to do in that area. We also have to make sure that we're not looking separately at physical risks and transition risk. I mean, as in around the world, in the US, in one day last summer, we were having supply chain disruptions because of the pandemic. We were having Hurricane Ian on the East Coast with about $80 billion of economic loss, and droughts on the West Coast. So we were having physical risk, transition risk, all at the same time. And we had the risk of getting to the Minsky moment of kind of 1 + 1 = 1,000 or 100,000, whatever. So those are two of the ways. And to make sure it's transparent, to have, so that, you know, there's literally in the newspaper today and yesterday, there are questions of what did we know and when did we know it? If you think about what's happening now, at some point, we don't want those questions to be asked about what did we as NGOs or bankers or insurers or central bankers know about those climate risks. So the more it can be transparent is critical.
Yeah, no, absolutely. David, maybe I can go to you now, just in terms of what the Netherlands Bank is doing. I think you have an interesting perspective as you've done an internal stress test on the central bank and its activities. What were the results from that? Yeah, what were the challenges and what methodologies did you use to kind of conduct that internal stress test?
So many things to reflect on, and I think I agree also with many things that have been said in terms of the complexities and the challenges and the underlying uncertainty and the fact that indeed it's about transition and physical. So it's quite a broad set of challenges that we have, and we haven't even talked about data yet. So that's going to probably going to come on top of that. So. With that in mind, I think when I think of the different exercises that we've done at the DNB, and I sort of reflect a little bit on that and step back. So we've done, let's say, 2 or 3 sort of exercises where we looked at different aspects of climate change. And I think if anything, I think that we, at a certain point, at the start of each exercise, we have sort of this notion of how to say it, let's have the perfect be the enemy of the good, something along those lines, in the sense that this is challenging, this is complex. We need to start from climate science, we need to start from different kinds of projections that stretch out way into the future. We need to think about the way this is going to land in the real economy. We have to think about how this is going to land at the institutions at the end of the day. And then we get, perhaps ideally at a certain point, at sort of the question, what is the effect on, well, financial stability? So I think, if anything, what we I think in all of those exercises have done is also, let's say, think very clearly about the scoping of the exercise, and perhaps not always start from the very big picture question. Okay, climate change in the broad sense, but try and narrow it down sometimes a little bit. To give one example, to make it, let's say, a bit concrete, is we have some ongoing work on flood risk, which is, coming from the Netherlands, one of the top-of-mind physical risks that you think about in the context of climate change. And there again, you can sort of start all the way at the beginning of this whole chain of events where you look at flood maps and think about probabilities. And the good news is that in the Netherlands there's good flood defense in place. So as Livio was already alluding to, from the present day perspective, that looks, let's say, pretty reassuring for the moment. But I think what we also do, in addition to the scoping, is that we always try to look for, let's say, our comparative advantage. So the risk modeling as we have it, the data as we have it, how can we leverage that to speak to, let's say, the question as we have it? So do we have, let's say, information on exposures that financial institutions would have to flood events? How can we look at that data? How can we incorporate flood specificities into the risk modeling? We know a little bit about how to do risk modeling, but how can we then incorporate the notion that there can be a flood event? Well, then you need to think about the damage that would mean to the collateral, and that would mean that you have to think about the impact on credit risk parameters, and then you get going a little bit, and then at least from that little part of the problem, you sort of begin to get a little bit the sense that we begin to understand a little bit. Now, that still means that there is a lot to discuss, because then, of course, you still need to think about the first bits of that analytical framework. What is actually the flood map that you want to focus on? What type of return frequencies do you want to have in mind there? And so there's still lots of conversations to have. But I would argue that let's say, once you've started from your own comparative advantage, you have something on the table. I already alluded to the fact that quantification helps you to make it as concrete as possible. Then you can further engage with, let's say, stakeholders and discuss in terms of, this was, let's say, the bit of modeling that we were able to do. Let's sort of look at that and further the conversation. Now, to round that off, then in the Dutch context, you start meeting lots of interesting engineers who have lots of ideas about how to do flood risk modeling, and then I think you're in a good place. So that as a very concrete example. So I think when I think about this very complex set of issues, I would sort of think that sometimes indeed the scoping is important, and also leveraging on your own comparative advantage. That's, I think, two things that I would sort of bring to the table from our own experience at DNB.
No, thank you very much. Livio, the ECB has done, correct me if I'm wrong, but I think the biggest stress testing exercise so far, the economy-wide stress test that you conducted last year. Could you tell me a little bit about that exercise, some of the results, the process that you went through, and yeah, your kind of takeaways from doing that exercise?
Yeah, so the so-called economy-wide stress test is a top-down exercise. So the stress test can be of two types. It's top-down, where you say, okay, this is going to happen, and then I model how the banks will react to the balance sheet. The bottom-up is when you ask the banks, what will, I give you the scenario, but then you tell me what would happen in your own bank. So the big challenge in this exercise was to find good data on firms, in particular on emissions and climate-related variables for firms. So there was a huge effort for that. Now, by the way, the new vintage of that is going to be released in about a month from now. So there is a new version of it, and I think there are also, what is also interesting, there are also new scenarios. And part is also related to the discussion we were having before. So there is a scenario which is called wake-up call. So that essentially, we still go to the Paris objective, but we rush it later. So for a few years we do nothing, and then we all rush to comply with the Paris target. Or there is also a scenario where this is further delayed and we don't get to. So it's delayed, plus it doesn't go into the direction of Paris targets.
So does that go beyond a disorderly transition?
Yeah, it's not really disorderly. It's a bit of midway. So it's not a hot house world, the NGFS scenarios, but it's something a bit in the middle, but it's delayed. No? And so all this, impacts the firms. But one important aspect we are also looking at a new vintage of stress test is what happens to investment. Because all this transition requires, a big investment in the end in renewables. Who does this investment and respond to what incentives? And that's a big question. And I think these stress tests don't really answer that question. So because in the end, I think it was mentioned this morning by Clara, but somebody, I don't remember. So it was mentioned that at the end of the day, we need to change the way we produce energy. And, this has to happen. It's a big shift. And and so it's not clear, it's part of the stress to the system also. So how do we model it? What incentives do they? I just wanted to say quickly a word about physical risk, because I think Elias and others mentioned the fact that the physical risk can be non-linear. So this is not completely forgotten in the NGFS scenario. So if you look at the NGFS scenarios, very closely, you will see that in the most pessimistic scenarios, we take some higher moment, so some worse moment distribution, to take into account a little bit this idea that there are these possible nonlinearities. So it's not just to say that I don't think that the NGFS scenarios completely kind of capture this nonlinearity, but it's also not completely forgotten. So there is some of it in parts of the scenarios. I just want to clarify that.
No, thank you. And perhaps in a second we can go a little bit more into understanding transition risks more specifically. I think we talked a bit about physical already. It'd be good to go a bit more into transition. But Stephen, maybe going to lean on you as hopefully being connected with the FRB, but we've seen that they're now developing their own stress testing model, seemingly trying to start to integrate that into what they're doing. Are you able to tell us a little bit about what that's going to look like? I assume it's in the very early stages, but are you able to give us a little bit of insight into that and into what they're thinking?
Sure. So obviously I don't speak for them, but so there's two models. First, in January they issued draft rules for the 6 largest banks. And to put those in perspective, in 2008, the 4 largest banks were considered too big to fail. They managed $4.8 trillion of assets. Those 4 banks today have $9 trillion. So it's an enormous part of the economy. And those will be issued in July. We think those are a good first step, but it's only a first step. Again, they don't go far enough. They don't integrate physical and transition. There are a number of shortcomings, but it's a good first step. Second thing is the 3 banking regulators, the Federal Reserve, the FDIC, and the Controller of the Currency are doing joint guidance that they hope to issue in the next few months for the banks that are 100 billion or more. So that's about 30 banks. And those will go a step further. Just a piece of data, just relating to the question of floods earlier. In the United States, the flood maps, if you look at the flood maps, more than half the people in flood areas are not counted in the flood maps. So that it's important in terms of the data. We just did a report on flooding, and there are a variety of recommendations from parametric insurance to microinsurance and other things that can be looked at as well as part of those solutions.
So is that because of lack of data that they're not factored into that?
It's lack of data, and when they were done, the curve was here, and now, unfortunately, just in the United States alone, last year we had $165 billion of economic loss. That number, when the maps were done, was much smaller. In some states, and it's not just the coastal areas, there are 2 states where we did an analysis where they had more flooding from rivers than they did from coastal. So it's not just around the coast, it is where the rivers and streams as well.
Thank you. Olivia, I believe the ECB has been working a little bit with the FRB on their developments as well. Have you got anything to add to what Stephen has said?
You mean the floods or what?
In terms of the stress testing that they're developing, the models that they're developing in the States.
Yeah. No, by the way, there's not only one model. There are many. Yeah, exactly. So there are many different models. Also, as I said, different types of stress tests. Also, both bottom up and top down. So it's.
Sure.
But I mean, so in the supervisory one, which was more bottom up, in terms of physical risk, we consider a drought in Southern Europe and floods in Northern Europe. I mean, when we think about physical risk in Europe, we always think of this binary. So the south as a drought and the north as floods. That's always a bit the template.
Yeah, sure. No, good. So I'd like to turn now a little bit more into our understanding of transition risks and how we can map our credit risk and understand our kind of the risk on our asset classes. Satoshi, maybe I can go to you to go a little bit into that and maybe some of the results that you're seeing.
Certainly. That in Japan, there's certainly certain manufacturing sectors are very important industries in Japan, and for example, automobile industry and some certain chemical industry and certain steel industries. And so, we did a certain analysis on how the change of the carbon price would affect the credit worthiness of those companies in those industries through our stress testing exercises using the NGFS scenarios. it certainly exposes certain data gaps because at the end of the day, for example, for the automobile sector, how the individual company adapt a decarbonization strategy is important. Well, certainly electrification is a solution, but well, certain company prefers a certain hydrogen or maybe biofuels or so on. So it is sometimes difficult to assess the credibility of the claim they make in terms of how they decarbonize their operations. But well, we use a certain information from the IEA scenarios or so on and so forth, we come to the certain numbers for analyzing that. Well, we haven't found any, well, you know, from this financial stability perspective, we haven't found some concerning results. If you look at the numbers, well, if we adapt the potential losses that may incur in 1 year, that is maybe small, but it adds up to the 2050 or 2100, then that number becomes big, and it's a judgment call how we should assess the results. In terms of the number for 1 year, we can say that the banks can reasonably absorb that kind of level of losses with the profits. But given that the uncertainty around the associated with stress testing exercise, how we can tweak that the number we get from the stress testing exercise to assess the real impact. All those things are really challenging tasks for us. So I would say certainly NGFS scenario helped us to design the stress testing exercise, but we need more data for analyzing the conducting stress testing exercise, but also for analyzing the end results we get from the stress testing exercise. So I cannot say that with confidence that what number we get is a certain indicator for the future action, but we get a sense, and certainly we identify the areas of improvement in terms of how to design the stress testing, and also where we should get more data from. So.
Yeah, no, thank you. David, do you have anything to add to this in terms of mapping our transition risk, understanding the impact on our credit and our assets and portfolios?
I think previously I sort of argued to sometimes simplify a little bit. Now I think I'm sort of going to go perhaps a little bit in the other direction, if I may, because I think transition is sort of a broad concept, but I also think it's good to think a little bit about what we sort of have in mind there. And perhaps the first point that I can make is that when we sort of started at DNB, the thinking was very much thinking about things like climate policy, technology, so very much related to climate change itself. Perhaps I can just note that I also see a little bit of a broadening out of the discussion there to let's say, broader nature-related losses and complexity there. We had, I think, a previous OMFIF event in Amsterdam not so long ago on biodiversity. So there, at least, I think it's important also to think a little bit about what we have in mind here. And I think the next panel is also going to address that. Secondly, and again, here I'm sort of broadening out a little bit. I think one thing perhaps that I haven't heard so much is also the sort of the cross-sectoral perspective. So let's say we've talked, I think, a lot about banks, but at least some of the work that we've done in the Netherlands is also very much from a cross-sectoral perspective, also because that is, I think, very natural for us when we think about financial stability. So the transition work that we did and that we, I think, published in 2018, if I remember correctly, was very much focusing on banks, but also pension funds and insurers, sort of from the idea that this could be sort of common types of shocks that could hit all of these institutions at the same time, but in different ways. So for banks, indeed, credit risk. For perhaps some of the institutional investors more sort of market risk. Coming back to the discussion on the NGFS, I think that was a time when the NGFS scenarios were still very much under development, but I think the thing that we did there in 2018 would sort of chime very well with, I think, what is now reflected in the NGFS scenario. So we very much focused on things like climate policy shocks, carbon pricing, technology shocks, and again, then basically try to work through the models, as I said before, trying to reason from the shocks in a stress test setting. So assuming, let's say, a very severe but plausible shock does occur, so really sort of asking this type of what-if question, how is this going to land in the economy and how is it going to reach the portfolio of the individual institution? I could talk about this for hours, but we have papers available for people who want to see the details.
No, thank you. Maybe we can share that with the audience afterwards. I'm conscious on time, so maybe I'll ask one more question on data and how we can kind of close the data gap and essentially integrate data to use forward-looking metrics and kind of understand our projections. Stephen, maybe I can go to you on that. And then if we have any audience questions, please do raise your hand and we'll come to you.
Yeah, clearly, as was said a few times, we, don't have all the data, but I think, as our colleague said, we can't let the perfect get in the way of the good. So part of it is do as much as we can, and NGFS has done a great job, ECB and many others, and then learn from each other as part of that, because Mother Nature isn't waiting for us to have good data. I mean, as we learned, we didn't have good data on this other nature-based crisis called the pandemic, and we faced dramatic supply chain risks, and at the same time physical risks. So we have to invest in data. There are several countries here that already have, for example, climate disclosure from companies. We hope in the next few months the SEC will require it in the US as a piece of it, but then sharing the brilliant work of the many smart minds in this room.
Lovely, thank you. Marcus, I saw you had a question.
Okay, thank you. So again, Marcus Ingholt, Danish Central Bank. My question is on second order effects, not tipping points, but second order effects in stress tests and scenario analysis, whether they are captured, and if not, if you're doing anything to capture them. So my thinking is that these scenario analysis quite well right now illustrate first order effects of climate change and of the same green transition. But there may be second order effects that are much more disruptive but that are not being captured. So as an example, initially Europe's energy transition away from, say, German or UK coal into Russian gas, that was very cheap. That didn't do anything because, you know, the Russian gas just came there. Right from Putin. But then there was a big geopolitical shock in the beginning of 2020, or 2022, sorry. And then suddenly we didn't have this anymore. So it wasn't as such a direct climate shock, a direct transition shock that caused the high inflation we have right now, but it was a geopolitical shock, but a transition beforehand that created some circumstances where this geopolitical shock got much larger effects than it would otherwise have had. So if this is something that's being looked into. Thanks.
Thank you. Was that directed to anyone in particular, or?
Well, the stress testing building institutions.
Elias, sorry, didn't see the little hand. Please.
Oh, it works? Great.
It works. It's very small.
Can I take that question?
We can hear you. Yeah, no, please answer. Please.
So I think you meant second round effects, right? I mean, that are quantitatively important but are not direct effects.
No, I meant indirect. Second order effects. Not second. I mean, so a second round effect. I would say that as, you know, something coming back. But while this is a second order effects, there's some, you know, where you are in the economic system, the energy mix you have beforehand. That determines the effect of, there's some state dependency, that's what I'm meaning. Yeah.
Oh, I see. So, I'm sorry, I had a different interpretation of your question, but I think it could be interesting anyway. You mentioned geopolitical risks in your question. I think this is something that it's fair to say is not present in pretty much any of the analysis, because it's very hard to model. So one that sort of haunts me, and I like to think about this, but I'm not sure how we could model it. It has to do with the effects of climate change on migration, and what that affects, the impacts that can have on geopolitics, on political polarization in countries. So if you look at history, I mean, all of the important climate changes that we've experienced have been associated with mass migration. And actually, this is very well documented, that the indirect effect of migration tends to be much larger than the direct effect of the climate change that produced the migration in the first place. And this is something that, I mean, some people are aware, but it's really hard to model. But I'm afraid that we might be missing the most important part. And for that, I think we need to, get people from different disciplines talking to each other and perhaps working on a joint effort to try to start getting these other aspects into the discussion, because they might be actually quantitatively more important than the direct effects that we are more aware of.
Thank you. Yeah.
So another comment I would have in this context is that so we know that there is a huge literature saying essentially that so producing commodities, has a political effects on the political system. So countries producing commodities tend to have worse institutions and tend to have also a worse distribution of income. And there is a very solid literature on that. So I think the hope is, related to what you were saying, the hope is that a transition to renewables would also change the production and shift the production more towards democracies, towards countries with better institutions and with less predatory system. Unless this is also prevented from the availability of metals such as lithium or so that could be the weak point of that. But in theory, the production of renewables can be done in democracies, so not only is fossil fuel produced in autocracies, but it's more than that. So it's the production itself that leads to autocracies. And so this becomes a vicious circle. So this geopolitical link is very important. I think I agree, is a bit underestimated.
Yeah, no, thank you. I think we had a question over there.
Hi, this is Mark Cliff from the London Institute of Banking and Finance. I'd just like to follow up on this point, because I think there's, if you like, the legacy of traditional risk management hanging over this whole discussion, which is that you have to start from the perspective of having data and models, and yet the whole point of doing a scenario is to cope with situations where you don't have either the data or a model, and geopolitics is clearly a prime example of that. The other thing is the NGFS scenarios are long-term systemic scenarios looking out to 2050 on alternative warming pathways, but actually right now financial institutions are making transition plans to hit interim targets in 2030. So global warming isn't a risk, it's a certainty. That's what the scientists are saying. The risks are extreme weather and transition risks, and in particular market risk. We have these ludicrous estimates, frankly, of minimal credit losses in 2050, and yet we've just gone through the most extreme period of volatility that the world has seen for decades, and this is completely lost on the NGFS scenario. So I'd be really interested to hear what exactly the NGF is going to do about its plans to produce short-term scenarios, which hopefully will include some of this kind of volatility.
Who would like to react to that?
So I fully agree with you that that's precisely the plan. Of course, these are also very difficult phenomena to capture. So I would like also not to warn against kind of expecting too much from this work. It's not that we will be able to model climate change, economy, and geopolitics jointly. But certainly this will be part of the new vintage, and so we are working at that. We are thinking about this, and as I said before, it's not clear to me personally, what is even the sign of this relationship. So if more energy market volatility, is it good or bad for a faster transition? So even the kind of the sign of the derivative is not fully clear to me, but we can think of scenarios where the sign is positive or negative. So whether it's shifted to a quicker transition or less quick transition. So the answer would be, so yes, it's part of the plan, but don't over expect what we can deliver on that.
Thank you. We're over time, so maybe we'll just do very quick kind of summing up remarks. Satoshi, maybe I can go to you just for final 30 second or less final remarks.
Well, thank you. Well, in short, well, certainly scenario exercise, scenario analysis or stress testing exercise is a way to assess the future risks. And certainly, we always complain about the data gaps. But certainly, I think even the current NGFS scenario provides a reasonably sufficient data for making a certain judgment call based upon the results. And so, I think with admitting certain uncertainty around the results of the analysis, but still we can build on our judgment on that basis. That's, I believe that the central banks and many financial supervisors around the globe are getting towards in the future.
Amazing, thank you. And Stephen, final remarks from you?
We've talked a lot about the risks. I guess two quick things. First, we can't overemphasize the urgency needed. And second is we can't ignore the opportunity. As we look at the transition, it's been projected there'll be trillions of dollars needed every year in new investment. Those are transition opportunities and risks as we think about these formulas.
Wonderful, thank you. David, final remarks from you?
I was sort of listening to the questions also, and I think what I hear there is at least remaining a bit of openness and flexibility. I think for the unknowns, and I think I can only agree with that. I think as I started, it's good that in some cases we've managed to make a transition from things that we wanted to understand better to quantification. But I think we should indeed always remain open to, let's say, new risks popping up and then basically going through a new cycle, I suppose.
Thank you. Elias, final remarks from you.
So I think that there's a lot of progress to be made in the technical part, if you want, in how we conduct scenarios. But we should not underestimate that perhaps the main area that we need to advance is in communicating these scenarios to the regular, to the public. Because I feel that we are doing a terrible job in underselling how serious this is. Because pretty much the analysis we make stays in this kind of symposium, or these discussions, and people in the street, they have no idea. They know that there's something potentially bad going on, but they don't really know the magnitudes. And I think we need to work a lot harder in bringing, our best forecasts, our best analysis into communication outlets that can do the job in putting these things in the mind of people. Whether, by a short report, a movie, I don't know, something that works. But if you ask anybody in the street today about climate change, what are the expected scenarios, people don't have a clue. I think that we need to do better in this regard.
Thank you. I think that's a really excellent point, and a question I did want to ask, but we didn't really have time, unfortunately. Olivia, any final quick remarks from you?
I mean, on the idea of the movie, we are in the NGFS team. We're also thinking of releasing a YouTube video explaining easily what the scenarios are. So hopefully this kind of goes a bit in the direction that Elias mentioned to have something there. Also because the new generation, they don't really read. Our kids, they watch videos and they listen to podcasts. So we need to change the way we communicate if you want to reach them.
Wonderful, thank you. And thank you so much to my wonderful panelists today. I'm now going to pass on to my colleague Ellie Groves, who will be talking about nature risk, moving on to nature. So thank you again, everybody. Really appreciate it.
Yes, thank you. You're both already making your way up, so thank you very much for that. Thank you. And we are starting a little later, but I will still aim to end on time so everyone can have a lunch break and discuss the really important and challenging topics that we've covered this morning. I'm really pleased to be moving on to the sort of the second phase of the day, as it has been described in our programs, to really look at the disclosure frameworks that we can be putting forward. I think it builds on that excellent session that we've just had about how do we communicate what the institutions, central banks, but also private institutions are doing to really push forward the climate-related exposures that they are climate-related responses to the exposure, and we're to be tackling here today. So I'm very pleased that we have Jean Boisnat, who is the head of the Secretariat for Networking for Greening the Financial System. The NGFS, I'm going to use that acronym from now on. We used it in the last session, so I'm very pleased to do that. We also have Karen Ellis here from WWF, the chief economist. So pleased to be talking about the responses to climate that we've seen, but also one of the things is that we can delve into is actually looking at the supply chains that we're doing, especially if we're talking around technological innovations. What implications does that have for the environment of the globe? And then we also have Judson Berkeley, who appears like magic in front of us from the Task Force on Nature-Related Financial Disclosures. So perfectly pleased to have you all here. Thank you so much. I'm Ellie Groves from OMFIF, and I'm going to start with you, Jean. First of all, to ask if you're going to be doing a TikTok or just a YouTube for this, maybe a TikTok on biodiversity, and then also ask your perspectives on the importance of having a consistent way of thinking about nature-related risks, and a little bit on what the NGFS is doing around this topic.
Thank you, Ellie, and thank you for having me today. So no TikTok planned yet, but there are people thinking about the NGFS communication, and I don't know whether they will have some strange ideas. Anyway, I think we are into strange ideas or at least disruptive ideas in the NGFS. Maybe just a word. I mean, you mentioned biodiversity, and for the NGFS, it has in fact been quite I would say a journey to understand. So we called ourselves at the very beginning, 5 years ago, more than 5 years ago now, the Network for Greening the Financial System. It was not the Network for Central Bank Climate Action, and that meant something from the beginning. So there was an intuition, I think, at the very beginning of the network around these questions, but it was quite clear that climate is already quite a piece to address and to do it well. So we postpone basically looking beyond climate to a later moment. What we have been facing is in fact a combination of evidence mounting that there is a need for looking beyond climate or looking at the other aspects of climate. There is this nature-climate nexus, which is an important one. There is also ongoing work that was undertaken in the NGFS. I mean, we have done basically the due diligence of is there some kind of material risk that would force us or lead us to look into these questions. And I also should insist that there was, I think, the gut feeling of the members, and I can remember a discussion with the deputy governor of a country, in a central bank operating in a country in the tropical regions, basically telling us we see climate change coming at us quite fast, but honestly we also see nature-related things coming at us even faster, and that we need to get ready for it. So that's this combination that basically led the network to say, okay, now we need to look into that, and the first thing was really to try to build a common understanding of that, because to be completely honest, climate, it took a while for us to speak the same language. Nature and biodiversity, each and every one of us, because we sit in some kind of specific places and so on, we have a completely different approach to it, and it's quite clear that if we want to be effective, we need to have this kind of common representation of what the problem is and how to look at it. And that's how the work of the NGFS has started, basically trying to build that common understanding, make sure that we don't have a discussion that misses its goal, and that we don't misunderstand ourselves, in order to be able to then take into account what needs to be taken into account in supervision, in financial stability monitoring, monetary policy, and so on and so forth.
Thank you. Thank you very much. We will touch on some of those issues in a little bit as well, but Karen, I want to come to you. Could you outline how you define integrating biodiversity? So I'm just asking Karen to define how to explain how they define integrating biodiversity, and also the key challenges that you see for the financial system. But I know you've done some works on the role of central banks in addressing this. So I kind of want to tell the story about the central banks, and then we will also touch on how other stakeholders and are integrating nature into transition frameworks. But let's start with the central banks as well.
Okay, thank you very much, and thank you for the opportunity today. Just to start by saying, we have done films for TikTok and many other kinds of films. If you've seen our film, Our Planet Too Big to Fail, that's about the impact of the financial system on nature loss and climate change, and what it can do to solve that. And if you're watching Wild Isles on Sunday evenings in the UK at the moment, that's a film that we were part of producing as well with David Attenborough, that really looks at nature's impact on us and the costs of nature loss. So we're doing our best to educate the public on these important issues and to get everybody behind the action that's really needed on this. So, sorry to answer, that was a little bit of a plug there.
No, I'm pleased. Excellent.
To answer your question and to build on what's already been said, and it's great that the NGFS and also the Coalition of Finance Ministers for Climate Action have both published reports in recent times setting out the importance of nature loss as a risk to our economy and to our financial system and financial stability. So that's gaining wider recognition now globally, including in mainstream financial circles. And the point is now landing that financial regulators and finance ministries need to be taking a lot more action to address this risk, which, as you said, is equally important and urgent, actually, as climate change. And very interlinked with climate change, I would say, as well. So this comes to your integration point. We know that we cannot achieve net zero without tackling nature loss. The scientists, the IPBES and IPCC reports that came out last year pointed out that at least a quarter of carbon emissions are associated with nature loss, particularly deforestation and land use change, often associated with the food and agriculture sector. Also, nature can provide up to a third of the emissions reductions that we need to see going forward. So both nature is a big part of the problem in terms of nature loss, and a big part of the solution. And given the strong interactions between climate and nature outcomes, it's very important to think about these two issues together. And the science is beginning to give us some pointers about how to do that. So we've been arguing that nature should be integrated into the fast emerging net zero policy and regulatory framework. Doesn't make sense to look at climate and nature separately. So let's start to try and integrate nature into that thinking at the same time. I can say a bit more later perhaps about our work on transition plans. We're part of the UK government's transition plan task force on how to integrate nature into transition plans, so we can talk a bit more about that. Also just to note that the UK government and many other governments signed up to the Convention on Biological Diversity's Global Biodiversity Framework last year, December last year, which commits all of those countries to tackling nature loss, to reversing it, restoring nature, and aligning the financial sector to that goal. So many countries are now signed up to doing that, and yet we're only very much at first stages of actually working out how to do that. So it's good that central banks are beginning to address this issue, and I think some of the things we would love to see central banks doing on that are really assessing the vulnerabilities of the financial sector to nature loss as well, and trying to integrate that into these scenarios that are being developed on climate change that we've been hearing so much about, but also then setting expectations of financial institutions around their own management of these risks and assessment of these risks, drawing on tools like the Task Force for Nature-Related Financial Disclosures, emerging framework that will help financial institutions to assess those risks as well, and then beginning to actually align both their regulations and their asset management to those goals, net zero, and it will become nature positive, I'm sure, in due course. But I'll stop there for now, thank you.
Thank you very much. And I want to come to you, Judson, now to talk about how the financial sector as a whole is currently thinking about nature risks. So what are the key opportunities associated with this as well? And how is you seen the thinking evolve?
First, thank you to UMFIF for organizing these excellent sessions. Apologies that I'm not able to be there in person. There are probably two reasons. One, we're in the final throes of finalizing our TNFD release, which is due the end of this month. But also, my day job actually is with UBS, and it's certainly been quite an eventful set of days here in Switzerland in the financial sector. So I do appreciate the chance to still participate virtually. I think there have been some great points made so far in the last session and this one, and I do think in a lot of ways nature is following a climate playbook as we try and talk a little bit internally here at UBS. And certainly we can learn from some of the activities there and ultimately how to probably accelerate some of our work faster and focus it to be more effective. Certainly there is disclosure, and that's what I've been involved with most directly on the TNFD work, and certainly that is almost a precondition at times to get some of the basic information out into the public domain to really then facilitate the risk analysis. And certainly that analysis is key to understanding where exposures lie, where sensitivities lie. But ultimately, it does come down to the transition activity. So we just heard the transition planning mentioned. So I do think target setting and transition planning will become equally critical. And the sooner we can bring that into the discussion and have a good balance between the risk analysis and the transition planning, I think that will be to great benefit. I think it's one of the learnings perhaps learned from climate is we've spent lots and lots of energy into risk analysis, and we heard in the past sessions some of the limitations around that, but ultimately it's about the action, and that comes from the transition and target setting. So I do see that as a very critical pillar of what we need to do going forward. But I'm happy to expand a bit later on where the task force is and to talk a bit more about the financial sector as well.
Thank you so much. I want to come back to you immediately, actually, Justin, to talk about some positive concrete examples of how organizations have successfully integrated the TNFD framework into their financial disclosures. So actually get some concrete examples I think would be really helpful, because I think that sometimes with these discussions, and while they're excellent, we talk around that kind of top level, what would be nice, what needs to happen. And I really think that we should be delving into what has been success and what does success look like and how can we all learn from each other.
Yeah, well, first I guess I have to caution you, the TNFD framework isn't there yet. Yeah. It's been coming out in draft versions. I mean, as I said, we'll have the version 0.4 at the end of this month. The final version is due in September of this year. But certainly I think there's a lot there to build on. And this idea of integration of the climate and nature focused disclosure is absolutely critical. That's been the positioning of the TNFD from the beginning, and one thing we see as a key element of making it successful and having a broad uptake. I don't think financial institutions are building from zero by any means. I think a lot of financial institutions have been considering broader nature topics beyond climate for many years. A lot of banks and other asset managers as well have had engagement policies around issues like their activity with, say, the forestry sector or with issues like palm oil. So it's certainly not a start from zero sort of situation. But there is clearly a step change needed here to really understand some of the critical issues within sectors more deeply, to try and quantify where possible, to try and build off of the public policy objectives that now are clearly in place through the Convention on Biological Diversity and the Global Biodiversity Framework that was agreed in Montreal last year. So what firms I think are trying to do is particularly in the financial sector, starting from what has worked a bit on climate to date. So at some level, you're starting with basic heat maps to try and identify potential sensitivities or hotspots within broad portfolios. There's some key tools that everyone has gravitated to because they do capture some of the best understanding from the scientific community on this. Things like ENCORE, things like IBAT, things like the work done by the Science Based Target Network. In the financial sector, we don't necessarily have the deep expertise in biodiversity and in nature-related topics, so we need to work with, in a collaborative way, the scientific experts. But certainly heat mapping has been one tool. I don't want to promote UBS too much, but we did try to publish the first version of a nature risk heat map along with our climate risk heat maps in our most recent sustainability reporting for our balance sheet exposures only. Some other firms have done something similar. The Spanish bank BBVA in their reporting also published something. One of the best examples, honestly, I've probably seen, and it shows that maybe not all the good ideas reside in one place comes from a bank in Taiwan, Esun Financial, which actually had a very well-developed impact and dependency-based heat map. And I think those heat maps are great starting points. It gives you your place to focus, but ultimately it is a bit of a drill in. And as we've seen on climate, it's about also some level of just having bottoms-up understanding to start to differentiate within sectors, company A from company B, whether that's for investing, whether that's for lending, and really starting to understand more deeply of their sensitivities based on their impacts and dependencies. And the critical aspect when it comes to nature, obviously, is their locations. Locations of their direct operations, locations of their value chains. And that's really going to be one of the bigger challenges around thinking through the nature topic as opposed to the climate topic. You don't have that fungible CO2 emission number, doesn't matter where it's emitted, it has the same impacts. Obviously with nature, the local specifics really do matter.
Thank you. And actually, I want to pick that up with Karen on around the implications of when we're looking at integrating nature-based risk into these disclosure frameworks, actually the complicated reality of the fact that this is actually covering a lot along, especially in our long supply chains. And I think that is a really interesting thing to start to explore, and the responsibility that the biodiversity and then this disclosure, where that responsibility sits along that supply chain. So kind of the work that WWF is looking at with this.
Yeah, okay, thank you. I think just to build on what was just being said, there is already a lot of work within many companies and financial institutions on nature-related policies and targets. So it's not that behind on that level. It's not very integrated in climate for the most part yet, so hopefully that can happen increasingly going forward. So companies have been grappling with that already, including down supply chains. But there are many significant challenges down supply chains, especially when obviously companies may have one jurisdiction that's telling them to do that, whereas the countries they're operating in have no such regulation or policy support for that kind of thinking. So it makes it very difficult for them, especially competing with other players who are not coming from that jurisdiction, to take strong action. However, in the context of the transition plans work that's now going on, so we are part of we sort of convene a group of companies who are sharing lessons on how to integrate nature into their transition plans so that we can all learn together on how best to do that. There's a lot of conversation about the need to come up with joint solutions down supply chains, particularly, including in producer countries, to actually provide frameworks that a larger group of buyers up the supply chain can come together and ask for the same data from the producers on the ground, because otherwise it's too difficult to get producers to provide the right data. So there's definitely going to be a need and a growing demand for coalitions and groupings of companies to come together. Arguably it could be done at the jurisdictional level, but that isn't yet happening. But companies coming together at least initially to provide frameworks that give producers in particular countries stronger certainty that if they take action to invest in more sustainable methods of production, for example, that will get them a benefit in terms of being able to sell up those supply chains. So that there is a lot of conversation going on about how to do that, and that's the kind of thing that players like WWF and many others can also help with in terms of convening and sort of neutral facilitation of those kinds of conversation in different parts of the world. So yeah, there's going to be a need for a lot more work in that space going forward.
And John, when you're looking at this from the regulatory framework, or when you're looking at this from the NGFS, how are you trying to build a sort of a cohesive taxonomy perhaps around this? We've struggled with a cohesive taxonomy for climate. I can imagine, and I had the same conversation with the Dutch Central Bank, which was referenced earlier, around how even more complicated it is when you're looking at biodiversity. And actually, where do you think we are along that pathway?
So you use the taxonomy word that I think everyone in the room wanted to avoid.
Apologies.
No. Just joking. But I think I think we are a bit before that, to be completely honest. Because if you want to have a proper engagement, a proper disclosure, etc., I think it's really important. And let me insist on having a common understanding of the scope and nature of the problem that we are facing. And typically, we have had a discussion in the NGFS. Should it be climate plus, or should it be a generalization of climate? I mean,
this might seem like trivial questions, but in fact it is determining so much after that it's an important discussion. The way we are advancing today is more like, especially because indeed you cannot solve climate without taking into account the nature part or the nature dimension of the issue. But still, if you solve climate overnight, which I hope we would, but you would still have a few. Water stress would not disappear overnight. So in fact, nature is a bit broader than that, and to us, the real challenge is, in fact, to develop something that is consistent with the way we have approached climate so far, but is generalizing it to other risks. So maybe in due course we'll come to being able to develop things like taxonomy and so on. But we are missing so much of the common language at this stage to be able to do what needs to be done consistently and avoiding also to fragment the approach. You were speaking to the global policy fragmentation, which I think is a big issue. And on the NGFS side, we are really trying to avoid, this fragmentation by accident, because some would have insisted more on that, and some would have insisted more on that, and so on, so that we make sure that we start off the same foundation to solve the problem. Even though, and again, to speak to something that was already mentioned. The local dimension is very important. We are not facing the same risk in Western Europe, here in the UK, or in the tropical belt, or wherever. So, and that's something also we should recognize. But we should have the same way of approaching the analysis or the risk assessment to make sure that what we are picking up is not because we have different lengths, different way of thinking about it, but because we are facing different circumstances.
Thank you very much. I want to open it up to questions as well. So please do indicate if you have a question for the panel. I have a few of my own as well, so I'm happy to continue. While we just wait for the microphone, one of the things that I know to be true in the UK House of Parliament, one of the highest number of letters that MPs get is around the bees and protecting of bees. So there is a huge focus from the population to ensure that this biodiversity and an understanding of the importance of biodiversity. But I think it would be interesting to continue that conversation around how we widen that up, I think, from the local perspective too. But please, could you identify yourself and then ask the question?
Yeah, and Anthony Belcher from ICE. I think it's maybe a question for the NGFS side of things in terms of scenario development for nature and how that will play into the framework that TNFD is developing, and how people will use scenarios to develop and manage their risks.
Yeah, so there is basically two things happening on the NGFS. On the NGFS side, the one thing is to build this framework that I was speaking about. The collective understanding of how the problem should be looked at. That's on one end. On the other end, and in parallel, we are starting to develop or to look into what does it mean to develop a nature-based scenario. That's very much work in progress. I expect that to land sometime, in fall, something like that, or to become public at that time. What I can say is that, given the local nature of the risk, I'm not sure that we will end up with the same kind of global scenarios that we have for climate, but very much insisting on how to build up your scenarios once you have done your risk assessment and that you have understood what is material for your economy.
And then perhaps there's a follow-up for Justin. How do you envision using the NGFS scenario within your framework for your financial disclosures?
Yeah, certainly having some common scenarios, whether they're truly uniform global or whether they you need to break down in some local aspects is absolutely helpful. We've seen that obviously with the climate risk analysis, and we've seen it with the corresponding transition planning. Lots of people using things like the IEA scenarios to frame their transition plans. I think the extent that we can get some of those common touchstones, as John mentioned, that would be great. Some of it, even I think some level comes out of the global biodiversity framework. There are some key targets in there. The 30 by 30 objectives. There are other objectives around reducing nutrient loads, reducing food waste. So I think there are a number of things that you can already start to think about in terms of target setting and what you can really start to measure, even in the absence of these agreed scenarios. I do think we need to be pragmatic here and think about what are the things that really match to how companies manage themselves. What are the things that the financial sector can talk with companies, the industries about, how they, what are their strategic plans, how are their production processes oriented, where are they sourcing from? Because I think there are things we can already start to work with today as some of the knowledge builds out, as it consolidates, and as we work towards these common scenarios.
I'll come to the question in a second. I just want to ask Karen. We heard already today the dreaded phrase, don't let the perfect be the enemy of the good. And a concern, is there a concern that this focus, this correct focus, that everything in biodiversity is very localized, that you have to take different scenarios and different perspectives on where the value chains are and where we are looking at the globe, that you then end up talking around the subject before and action isn't taken forward quick enough? And actually, how concerned are you for that? So how do you balance those two very real risks?
Yeah, that's a really great question, and I do worry that we're getting so mired in the complexities of modelling of all of this stuff that obvious, no regrets things we should be doing now are just being missed, or it's almost like diverting attention onto that techie stuff when really obvious opportunities to take action, especially at the policy level, are being missed. And so, and also at the company level. So, for example, I think the obvious no regrets action for companies is to look at their impact on deforestation and exposure to deforestation risk. That's a very complex area as well on its own, actually. But there's potential for companies to work together to identify solutions and transparency down the supply chain that would actually enable much more transparency and disclosure around deforestation impacts as well. And that kind of thing can have a significant impact on climate change impacts through emissions, through deforestation. So there are things that we should be doing straight away. There are policies that can be put in place to really strengthen and support that. So I would say that we should do that. The other thing to say is there's already a lot happening, I think. We do a regular assessment of central banks and wider regulatory policies called SUSREG. The last one was published in December last year. I think it looked at 44 countries or something like that to look at what their policies were on this. And I think 40% of them do have some degree of wider environmental issues being taken into account beyond climate change, including nature. So that's often about asking companies or giving guidance to companies about thinking about nature-related risks. But that's a good start, getting companies to think about it, using that data, monitoring that data to actually start learning about the risks themselves. So I think there's a lot that can be done before full information is available just to help us to navigate this issue and to start taking the obvious action we know we need to take straight away.
John, you looked like you wanted to come in here, so yeah, I'd like to give you the floor.
Apologies that it was so visible. No, I fully agree. I think the challenge to us is to go past beyond these no regret obvious things for which we need to build these frameworks. And I think the framework basically is around in 4 words: nature rather than biodiversity, because it's a broader topic. Impact and dependencies. And something that, lack of substitutability. In fact, what I think the main challenge is that we don't really understand what's in front of us with regard to the risk assessment part of it. And that's what people are not realizing, that in fact, half of our GDP, roughly, depends somehow on some services that we are not sure we will keep on having in the future. But no one has really, is half of the economy disappearing overnight? Or what will happen? And that's the question we need to make progress on to be able to develop sound and effective risk management.
Thank you. And I would like to know.
Yes, hi. Theodora Antonakaki from the Bank of Greece. I would like to hear the panel's views on pricing in externalities. We heard on the first session that there is the sustainability benefit versus financial gains. Then on the second session, we had that we are moving away from carbon pricing, especially through the IRA, the Inflation Reduction Act, that the discussion has already moved away from carbon pricing. So what are your views on pricing externalities and pricing in the cost of doing business? Thank you.
I think I will first of all ask Justin you to tackle this quite, I think, even furtherly complicated question in regards to biodiversity than as you touched on this earlier around the carbon pricing perspective when we're looking at tackling the climate crisis. But how do you translate that into nature-related risk?
Yeah, I mean, obviously, pricing is the economist's, favorite instrument for these sorts of things, and if we could do that credibly, that certainly would be helpful. And there are efforts underway at this, in terms of trying to really monetize externalities and really reflect those into the financial statements of companies. I do think this is work that's going to continue to need some investment over a number of years. But this idea of sort of impact P&L accounts that really could reflect essentially a company's positive and negative impacts along with their financial impacts, I think would be quite an interesting development if that could be done. But I think that's it. It's going to take time, clearly, and I think there have been some good points made about we need to find some ways we can move forward in absence of maybe some of these first best solutions, and so certainly having policy frameworks that can guide pathways for industries, having some key issues that are looked at, such as deforestation, as was mentioned, plastics, another example as well. You have to think about what are the ultimate goals that we have, and how can we sort of start to think about the evolutionary path of different activities or industries, and then what can the financial sector do to accelerate that? The thing I think we shouldn't lose sight of is it was made quite well before, is certainly your risk analysis is necessary, and that level of understanding is very helpful. But if we achieve transition, we actually achieve effective risk mitigation, and that is effective risk management. So at some level, I think we also should sort of absorb some of the lessons from our climate as work, and the more we can focus on that transitionary element, I think we give ourselves the best chance to mitigate risks, be they transition risks or physical risks.
Thank you. We've got 3 questions. We've got 3 questions as well in the audience. So I will just come, if you could answer this question quickly from there, and then I will take those 3 together, and that will take us into the last 5 minutes. So, Jean, how do we price this? How do we price this nature-related risk?
Honestly, I don't have anything more to add to what was just said.
Well,
but I'm an economist,
Yeah, it's a complicated question. Totally agree. Externality is a massive problem, and we've got to overcome them. A lot of that's got to be done through policy change, I think. And if you read the Dasgupta review on the economics of biodiversity, very long report, set out lots of different ways that you could do that, and it has to be country-specific to some extent as well. But so ministries of finance and other ministries need to take responsibility for putting in place those policies. But in fact, we're finding that that's the pushback we get from financial institutions anyway. You're asking us to do a net zero transition plan, but you're not giving us the policy that actually enables us to do that in a profitable way. Same with nature. So I think we need ministries of finance and governments to take responsibility for putting in place the policies that drive that investment in nature and in net zero transition as well.
Thank you so much. We've got 5 minutes, so I'm going to take it. There's also a gentleman there who can have the microphone, please, after we've taken this first question here.
Paul Rankin, VSA Capital. Can you just suggest some ideas on how we can quickly and easily get more investable instruments into the marketplace, into biodiversity, wherever they may be in the world?
Excellent. So instruments into biodiversity. This lady at the back of the room.
Thank you. One view of the world is that the financial system is a recipient of biodiversity-related risk. Another view of the world is that the financial system is a driver of biodiversity loss, and therefore it falls within the mandate of a central bank to help mitigate that. I'm curious to know, in the kind of NGFS group, how many of the participants solely take a recipient of risk approach in terms of how they manage their operations versus how they try and actively use the financial sector as a driver to stop biodiversity loss. Thank you.
Thank you very much. And then the gentleman there. Thank you.
Great. Thanks very much. William Atwell from
Sustainable Fitch. I just want to point out regarding nature-related scenarios, there was actually the UNPRI FPS Plus Nature scenario launched in January this year, which I was fortunate enough to participate in the launch of. So there is work going on there. I wanted to ask the panel's opinion about when climate action and nature action potentially work in conflict with one another. We know we've been talking about how they interact, obviously, in the real world. But in some of the measures, for instance, that are being taken to accelerate investment in clean technology, I'm thinking about some of the incentives in the proposed Net Zero Industry Act launched by the European Commission last week, and also the Critical Minerals Act, draft Critical Minerals Act, to accelerate mining projects for rare earth minerals in the EU, for instance. Could that potentially be working against some of those nature protection and biodiversity protection objectives that presumably we all think are important here?
Thank you very much. So those three questions, I think if we weave them together in some aspects, I think it's quite interesting. Let's start with the question from the lady around the recipient of risk or the active driver to stop. And then I would quite like to look at the instruments that are out in the world and where do they conflict with each other. I think that's a really important position or discussion to have. We could probably have it for 15 minutes longer. We won't, because there is lunch. So I want to start with you, Jean, around the position of within the NGFS, and then how that translates into the real world instruments, and then where does climate action and nature act and conflict with each other?
So I think it's good to have this kind of two different views of the issue. To be completely honest, when I look across the NGFS membership, I don't see people opposing the two of them. I see people looking at it, understanding it's both with regard to basically impact and dependencies. And we very much have the same framework to think about that we have for climate transition risk and physical risk, so to speak. So in fact, it's not one camp or the other. It's the two of them, and it's understanding also that there is not that much that we as central banks can do. We can go a long way in some dimensions, but honestly, the whole problem requires a whole of government approach to it, and that's also something that needs to be well understood. With regard perhaps to the instrument question, I'm afraid that without policies, to me it's more of a risk discussion than an instrument discussion. And I wish it would be otherwise, but I fear that at this current juncture we are really more looking at risk and stemming out of dependencies and so on. But there should be, to me it's a bit of the same question that the adaptation finance issue. It's difficult to build a business model out of that, even though it's critical.
Thank you very much, Karen. And if you could actually, I think also maybe start with the climate action versus nature action, and do they conflict with each other?
They can do, yes. So sometimes they can, as examples you gave. Also, biofuels is another obvious one. So in our work for the Transition Plan Task Force for the UK government, one of the recommendations we made that has been adopted into the guidance that's been put out is that one of the things companies should think about in developing their net zero transition plan is the potential impact on nature and any risks associated with that, negative impacts on nature, and what safeguards they will put in place to manage those risks. So it's beginning to get at that problem, identifying where there are trade-offs. There's lots of complementarities too, but there are some trade-offs. So beginning to sort of get those out in the open and think about how to manage those trade-offs going forward. I think that's the first step, and then we are going to need government to think about that as well in terms of the policy frameworks they put in place to drive net zero and nature positive transition going forward. On some of the other questions, in terms of the question about the recipient of risk versus the impact, I think this is really critical, because I think some of the issues that came up earlier this morning highlighted where there's sometimes a bit of a trade-off between the existing main mandate of central banks and regulators versus climate and nature as well, to an even greater extent perhaps, where I think that trade-off is mainly probably in the short term. In the long term, they become the same problem in many ways. But in the short term, there may well be a trade-off. And so we've been arguing actually in the UK context that financial regulators should be given a statutory objective to deliver net zero alignment, because the UK government has made a commitment for the UK to become the first financial centre to deliver, to be a net zero aligned. I don't know if that's going to be true or not, but it seems to make sense that financial regulators would be given the job of making sure that happens. So it increases that in their prioritisation list, and in terms of the resource they can throw at that question. So I think that is a really important part of what we should be expecting of financial regulators going forward. And so on the final question around instruments, what is happening in the transition plan conversation space is whether that's on the net zero transition, but it's about how can we credibly demonstrate that we are engaging with companies to improve their performance, such that we can continue to invest in some companies which don't have great fossil fuel record, but who are working hard to tackle that and investing in new solutions. And if we can get a credible framework for that through the transition plan framework, that kind of thing can be applied to the biodiversity transition as well. And we know there are some funds out there that are already looking at incentivizing the nature or biodiversity transition as well, and looking at what requirements they could set of the companies they invest in to ask them to show that they are making improvements in terms of their nature impacts. So I think there's bits that are being done that could help to develop these instruments in due course, hopefully fairly quickly.
Thank you. And Judson, to end with you, if you could just touch on those questions, perhaps starting with the instruments question, and anything you would like to add.
Yeah, well, I'm between you and lunch, so let me just focus on instruments and put out a few ideas. Something we've been looking at as UBS, whether we can develop blended finance solutions, perhaps using philanthropic capital from some of our ultra high net worth investors, investing in things like, say, mangrove restoration. Maybe you're potentially tapping into the value of carbon sequestration, potential other ecosystem services. So finding sort of creative solutions to get to that sort of monetization point that we mentioned before. Other interesting instruments that have been developed, debt for nature swaps are coming back into focus. They've been around for a long time, but certainly in the case of nature, they can be used quite an effective way, particularly as we move into a higher interest rate environment with concerns around the debt sustainability of emerging markets. And finally, I'll put in a plug for some work that's going on in Jean's organization with one of my other hats, which is as the industry chair of the IAF, the Institute of International Finance's Sustainable Finance work. We're actually working on a blended finance handbook with the NGFS to be published later this year, and so I'm hopeful that'll also be able to feature not just climate-based solutions, but broader nature-based solutions in that work.
Perfect. Well, hopefully when that comes out, we will be able to, we'll be able to convene a discussion on that as well, because I think that there'll be for sure interest from those in the room and also those who are listening virtually as well. So I just want to thank everybody for listening to this really interesting discussion, and also for contributing to the discussion and the speakers here. So please do head out for lunch, and then we'll reconvene in 1 hour for the afternoon sessions. So thank you, everybody.
Thanks for joining us after lunch. I hope you had a nice time mingling. So we will now be continuing with the session on converging sustainability regulation, developments in reporting, building transparency, and managing climate risk. I'm Taylor Pierce, Senior Economist at OMFIF, and it's a pleasure for me to introduce my esteemed panel of speakers today. We have Sasha Sedan, Director of ESG at the Financial Conduct Authority, Lee White, Executive Director of the International Financial Reporting Standards Foundation, or IFRS. We have Marcus Ingholt, Senior Lead Climate Economist at the Danish Central Bank, as well as co-chair of the subgroup on disclosures of the NGFS. And Carlo Funk, Head ESG Strategist of EMEA at State Street Global Advisors. So I'd just like to jump into the questions. Climate-related activities within finance, as we've discussed today, fall somewhere along the spectrum of aligning investment activity with climate goals or managing climate-related risks. So where do disclosures fall along this spectrum? I guess I'll start with Sasha.
Nice to have a microphone back in the real world, a bit like karaoke here, isn't it? So here we go. Disclosures. Well, disclosures aren't everything, of course not. It's about doing things and impact and everything else, but disclosures are very important, and I'm glad I'm going first because I'm sure not many people can say it doesn't matter about disclosure. So let's give some examples probably. If you're thinking about anything that's going on in the world at the moment, people are trying to price it. And if you're trying to price something, you need to know what kind of risks there are. And I think risk is the big one that I always talk about. And some of the times, and we'll go into this, people say things like, oh, but you know, I care about a lot of other things. You're like, well, what's material to the actual company? So let's talk about corporates, not just equities, bonds, real assets, infrastructure, anything. It's about materiality. And therefore, you need to have disclosures on that. Everyone's different, though. So it's a very important point that we don't just try and make one size fits all. Very different sectors out there in different locations and everywhere else. So I think that's really important. Secondly, it's not all about climate. I think that's a really important point. These things are becoming very high up the agenda. Wherever we are, and we do our own financial lives survey, huge survey, and the consumers want their money. They want their money to do well. They certainly, number one priority is to make a return, but they also would like their money to be linked to some of the things that they care about or social factors. And so, therefore, this is becoming bigger. But this is coming from employees as well, so it's not just coming from regulators or other people. So disclosures are extremely important, but they're not all. There's going to be other things we'll talk about later that are just as important as disclosures. But of course, any company should be reporting what's important to its investors.
Great, thanks. Lee, do you want to follow up on that?
Good afternoon. Thank you, Taylor, and thank you to SPI for the invitation to be on this panel. The question, I think, if I repeat it correctly, was where does the disclosure fit along that spectrum? And I'd say at all parts of the spectrum. In the spirit of what Sasha was just saying, I'll be very clear. You know, I think the further you can get in precision in disclosures, the better that the capital markets can allocate the capital correctly. Investors are as well informed in what they need to know to take their decisions, and ultimately that will then lead to impact through those decisions as well. So I'm going to keep my first response fairly brief to say disclosure is very good and can have multiple impacts in how they're used.
Great, thank you. Marcus, do you want to comment? And then I'll come to Carlo on the investor side.
Yeah, so I mean, so essentially I just want to echo what has been said before. I think one point is that when you begin to price these risks, then you are actually also supporting the green transition, because suddenly there'll be an incentive for business models or for managers in businesses to transition. So even though disclosures to begin with are at the superficial level is about managing risks, then you could say that so you could say adaptation to climate-related risks would mitigate climate change.
Great, thanks. And Carlo?
Yeah, I mean, excuse me.
Well, I mean, obviously, when you have the goal to directly finance the transition, like disclosure per se will not drive capital flows in a first derivative instance. That's clear. But when you then think about the value chain of how investors are making decisions and based on what kind of information they're actually employing capital, they rely on some form of data. The data they either research themselves, the data they are purchasing from third-party vendors in the market, and without accurate disclosure, not only accurate disclosure, but also disclosure that is focusing on the material and the important parts, the water, with all the best intentions, is going to be so muddy that investors have a hard time, or might have a hard time, to actually make capital allocation decisions based on this information. So actually, the disclosure piece is so absolutely paramount in the context of this entire ecosystem on how investors are making investment decisions. And then you can always like start to drill down what kind of metrics are important. We might come to that later, but again, when you think about the ecosystem of financial market decision making, it starts with disclosure the same way as equity analysts, when they put out a stock price target, they rely on quarterly earnings report. They dial into the quarterly earnings calls, and they try to find as much information possible in that regard to make informed decisions. And if you, even though you might have the feeling that something is in the cooking when it comes to climate risks and opportunities, without the disclosure, you can maybe as an investor shy away from acting if you are feeling insecure about what kind of information you can base this decision on, especially in the context of fiduciary money management, where pretty much every single decision you make, you need to justify. So absolutely, disclosure is at the very heart of this.
Great, yes.
I was just going to say, we've just got to distinguish this, because we've all been there. You know, when you've had companies say to you, whether it's on anything, say, the employees are most important asset. Words are very nice, but like, well, how much do you pay them? Do you train them? What's their retention? What's their churn rate? Any of these things. So you need proper data disclosure, and you need it sometimes to be assured to get trust, which is the next stage.
Great, thanks. So it sounds like it was a bit of a trick question, because the answer to where do they fall along the spectrum is across the whole thing. Great, I'd like to come to materiality now. So materiality is a key accounting concept in which financial information on a company or entity is considered material and should therefore be disclosed if a reasonable person would consider it important. That's the SEC definition. My question for you all is it now widely accepted that climate-related factors are being considered material? And specifically for Lee, which kinds of risks are considered, and how does this connectivity work with accounting standards? So I'll start with you, Lee.
Thank you very much. So to your first question, I just would have to say, yes, it is widely accepted. You know, I think there's a recognition that, and you didn't say it this way, Taylor, but I'd bring it out a little bit further. And the materiality focus with climate is both on the risks to an organisation and the opportunities. So it's both elements. And the standard that's been prepared by the International Sustainability Standards Board, which hopefully will be published by the middle of this year, will known as S2, very much focus on the risks and opportunities that need to be disclosed regarding climate. On the second piece, this is a really quite an important area, because the demand that came towards the trustees of the IFRS Foundation leading up to the announcements at COP26 to form the ISSB was very much, one element was very much coming through of, we want this to be in the IFRS Foundation because we want to see this connectivity with financial reporting. And so that is starting to really be moved ahead. I would say that we've seen already that the types of concepts being used on the accounting side, many of the concepts, not all, and the terminology is also being used in the Sustainability Standards Board. So you have that level of connection already because the terms and the nature of the standards have the common language. What we do know as well, and I think this is actually happening today at the Accounting Standards Board, their meeting, and it's all on the public record, is that they will be looking at how they wish to advance further the recognition of the impact of climate back into financial statements. So the requirements are already there, but I think there more could be done in order to allow the guidance and the connectivity happening between the disclosures of this proposed S2 on climate and then ultimately back into the financial statements as well.
Great, thanks. And we'll come back to some of the other work that the IFRS is doing in tandem with other initiatives and organizations. Sasha, did you want to comment on this?
Well, I think, I mean, the obvious answer is when you're looking at any of these things, what you don't want is a 1,000-page document with every little risk that could possibly ever happen, because no one would then take anything seriously. So the obvious point is, tell me the 10 or the biggest things that matter to your company and tell me the information that I need to make that. And otherwise you just get blanket pieces of paper that tell you that there is a possibility that this could happen or that could happen, and it just loses its emphasis. So it's pretty obvious. But then what's important is that it's done from a very strong governance process, that the audit committee or someone else says, these are the biggest risks that we've got. And I do think that's a really important point that Lee made. Opportunities. There's going to be a huge, and we're in the civil engineering building, there's going to be trillions of dollars spent in mitigation, adaptation, and things that are going to happen in the next 30 years. What are your opportunities as well that you're going to spend your money on? And so let's not always think about this as just risk and negatives. I think it can be very positive as well.
Great, thanks for that. Marcus, how is the Danish Central Bank thinking about these risks and opportunities?
Well, actually, I'll come back to that, but I would like to start somewhere else, and that's on this question about the extent of disclosures. So first of all, I entirely agree that we should focus on materiality. Just disclose material risk, because if the disclosures are too long, then nobody will read them, companies won't take care when doing them, and then they'll be useless. Secondly, there's this issue, especially in Europe, where we're discussing whether disclosures should have a single materiality, so just focusing on the risks to the firms, and perhaps also opportunities, or if they should be double materiality, or we should have double materiality, so focusing both on the risks and opportunities to the company, but also the impact of the company on the climate. And I mean, so as a central banker, our interest that lies with a single materiality, because this is about handling risks. Then I would say it's okay for politicians and other people to want the double materiality, but then they should call it double material. They should be clear that this is not just about risks, but it's also about assessing the impact of the company on society, and that's perfectly fine if you have it, depending on your idea about the role of a company in society. But it's not about risk management, and I think that's important to keep in mind. But it may be important for consumer protection or aligning investment activities.
Great, thanks. Yeah, that was also a point that was brought up in the last session on nature-related financial disclosures. Carlo, did you want to comment on?
Yeah, sure. I mean, first of all, short answer to the question if climate-related risks are being perceived as real risks and opportunities. I would say the vast majority of investment professionals, the answer is a very clear yes. Of course, depending on where you look in the world, there might be disagreements on a personal level, but when it comes to real investment professionals, by and large, the answer is an absolute yes. End of story. And actually, the interesting part there is we all discuss this under the umbrella of sustainability or umbrella terms like ESG or whatever it is. But I mean, at the end of the day, when you look at at the TCFD, and you start to look at what the transition risk would mean, what a physical risk would mean, and you talk to an insurance company. I mean, no insurance company, like, of course, if you insure a building, the shoreline will define the premium or has an effect on the insurance premium, right? That has nothing to do actually with a lot of sustainability or ESG thinking. It's just like common sense, right? So in that regard, it's an absolute clear yes that this is clearly recognized from financial market participants and practitioners. Another comment of what Sasha made, and when we talked about materiality, it is not only, so first of all, who wants to read through a 100-page document, especially from a consumer protection perspective? Like, absolutely not. So this is why you have to define the KPIs, that's clear, but not only you need to do this because to narrow down actually the focus also of what can be digestible, but also that closes the door for companies to disclose things, maybe few things that are easily digestible, that are actually in fact irrelevant, right? That's also an important point, because often when people think and talk about KPIs and narrowing down materiality, it's clearly correct to say, well, where should I focus my attention? We all need to focus attention and have trade-offs, clear, but it also again closes the door to focus on things that are actually irrelevant. And companies at times can be quite smart to create narratives that seem to be very relevant for their operations, but in fact, they're not so much, right? So this is something, that's why this is so absolutely crucial.
So it's not just about having more information, but also the right kind of information.
And this is, again, not only in the context of climate, right? That is in the context of social and other governance elements, clearly as well.
Which we will come to shortly.
May I say one thing? Because I also think there's something, there's a lot of discussion over different technicalities about whether, one metric or the other metric, and some data. And all of that is important. Perhaps I'm talking it a bit too much down now. But what's even more important, that's good governance and good strategies. So, making sure that this basic housekeeping is in order. And that's really where it begins. And you can have the best possible carbon metrics and whatnot, but if there's a crappy culture within management, then it's not going to matter.
And Carlo, you mentioned about irrelevant things. I've been in rooms with companies that have told me that they've got dolphin-friendly soap, because that was what they wanted to talk about, which was, I'm very pleased for them. But it's, materiality, I was thinking, interesting, but, they just want to fill that void.
Yeah, good point. Thank you. By the way, if there are any audience questions that come up, please do feel free to raise your hand. I'll open it up at the end, but please feel free to ask as we go along. My next question is for Sasha. So there's been a proliferation of regulations on reporting and disclosures on climate-related factors. As the UK's financial regulator, what has been your experience with this? Is it preferable to kind of forge ahead with national standards and then think about harmonizing those with other jurisdictions? Or is it better to reach consensus first at a more global level?
Well, the quick answer is national standards won't work on their own. So there's easy. So we were one of the first countries to mandate TCFD. And just to give you some stats, let's use some real numbers. 64% of the companies in the premium listed in the UK said that climate was a principal risk. So they're already saying that. That's coming from the corporates themselves. And I would guess that's going to go upwards, not downwards, but that's up to them, not me. So therefore it's already happening. But we're using international standards. I'm working very hard. I'm the now Vice Chair of the IOSCO Sustainable Task Force to make sure that we have international standards for all securities regulators. Why? Not just because it's the right thing to do, because most companies and most investors are international. And that's the most important feedback we get all the time. Can we just have one set of metrics? Can we just have that? It is difficult, and there is going to be different debates coming on, but absolutely that is the aim, to get one kind of measures that we can use in different parts of the world so that anyone can compare, contrast, and trust which is the thing that we talked about at the beginning with disclosures. It's not easy, but it is happening. Now, just meaning having one set of standards doesn't mean we all go at the same pace, so that's probably the more nuance of the question. And I always think about that. We went first on TCFD, or one of the first, but everyone else is doing the same thing. And some are doing it voluntary, some are doing it at large companies. We did it large companies first, large asset managers, and then we moved that on. So scaling and phasing is just as important, but moving in on the same road at different paces is really important. And I know that's something that we, as hopefully a progressive regulator, is trying to help bring that standards together. Same with ESG ratings, transition plans. We're trying to use international language and using the things such as ISSB to do that. So it's important, but of course people go at different paces, but it's exactly important for investors not to have 15 different metrics on the same thing.
Great, and just as a follow-up question, you mentioned the TCFD, Task Force for Climate-Related Financial Disclosures. Don't want to throw in too many acronyms without spelling them out, but where else have we seen convergence in standards? And where has there been divergence in regulation? Maybe not just in pace, but also in substance. Maybe Lee, if I could open it up for you.
Thank you. So let's try and set a little bit of context. So the announcements that were made at COP26 with the creation of the ISSB also that day announced that there would be a level of consolidation, because you've heard already in some of this dialogue that there's multiple, at that time there were multiple different sets of directions, requirements, and what we were wanting to make sure that we weren't just going to add what was then known as the alphabet soup of acronyms. An important part there was consolidation of two organisations, the Value Reporting Foundation and the Climate Disclosure Standards Board. Both of those were successfully done in 2022. And TCFD was really fundamental here because, you know, in a short period of time, they created a very significant amount of momentum, and we wanted to build upon that momentum. And so we used the TCFD as the architecture framework for the two standards that are coming up, both S1 and S2. So if you're an organisation or a jurisdiction for that matter that's actually already taken steps with TCFD, that can be the foundation point to then build to use of the ISSB standards. And so we've worked with the TCFD leadership and secretariat, and we think there will be a natural point of passing over from TCFD to the ISSB, but that remains to be determined exactly the timing of that.
Sure, and can you also speak about how the IFRS via the ISSB is working together with the GRI on standard setting?
I can, Taylor. So, and again, we heard some of this just being discussed by the panellists. So we have an MOU in place with the GRI, and I want to be really clear, this is not an MOU which is a piece of paper, this is in real substance. The two boards are starting to work through their program of priorities and to see where those priorities will cross over and where they need to work. We very much have a focus on what we describe as the two pillars of reporting, the ISSB purely on the investor focus, delivering what we need to do into the hands of investors. For the GRI, they have a multi-stakeholder focus. Marcus was drawing out this distinction earlier, and therefore we want to make sure that if there's topics or areas, the investor focus can happen, and as well we can certainly see if jurisdictions or organisations want to go further, then they can do that utilising the GRI standards.
Yeah, that makes sense. Marcus, did you want to comment on how this fits into the EU's frameworks?
Yeah, exactly. So it'll be pretty quick, but I just want to say I think there's a lot of focus also both from the European Commission and from the bodies you represent on making sure that these reporting standards are at least not inconsistent with the EU regulation. Then the EU might require its companies to go further in certain ways, double materiality, but that, you know, once the European companies have reported, then they would also have reported in compliance with your recommendations. And when when I'm talking about the European regulations, there I'm specifically thinking about the Sustainable Finance Disclosure Regulation, so the SFDR, and then the Corporate Sustainability Reporting Directive, the CSRD.
Great, thank you.
So Taylor, and I'm conscious of time, so I'll keep this very, very brief, but I can certainly confirm the sentiments that Marcus has expressed here. I just say that the work is still ongoing with the Commission, and we're really, both the Commission, EFRAG and ourselves, are very focused on maximising the interoperability between the two reporting regimes.
So it sounds like there's a lot of work being done to make sure that in jurisdictions that want to go beyond what's being discussed at the global level, they have the space to do that, and it will be interoperable with global standards. Makes sense. Any questions from the audience? Can I have a mic for the woman in the third row? Thank you.
Hello, my name is Guyana from Sustainalytics. I'm the biodiversity expert. Talking about disclosure, just focusing on carbon, we're blindsided to the wider nature-related risks. The EU is taking big steps towards this. The ISSB in COP15 hinted, or they announced that they would look into incorporating nature-related disclosure. Can you give us any time horizons on that?
Sure can. And there was that reference that you made at COP, but also the December board meeting of the ISSB also gave a little bit further granularity around that. And I'll just be, to give some context, as S1 and S2 are being finalised in order for publication, the ISSB then undertakes what's known as an agenda consultation for their work program for the next 2 years. That will be launched, I think, either late April or early May, with probably a 120-day consultation period. And in there, because we've already heard quite a lot of the passion and the importance around nature, that I suspect much more will come through that process, and we'll then be able to transparently give you a sense of exactly the priority and the timing of responding to that priority.
Maybe sorry, one comment. When I think the work, and keep me honest here, obviously, but the work of the TNFD is also quite paramount in that regard, right? When I would think about just from an investor perspective, how long it takes at time for those kind of elements that are on an intellectual level make a lot of sense to make it down to investment decision making, that takes a minute. Like when you think about TCFD, when was it, like 2017 if I'm not mistaken, and then things happened. The UK as the first made it mandatory, and was just like clearly like really running front there, which is amazing. And then when you consider the TNFD is just like in the midst of works, right? There needs to be, and that's not discounting by any means or in any shape or form the importance of this whatsoever. But when it comes to base something on base financial decision making on data, that's different from looking into it, it's different from analyzing, it's different from getting informed. But having like hard-coded financial decision making based on data, this data needs to have like certain form of robustness, which again, if it was up to me personally, that should all be in place already. But there is something, again, and I'm speaking again as a fiduciary money manager, that we need to also check around information quality at the end of the day.
Yeah, we have another audience question.
May I say, before the gentleman asks question, so just when it comes to nature-related risks, it's even more important to focus on materiality, because this nature-related losses are so much more multidimensional than climate change. So, I mean, if we have difficulties focusing on materiality when we are talking about climate change, then I'd read what's installed for us.
Thanks.
Hi, Etienne. I'm with Impact Finance, lead the public policy. My question is for Sasha, but also Carlo. We've seen, we've seen SFDR rolling out in the EU. The FCA just published, like a couple of months ago, its proposal for an SDR, whereas the US also, the SEC published a similar proposal. How are you learning from the bumps that the EU experienced with the rollout of SFDR?
First one's for you.
I think the first one is for me. Yeah, hi. Well, like anything in life, if you don't go first, you can learn from others. Good experiences and bumps. I like that word, bumps. And some of the things that we've learned from that has been that, one, it was a disclosure regime and ended up being used a lot of the time as a labelling regime, and you know from Article 6, 8 and 9. So I won't go into too much detail, but that. And of course, when you use numbers like 6, 8 and 9, what do you think commercial product marketing people, they all want a 9 and not a 6 because it's a higher number. So you get hierarchy. So we've tried very hard not to have hierarchy, because if you're a consumer, and that's how we think of the consumer all the time, they might not want a very niche product or a 30 stock portfolio for their pension. That's not very good for the capital allocation, but they might want to take sustainability considerations into it. So we've got focus, improve and impact, and it's okay. Secondly, back to your point, a lot of people got more excited about exclusions and excluding things, which of course are an important part of it, but are not everything, because if we're trying to change the things that we've just been discussing, and you talked about with nature and everything else in the other panel, you can't just avoid huge swathes of industry. You have to get them to do things and push them and be active stewards and all of the things that we talk and influence. So our big label, which is different, is the improve label. And again, when we first started it, we used the word transition, but we did a survey, or some surveys with over 15,000 consumers. Transition to what? They don't understand it. But improve, oh, I know how to improve. I want improvement. I want that. So we've been learning and using consumer language so that people can understand that. And also it's because we shouldn't exclude a lot of the time. We should be influencing, especially if you want to change. You need oil and gas to change. You can't just exclude them and hope that they change. So those are three of the things that we've learned from that. And then last but not least, it's not just about, it's the naming. It's the names that are allowed to be used. And some of the names are, you know, in terms of responsible, sustainable, and how you use that. And that's what's happening across the world. People are looking at the naming. So hopefully that's helpful. Carlo.
Yeah, I'll chime in. So first of all, it's interesting to, when you think about SFDR, it was never clearly being intended, as Sasha stated, as a labeling regime. The thing is, even ESMA publicly stated, I think last year around February, March, that SFDR is incorrectly utilized as a quasi-labeling regime. But the way financial markets work, it's not that anybody reads this and say, okay, that's not the intention, and now we're gonna like change overnight. It's still being used incorrectly to get like at times on buy lists and things like this. It's the reality. The only thing is what has happened, that this Article 9 category, because of additional language additional answers being given by the EU, which means, and I can quote this, they said, well, an Article 9 product should be exclusively invested in sustainable investments and should only hold non-sustainable investments for either liquidity or hedging purposes. That's the exact wording of them. Well, that automatically rules out a lot of broad diversified portfolios, including climate benchmark, EU Paris-aligned climate benchmarks, if you ask me, by the way, which makes it a de facto, for a lot of things, null category, unless, to Sasha's point, you are really going in really fundamental, concentrated, illiquid, or you focus on green bonds. And that's clearly not in the interest of consumers. So the point is, and clearly there's a second mover advantage in that regard of the FCA to learn from this, and they did. And also, what was nice during the consultation process, I have to say that the FCA, they were listening to feedback, Because that has not happened too much in my so far experience, that there would be a proposal coming out from a regulator, and then of course there would be like smaller tweaks, and then you're like splitting hairs. But there have been, the feedback was taken in, there have been quite some fundamental changes along the line. So that was good to see.
Great. Sasha, did you want to comment on that at all?
I mean, I've come from industry, and that's why I came to join the regulator from 25 years of running money and stuff. I think it's really important to listen to the industry. And that's why we had a disclosure group that was made up of 17 people who are selling products in the market and understanding what it's like. And then the last point, we are a consumer regulator. So we have gone out and surveyed consumers to understand the word. They don't understand the word stewardship. And yet we spend all our time talking about stewardship. And it's a great word, and it's a really important thing to do. But explain it to the consumer in the language that they understand. And so we've just said that we want a two-page document, because the one thing we hear all the time, I've bought this green fund and it's got oil and gas in it. I don't understand. And it might be for the right reasons, that oil and gas company is changing, it's got a plan, it's moving, it's doing that. But explain that to the people who are buying your product, and that's what we're trying to help.
Great, thanks. I'd have a follow-up question for Carlo. You spoke about some of the climate-related benchmarks. From an investor perspective, what is your experience with the adoption of some of these frameworks across jurisdictions? How similar are they, and how is that affecting your decision-making as an investor?
The reality of things is that those benchmarks are actually, from a technical perspective, quite different, right? At the outset, it looks like a perfect storm, right? Especially for investment professionals or houses that are reliant on scale products, right? So you have a European Commission that puts together the technical expert group that comes out with a blueprint and how you should construct a portfolio, right? It's just like, it's kind of the perfect storm at the end of the day. You would assume, okay, that's amazing. There's an official institution that tells me how to construct a portfolio, and everybody should follow this. The reality of things, though, is that once you then start to go into the weeds of the possibilities on how you can construct those portfolios, which kind of data sources you use, which kind of metrics you use, that can be quite dramatically different, right? And those kind of metrics are ultimately then informing capital allocation decisions, which is also an important point to make when it comes to understanding the difference between general KPIs when it comes to disclosure is not going to be the same as what different data vendors would do with this data to come up with their own metrics, because we must not forget that they're in competition as well, right, to come up with the next great way of, or next data point that can be utilized in portfolio construction. So what that means from a fundamental perspective, they are trying to do the same thing, but the way they will be constructed, if you would like look under the hood of an MSCI Paris-aligned benchmark versus a S&P based or stocks based or whatever other benchmark provider might have, you will see different metrics that utilize different methodologies are being used, and the way the actual underlyings are reweighted is different. And there's nothing wrong with this, because just it's good for innovation. Nobody is, in my view, complaining about the fact that different big asset managers are constructing portfolios in different ways, even within the same kind of thematic bucket. There would be like, if that was the case, I would probably want to write an article on bubble risk, right? So at the end of the day, it's totally okay and it's good for innovation, but it needs to be acknowledged that they are different, which means the due diligence process for an investor, even for the sophisticated ones, when choosing one of those propositions, needs to be as thorough as in any other circumstance.
Great, thanks. I want to bring it back a little bit to reporting and disclosure standards. I guess this question would be for Lee and Sasha. What can be done to ensure that some of these standards are truly global and not just being taken up by European or North American jurisdictions? Lee.
Yep, thank you, Taylor. If I sort of reshape your question slightly, I think it's trying to draw the distinction out that we just don't write standards that are for the advanced economies. And that message has come through very, very strongly in the consultations we did, particularly from G20, but from a number of other groups, the Financial Stability Board and so forth. So if we take climate as an issue, not the only issue, but as an issue that we're dealing with first, we need a global response to a global issue. So therefore, we need to shape, and this is our challenge, we need to shape standards that allow all to use as a global baseline. And how we do that is that we try and make sure we build in enough guidance, enough options to allow those that may be building up their expertise and capacity at a jurisdictional level to still feel that they are able to join in responding. And that's the philosophy of what the board's been doing, that I will continue to be focused on making sure these standards are fit for purpose for around the globe and build in as much options, scalability, proportionality to the requirements of the standards.
Thanks. Yeah.
There's a question there.
Sorry.
Should we do that before Yeah.
Sure.
I didn't have much to say, it's fine.
Yes.
Thank you. It's Anushka Barber from FTSE Russell. And actually I had a question on SDR, so sorry if I'm interrupting the flow on the global disclosure question. So it was just to say that I think we really welcome the FCA's very pragmatic approach to SDR, as you say, learning from the bumps on the road, I think someone mentioned in terms of other disclosure regimes. And also very reassured by, I think, Sasha, your comments just now around making sure that retail investors, the only funds that deserve an ESG or a sustainable label are those that are very dark green and very concentrated. But just in terms of practically, we've been looking at the 3 labels, and we are struggling to see how a broad, diversified, sustainable portfolio might meet, for example, the year-on-year improvements that are required in the improvers label, and for the focus label, kind of, just really interested in your views, kind of how do you make sure that those kind of very diversified offerings can meet, the 3 labels that the FCA have done so much research and testing on. So just welcome views from Sasha and
well, I'll go
the panel.
first, and if anyone else wants to. The first thing is we put out a consultation. So we've done all the work and still listened to everyone. Thank you, Carlo. And then still put a consultation. I've had 240 responses. So we are going through that because some people have come up with some very good points that could make it even better. And some of that is the points that you've made on how do we measure this. Now, part of that, as we've said, is let's get the first set of ISSB standards, and then we have better metrics to be able for people to be able to measure things and be consistent. But we're absolutely working on that at the moment. And going through those responses, there's quite a few buckets that are coming through that are similar in saying this is quite difficult and this is quite easy. But we're making sure that to begin with, we've said that it's up to the asset manager or the product specialist to put their own KPIs in. We're not telling you which ones. It's not. We should not be prescriptive. So we've been very careful on that, and we want to make sure that. So if you want to say a green income fund, then it's your job to say why it's green. Not for our job to say that it has to be this way on a specific taxonomy, otherwise you're not green, because that's not fair to start with. And then secondly, I think it's really important that we're looking at other things to help, including ESG ratings and things in terms of how that is measured. It's not just about one thing on labelling, and it's all the other work that's going on. They're in parallel, but this is in place. But we're not asking too much, I think, in the beginning, but we'll wait till we get all that feedback, and then we'll even adjust it even more.
Great. We have another question from the audience here in the front row.
And while we go to the question, what's going to be interesting, and especially in the context to your question from FTSE Russell, right, with diversified portfolios, is around with all the best intentions, then finding the proof in the pudding, especially for things that you might not be able to control, and still find, and where this meets in the middle, right? That's exactly what I think a lot of the feedback was about. Certainly the ones that we gave, but that's being worked through, and it's non-trivial, right? But the important thing is, for now, that I feel that there's a dialogue going on, that that's not like just rejected as irrelevant, right? So.
Great, thanks.
Yeah, Sheila Bijiwe, Central Bank of Kenya, Deputy Governor. It's just on the standards. I sit on the Financial Stability Board for Africa, and I'm not really clear that we're really heard. So I think as we go forward, more attention needs to be given to those issues to make sure that when the standards come out, the views of all have been heard. And I think that also where Africa is on the green agenda is much more ahead than people know. So I think that more thought needs to be given to this issue as we move forward. Thank you.
Great, thanks very much for that.
Can I just say a
yeah,
quick response
please.
on that? So thank you very much. I think we will always make sure that we're listening to as many as we can, but we were quite heartened when Nigeria at COP27 came out and said they will be one of the first runners through of S1 and S2. But we've got much more work to do in Africa, there's no question about it, and we announced at COP as well quite a significant program of capacity building, which I think we can utilise then also as we continue to shape standards further once we have our networks and programs of work in place.
Great, thank you. I guess I would like to shift the discussion a bit, just given the time. I'll come to Marcus now. So as we've discussed in a few previous sessions, there's differing views on how central banks should be approaching the sustainable transition. I have a two-part question, I guess. So from your perspective, what role should central banks play? More of a lead by example or more of a standard setter, more actively? And the second question is, of the progress made by the subgroup on climate-related financial disclosures of the NGFS, what excites you the most happening there? Thank you.
Okay, thanks. So first of all, yeah, central banks should lead by example, but they should also do much more. And now I guess we're just talking about disclosures, not more broadly about how they are approaching climate change and sustainability. But I mean, another reason why central banks disclose, that's simply to answer to answer calls from the public about ensuring transparency about the central bank's activities, the functions, their relationships with the financial sector. Then disclosure also forces the central bank to into some discipline about learning about the different metrics and targets that are being used, and this could eventually help the central banks in fulfilling their financial stability mandates, because they're better able to assess the metrics being disclosed and different metrics. And then finally, I think central banks, and perhaps that's the, or I would actually think that this might be the most important contribution of central banks when disclosing. That is that central banks are, validating or vetting the different metrics and disclosure standards and so on from an impartial perspective. So many of the partners, people who engage in this debate, have an incentive one way or another way. It could be an asset manager that has to maximize the client's profits. It could be a green NGO that wants to do certain things for the climate. It could be other people. While central banks are a bit more neutral on this playing field here. They're like the referee. So that would be my answer to your first question. Then you also asked me what excites me the most about the subgroup within the NGFS that I'm chairing together with Liliana Geronimo from the Portuguese Central Bank. And well, first I would have to say the breadth of the people who are involved So we have 64 participants from 35 institutions, and these institutions cover the Southeast Asia, the Oceania, Africa, Europe, and both North and South America. So I think that's really great, and I think that's good in terms of ensuring that we have global disclosures, that there's interest about this globally. And then one other thing that I really like about this disclosure work here is that it really allows us to think holistically about how climate change impacts the economy. So central banks with the price stability mandate and the financial stability mandate, then essentially they have a role in ensuring a robust economy, broadly speaking. And the way that climate change will impact the central banks, that then matters for this goal. And so if central banks want to disclose holistically about the climate, then they should, then they need to sit down and think broadly about how the climate impacts the economy, and that has to be fit in a way that works into these disclosures. So it sort of it allows for broad thinking and taking an eagle's view of climate and the economy.
Great, thanks, Marcus. Are there any other audience questions? Otherwise, as we are coming to the end of the session, I think that I will just pose all of you the question. I think it was put quite nicely by Judson in the last session from the TNFD, that they are trying to take the climate playbook and use it in some senses for nature. I wonder, do you think that this is possible and desirable on social and governance considerations, going beyond the E in ESG, as the cliche phrase goes? How can we use the work that's been done on reporting, building transparency, mitigating risk, disclosures, quantifying all of these different metrics? How can we apply that to social and governance considerations? I'll start maybe with Sasha.
I shouldn't have sat next to you, should I? Yeah,
A hot seat.
But the word ESG has S and G in it, so let's not forget that. I mean, it's been there for a long time. So, and G, I mean, I'm a regulator. Do you think the most important things that we care about are the governance, accountability, the senior managers regime? How do you incentivize people? These things are already there. So this isn't all new stuff at all. So I think we've got to make sure that we remember that. Of course, some of the areas of S are probably the areas that we've probably got the newer areas, but it's not that new. And people are talking very much, and we've seen what's been happening with payments, supplier payments, health and safety, a lot of the diversity work and socioeconomic. So this is coming, and all we're after really is it's got to be important. And the people who are pushing it the most are the employees of the companies that work for. So let's remember that. When I speak to the chairman of companies, they are getting really big push about, I want to work for a company that I believe in. So the retention and training of engineers of an oil and gas company, they're not going to work for them if they don't believe that they've got a plan on this. So this stuff is coming, and of course it's been selling, and that's why we've had the products, and that's why we need to bring labelling. So I'm quite confident that this is just an evolution.
Great. Lee, do you have comments?
Thanks, Taylor, and just picking up on what Sasha then just said, I think it is a bit of an evolution. I think from a standard setting perspective, it's very clear that there is already demands in different ways to move outside of the E and to explore the S and the G. I think when it comes to the S, I've recently returned from Japan. There was a very strong sentiment about human capital being expressed there, and Sasha touched on this a little earlier as well. I think the only element I'd share is to say what we've done with S1 and S2, particularly S2 on climate, is not necessarily the blueprint of what we will do next. So, we need to think through what is the best approach, and we've got some fantastic intellectual capital that we acquired through the consolidation, both from integrated reporting and from the SASB in terms of all their great industry-specific disclosures as well. So I just say watch this space, but it will certainly be broader than E.
Great.
Yeah, I'm happy to. I'll make it short. I know we're almost out of time, but I think that it's clearly established that social elements are financially material, and obviously you could argue at some point that a lot of those elements that are, once you would establish that they're financially material, that they're actually part of good governance in the first place. Yeah. So, I mean, let's see where that goes. The only thing is where it's arguably going to be a little bit different, and I don't have a perfect answer, but in the social aspect is that you think about transition and physical risks. Like, think as an insurer, right? It's like a very scientific, more of a fact-based approach. Arguably, what's happening with the TNFD is going like quite into this direction from a process perspective. So you would ask a scientist in one area of the world about physical risk, and the scientists of the same profession in another part of the world, they'll probably give you the same answer. When it comes to social aspects, like the way cultures are built and the way societies are built, there could be a little bit of a difference, I guess, from region to region, which does not by any means that it's insignificant. It's very, very significant. So that's where I feel down the line it might be a little bit more tricky, which doesn't mean that it shouldn't be done, but that's a little bit my comment.
We need a whole extra hour to discuss all of the implications of that, but for now I'll just let Marcus, any final thoughts on this last question?
I mean, so I'll really perhaps just end where I started, so to say that, I mean, the key governance, hugely important. None of this is going to matter if you have a bad corporate culture.
Great. Short and sweet. Well, I think that concludes our panel. Thank you so much. And we are now going to a drink break. Yes? Okay. 15 minutes. And then we'll continue with the session moderated by Clive after this. Thank you.
just wait for everybody to top up with coffee for the afternoon session, and then we'll just kick off in a couple of seconds after that. Right, we have a quorum. Welcome to our afternoon session, ladies and gentlemen. Thank you for sticking around for this part of the day. What a good panel we just had before the break. I don't know if Sasha is still here, but I wanted to say that even dolphin-friendly soap can ease some pollutants, as I've had to tell my teenage son over the years. We have a panel now on the subject of impact investment, mobilising assets and portfolio management. I'm delighted to be joined by, I think I'm going to call it our super group, given that we all have microphones, a really diverse group of central banks. We have investors, we have banks, so really able to look at all sides of the capital equation here. And I'm joined by, to my immediate left, Sophie Joanni, who is head of investor relations at ILX Fund. Sophie, welcome. By Yuan Gao, who is vice president of fixed income, currencies and commodities at CICC UK. Welcome.
Thank you.
With Yvonne McCarthy, who is head of the climate change unit at the Central Bank of Ireland. Welcome, Yvonne. And with Michiel de Smet, who is sustainable investment expert at the National Bank of Belgium. We've talked a lot about frameworks today, so I'm going to just set a framework for this discussion on the topic of impact investment. This is a term that's been around for a long time. I remember probably first coming across it maybe 20 years ago in the world of wealth management. The idea being that, you know, wealthy people were giving away money in philanthropy, and their money could go further if they were to invest it for an impact. It's not necessarily always a term that we hear today as we talk about climate change, finance, transition to net zero. So to frame the discussion, I just wanted to ask each of the panelists what they consider the term impact investment to mean. And I'll just start on my left and go along. So, Sophie.
Just to give you a bit of a background, ILX is an Amsterdam-based asset manager, and we specialized in global development finance co-investment strategies, and more specifically in private credit investments. What we invested in, what we consider as being impact, is anything which would be SDG related. We have obviously also a large focus on climate finance. So anything which is SDG related that we can measure.
Thank you, Sophie. Yuan.
So just give everyone a bit background also about CICC, China International Capital Corporation. So we are basically the very first investment banks in China, and was originally founded in 1995, joint venture between Morgan Stanley and the China Construction Bank. Right now, we are basically largest shareholder is the Ministry of Finance of Chinese government. So what we try to achieve through this impact investment with Chinese characteristics is a responsible investment framework which covers, empowers innovation, and in the same time also we're trying to empower both the investors, the society, as well as the issuers to making impact which is aligned with the international standard of ESG. Right now we have this ESG as well as the original Rockefeller's philanthropy's idea of impact investment.
Thank you. Yvonne.
Thanks, Clive. I think we're all aware that impact investing is a very broad term. It encapsulates lots of things around having positive impact in addition to financial returns, but it's probably no surprise that in the central banking world right now there's so much focus on the climate aspect. And that's because climate change is such an existential threat that poses financial risks. And we all know that there is a need for the world to transition to a net zero state, and to do that it's going to require very significant investment. So from that perspective, there's no surprise that we talk a lot about impact investing in the context of climate change. That said, there is of course still room, and there's still growth in the other aspects of impact investment as well, around the social issues and sustainability more broadly. But I think the big question really is, how do you actually measure impact? And in that context, there's some interesting work, in the European context. ESMA recently published some proposed guidelines on fund names and kind of who can use the term impact investing and what it actually means. And in that context, they're proposing that impact investment actually needs to be assigned to
a quantifiable, measurable target. So if you're going to use the term impact investing in your fund name, then you need to be able to meet measurable targets aligned to that. And I think in that context, that's work that obviously the central banking community across Europe is very involved in, and also especially at the Central Bank of Ireland, we're very heavily involved in that. We chair the IMSE, the Investment Management Standing Committee, that's overseeing a lot of that work. So I think that's a question that we need to keep our mind focused on. How do you actually measure impact? And that's definitely a focus within Europe.
Thank you, Yvonne. And to you, Michiel.
Thank you. So we've already seen 3 different perspectives. I'd like to add a 4th one, which combines some of these elements. I like the definition by the Global Impact Investing Network, which says there have to be 3 elements. It's investing with the intention of positive social or environmental impact in a way that is measurable alongside financial returns. So it's intention, positive impact, and quantifiability. So in the case of climate change, that could range from grant capital, concessional capital, to deforestation, or to phase out coal, over smaller private allocations to social enterprises that innovate in renewable energy, down to listed climate solutions like green bonds investing in renewable energy.
I mean, do any of the panelists have any concern that other areas that require impact investing, education, healthcare, food, are slightly falling by the wayside here, or being left behind by the urgent need to deal with climate, or is this all interlinked and under the social banner as well?
Yeah, happy to go first. So I think it's fair to say that climate change, renewable energy, green bonds are high on the agenda. We also see a relative drop in the share of, if you look at thematic bonds, ESG bonds, of social bonds compared to green bonds, regardless of the absolute drop that we saw in 2022. However, having said that, especially in traditional impact investing, that investing into education, into health, into social housing, into reskilling people still is very much alive. Going forward, looking at social bonds, sustainability bonds, potentially sustainability-linked bonds, I think that is it's an interesting space to keep an eye on.
Anyone else on the panel with a view on that?
Well, I would say it's the same for ILX. We have a pretty broad view where climate is important, obviously, but we're looking at the SDGs in general, which would mean that our clients are looking for impact in 4 economic sectors principally, which would be energy access, clean energy, sustainable industry and infrastructure, and also inclusive finance and food security. So it's a broader sense. Obviously, as my colleague said here on the panel, there is a focus on climate, but it's general in a way that we're trying to align and have measurable positive impact in a broad area of the good, if you want to call it that way.
Yeah, well, there are a lot of aspects to this. There's going to be a poll going on during this panel. Those of you in the room probably know, hopefully now, how to do the poll. You'll have an app which you can download off the agenda or the booklet of the day, which allows you to vote. And those listening in or watching us online can vote by clicking a button on their screen. And the question is going to be quite a straightforward one. Should impact investors accept a lower return? We'll discuss the results of that a little bit later. Obviously, impact investment, it certainly started with people saying, well, I'd take a slightly lower return in order to make an impact. But I wonder whether that's the case now. Let's move on to the substance of this discussion. I'm going to come to you first, Michiel. I'm doing the research that all of us do by looking you up on LinkedIn. I saw that you describe your role thus: at the National Bank of Belgium, I focus on the financial system as a powerful force to address climate change, biodiversity loss, and other global challenges. So I just wanted to ask you, how do you think the financial system is doing?
I'll try to go around that question. First of all, yes, it's not just climate change. Going back to your earlier question, it's also about biodiversity loss. It's about social inequality. So it's important, as we saw in the previous sessions, that if we do finance projects, companies, that we understand how we address multiple challenges at the same time, or at least be aware of the trade-offs that might be there. Now, how's the financial sector doing? I think we need finance. They've got an important role to fulfill, and that is the entire spectrum of finance. grant making, traditional grant making, societal impact focused finance, concessional capital, traditional impact investing, all the way down to or up to traditional investing. It's encouraging to see that across that spectrum we see products emerge, we see impact funds emerge. I think it's time to accelerate now. So we've been testing certain products. Or we at least understand that they do have impact. Some of them have measurable impact. So where we have learned that a product in innovation works, let's then pick it up and accelerate it. And I think it's high time to do so. Give us a couple of examples of products that you think are working then. So if you go to listed products, think about labeled green bonds, ICMA-aligned bonds, Climate Bonds Initiative, in future potentially the EU Green Bond Standard. Understanding how the proceeds are being used, understanding how they've been selected, how they've been reported afterwards, how the proceeds have been allocated, so getting a certain guarantee that the proceeds have been used for certain causes. Say, for example, energy efficiency, renewable energy capacity. I think that would be an innovation where you're like, yes, this works. Let's understand how we can scale this. On the other hand, we look at sustainability-linked bonds. In principle, in theory, great innovation. In the past few months, we've seen there still are a few bumps, as we called it in the previous session, and that's fine. I think that's a sector that's maturing. So let's understand what works, what types of indicators, KPIs we use, what the step-up could be. And then take those learnings with us and well, take that sector as well further.
Thank you, Michiel. Maybe Yvonne, you could just explain to us a little bit about the mandate of the climate change unit at the Central Bank of Ireland, and then also talk about some of the stuff that Michiel was just talking about, in terms of what you see in terms of what's working and what's not.
Sure. Well, in the central banking world, we'll all be quite familiar with the fact that climate change has moved very high onto the agenda in the central banking world in recent years. And at the Central Bank of Ireland, the way that we've taken a strategic approach to climate change, dealing with the challenge that is climate change, is very much a strategic focus for us. And so we established a new climate change unit just over a year ago, really, just to, I suppose, drive forward the central bank's ambition in relation to that. And what we mean by that is we want to get to a space where we're incorporating climate change considerations into every aspect of our business. So we want it to become part of our DNA. And at Central Bank of Ireland, we have a very broad mandate. Our job is to ensure that the financial system is safe and sound, that we've got financial stability, that we support monetary stability, but also we have a conduct mandate, which is very important in this space. So it's about ensuring that the financial system works in the best interests of consumers and investors and the wider society. So in that context, a couple of key priorities for us are around incorporating climate change considerations into our supervisory activities across all sectors, to make sure that financial firms are actually embedding climate change into their own operations and taking the task seriously. And of course also that we're working to build capacity, not just within the central bank, but also across industry. And in that context, we established a cross-industry forum where we bring together sectors, representatives from across the financial sector in Ireland with climate experts and ourselves, because we recognise that capacity building is so important to tackle this challenge, not just for ourselves, but also across the financial system. So I think that's just to give you a flavour of some of the things we're talking about and some of the things that we're doing. I'm very happy to pick up on any of those later. But I think in terms of, the financial system and talking to some of the points that Michiel's making, I mean, I would say that we are seeing now a real embedding of climate change considerations into, and ESG considerations into the financial system. I think that's very promising. In the European setup in particular, we know that there's a very substantial body of work around developing a sustainable finance framework, which actually provides the architecture off which to hang all of the other pieces of the product development and all the work that goes with that. But at the same time, we're now moving into a different phase, which is a little bit more about review and testing the system rather than the products. Actually making sure that the system that we've designed as it's currently working, that it's actually usable, that it's actually designed to be fit for purpose. And in that context, the European Commission, it has its version 2 of its sustainable finance platform kicking off. And a big part of what they will be looking at is taking feedback and bringing that feedback to the Commission about the usability of the sustainable finance framework in Europe and the work that needs to happen to increase the efforts, because, again, it's really positive to see so much development, but as I mentioned earlier, and as so many people have mentioned today, the scale of investment that's needed here is enormous. So, the financial system is tackling the challenge, and products are emerging to tackle that challenge, but it's nowhere near where we need to be, and we have quite a path ahead.
And the version 2 you described, do you think that will be a big step forward, or will we have to wait for version 3, version 4 before we get to the point where we're all happy with how that actual product side of things is actually coming along?
Yeah, I think things are developing very quickly here. They have, if you'd asked me this 10 years ago, I wouldn't have expected us to be where we are today in this context. So I think it holds a lot of promise, and I think that the mandate is right. The kind of focus of version 2 is right at this juncture. But in terms of, you might want to talk later about green product development a little bit more, so maybe I won't get into it now.
I just wanted to ask if you can answer this. You talked about sort of encouraging members of the financial services sector in Ireland to adopt certain practices and principles. What do you do if they're reluctant or they're falling behind? What's the role of the central bank then?
Yeah, so as a regulatory authority, of course, we have enforcement powers, and we actively use those enforcement powers if we observe that the financial system is not operating in compliance with the regulations as they are laid down. Of course, we're in a very new space when it comes to climate change and sustainable finance, and we really are still in very early stages of implementation, if I'm to put it that way. So if you take an example, SFDR, Sustainable Finance Disclosure Regulation, for example, level 1 in place for just over a year now, we have been doing supervisory work at the Central Bank of Ireland across the funds industry, for example, to look very closely at how funds are responding to SFDR. Are they meeting the requirements of the regulations? And what's really important in that context is that we actually communicate with the funds industry, with the general industry, not just on our expectations, but also on what we're finding. So there has been a process of communicating our expectations, undertaking thematic specific SFDR type supervisory investigations, and just last November we held an event where we talked about some of the findings from that work, and it is important in that context that we share examples of best practice and that we use those examples to propel further learnings and work in that space. But of course in time, as I said, it's very early stages yet, and the regulations are still going through phased implementation stages, so it's still very early until the whole framework is in place to really talk about these issues in great detail.
Thanks, Yvonne. Johan, I want to go to the specific role of an investment bank in a second, but just to sort of continue this discussion about how's the financial system doing. What's your perspective on that?
That's a tough question, considering I think I'm the only speaker from a Chinese institution today, probably also including tomorrow's session. So what I want to highlight is I just traveled back from China last week for a 2-week business trip. And what I have seen is very promising. The recovery is very fast. And China has really paid huge attention to this sustainable investment, ESG, as well as green bonds area. We'll go to that later. But giving you a few examples, some data. So in 2016, the whole issuance of green bonds in Chinese market is less than 50 billion Chinese yuan. And guess what's the amount of last year by the end? It's over 850 billion. So it's more than 10 times over the 6 years. And unfortunately, CICC was a leading underwriter of over 20% of those amounts, which is a privilege. But in the same time, we do realize the popularity of all these sustainable-linked products, as well as green bonds, blue bonds even. They are all very popular among investors in China. And the whole market right now, so as we come to Mikhail's point, is about how we link the measurable, quantitative measurable measures, as well as how the two different systems, because as we look into the G20 countries, each country has its own merit is each country has its own specific economic characteristics, and how we really link those together is really require a bit more framework from international global vision. And how that's achieved? So China now is co-chair the G20 Sustainable Framework Working Group with the other power, and the G20 Framework for Transition Finance is also undergoing, which making huge progress. And the last year, in 29th of July, China published, the government published the China Green Bond Principles. And these, what I want to highlight here is that these principles share the exactly same 4 core components of EU Commission's Green Bond Principles. And that's fully aligned. And one of the focal points of that principles is the use of proceeds, and which was not 100% in the green area, in the sustainable linked area before. And this alignment between China and the EU's green bond principle really bring the not only government bonds, policy bank bonds, local government bonds, 100% of UOP use of proceeds, but also the China corporate bonds become 100% UOP as well. The only remaining is enterprise bond, which supervised by NDRC is going to merge into also going on the way to 100% with a new 2 sessions just finished in China in March. So that's give you some idea about how the Chinese in China, the market is doing and how the system is doing. It's a top-down process. So it has PBOC, the central government, the central bank, sorry, and it also has a number of regulatory bodies. So with the recent 2 sessions, is undergoing some reform. So I can't comment too much on that. It's not there yet. But from a market players' perspective, what we see from both issuer side as well as those green projects and investor sides, this area is booming.
Let's come to that issuer-investor relationship in a minute. Mikhail, I'll just bring you in.
Yeah, I wanted to give an idea of the size of the scale. So as Yuan was saying, green bond principles, whether in China, whether in Europe, other jurisdictions are maturing. Taxonomy is maturing. We might come to that. There's a common ground taxonomy, which combines elements from Chinese taxonomy, EU, other jurisdictions. So as those building blocks are being laid, it actually is time to scale now. If you look at the fossil fuel banking versus renewable energy banking ratio in terms of how much money is being spent on financing from a banking point of view, but also from an investment point of view, we should be at 1 to 4. To be clear, 1 fossil fuel, 4 renewable energy, and at the moment we're standing at 1 to 1. So if we want to move towards net zero by 2050, we drastically need to increase that one. So as those building blocks are there, it really is time to redirect those capital flows and get those numbers higher. So that's roughly the bit of the scale of the challenge that we're facing.
Thanks, Miguel. I'm going to come to Sophie now, because I think what ILX is doing is very, very interesting in terms of mobilising assets. And it's in a particular space with a particular group of investors at the moment. Maybe you could talk us through a little bit about what ILX is doing, Sophie.
Sure. As I said, we invest primarily in global development finance co-investment strategy. So we invest in UN SDGs and climate finance focused private credit instruments in emerging market. And we invest alongside MDBs and DFIs. I just want to give a bit of an overall view of the market to understand why we invest there and why it's so important to mobilize assets towards that kind of new asset class. First, in terms of emerging market, which is the market we focus on, we definitely believe if we focus on climate, that the fight against climate change is going to have to be focused quite a lot on emerging market. Emerging market and development economies account for 2/3 of the greenhouse gas emissions, and many are highly vulnerable to various hazards. So there is 2 issues for emerging market. The first one is the transition, and the second one is the adaptation. How do they adapt to the physical effect of climate change? And that implementation is going to have to be accelerated. But it's also going to have to be in a way where it does not disturb the economic and social interest of the people that are firsthand impacted. And if you look at the financing need to achieve that in emerging markets. It's estimated by various entities to be at about 4.2 trillion annually. And meanwhile, you compare that with the official development finance amount of money which is there to support the emerging markets. It's limited to about 160 billion. So there is a massive gap here. And the only way to fill that gap is to look at the assets under management of the pension funds. If you just give you an idea, the pension funds, the 20 largest pension funds run about 20 trillion. So this money has to be somehow channeled towards emerging market. There's been a lot of interest of pension funds to invest in emerging market, to invest in sustainability. However, if you look at the capital market, to go back to your question, if you look at the capital markets of these local economy, most of them, the only way to invest is via tradable and listed securities. And that being said, it's not in all the critical sectors, and it's not necessarily easy to have a measurable impact when you invest that way. So when there is not a well-functioning capital market, and some of these markets actually do not have one at all, the role of the MDBs, which historically have been there where the private sector has not been, is really critical. They can work to deepen that local capital market. They can create kind of a conducive business environment for private investors to come in, being catalytic to come in with them. And that comes to the crux of what ILX does, in a way that we are the linchpin between the MDBs that have a local presence, a deep knowledge. They also have ESG safeguardings. They have all kinds of data and experience in those local markets. And then at the same time, ILX is offering a scalable product for these pension funds because they cannot invest at the small project level with the MDBs. So we offer to them the ability to invest at a scale with a very diversified portfolio across sector, across industries, across countries, across regions, with accurate returns. We'll talk about that later, the returns. And also with data transparency, we report on everything. And I think that's the key, is that the pension fund money wants to go and help, but there is no conduit to it. And in some ways, ILX is offering one of these conduits. I'm sure there are others out there, but this is one of the conduits where we invest along the MDBs in order to rely on their experience and their market setting in terms of impact that they have done over the years.
So from your point of view, if we think about agents of mobilization, pension funds have to be at the top of the list, do they?
They definitely have to be at the top of the list. Obviously, there are other pools of capitals. In terms of the private pools of capitals, you have sovereign wealth fund that you would classify slightly differently. You have the banks, you have the private banks, but the pension funds in general, some of the largest pension funds are our clients, are always leading the way in terms of trying to create a new asset class. This development finance asset class would be new, and the pension funds are always a bit ahead of time, especially in Europe and especially in the Nordics and in the Netherlands.
Thank you. I mean, Johan, in terms of your role as an investment bank, how do you see the investor group that effectively funding these markets? How do you see that developing at the moment?
I want to bring a bit of color of the comparison between the world, basically developed markets and emerging markets. So developed markets, as Sophie mentioned the pension contribute a lot. It's over $20 trillion asset under management. But like developing markets like China, the pension is big, but the market is not that big at all because most of the assets are holding in banks. So that's a special, clear difference lies there. But with a demographic aging populations also in Asia, not only China, but Japan and South Korea, etc. So the pension industry in China is also going to under a reform in future, in very near future, which is more will bring the pension industry more closely to what we have here. But still, it's different. It's 1.4 billion population. So it's not the same scale, and it's not the same distribution as well. So, but in the same time, from our asset owner in mainland China, right now, how CICC helping with this space is through major three perspectives. One is we try to help with financing. So if there is a construction project which has a sustainable link, we can help as an investment bank for financing. If there is a small, medium-term businesses which also has a sustainable ESG link, particular climate link, what we can do, we can directly invest in those projects based using CICC capital. So we have 7 pillars to base. So the 7 pillars including equity, fixed income, wealth management, investment bank, asset management, and CICC capital, which is a private equity type of business. And we also have the 7th pillar from last year end, which is international. It's also addressing some of our priorities going forward. It's not only look at China, it's beyond China. Because what we see is environment and climate, they are public goods globally. They are not just for developed world or emerging markets, not only just for Europe or Asia, but also Africa, and also South America. So we need to think all this holistically from a top-down perspective. Also, in the same time, we need to understand the local market. So it's ultimately, with all the regulations, with all this taxonomy aligned with the framework set up, it's still a people-to-people business. We need to understand our customer, not only by looking at news, reading news, looking at television, TikTok, YouTube. We need to talk to people locally. So that's why I'm here in London, talking to everyone here. Because what we really want to hear is how our clients, central banks, investors, what's your concern about investing in China and what we can help? And what's your concern about Chinese investors here and what we can help? So those are different ways of services we are currently working on. And it's a different system, but ultimately the trades still going on. From a commodity space, we can see most of the trades, even with this deglobalization, the trades are recovered really fast with all this post-COVID recovery. So I do encourage here everyone, like, if you are interested, come to me later and let me know what's your thoughts about China. And if you're interested, happy to have further conversations.
Sure, plenty will take you up on that, Yuan. Just on this subject of mobilising assets and the drivers of that mobilisation, Yvonne, what are your thoughts on that?
Well, from a central banking perspective, I think we look at this from a different lens, which is that firstly, I suppose we play a very important role in making sure that can happen. But what I mean by that is that it's our job to make sure that the financial system is actually resilient to the risks posed by climate change, so that it's actually capable then of being ready to support that transition. So I think that's one aspect to that in terms of mobilising the assets. We have quite a big job to do there, and we heard about some of that work earlier on today when we heard about stress testing approaches and the like. So I'm not going to repeat it now, but that would be one aspect. I think also from a central banking perspective or a regulatory perspective, it's important that we support innovation, because this is a very new space, and perhaps a lot of the products that will actually mobilise assets are already in existence, but perhaps they're not. So we have to be able to support innovation and actually test and learn what works and what doesn't. And in that context, access to sandboxes and the like, we have one at the Central Bank of Ireland, but they're really important. It's a really important part of the puzzle, I think. And then finally, I think that asset mobilisation, what's really critical here is that there is a sustainable finance framework, that there is clarity on what we mean by green assets. And that's why all of the work that we're hearing about across the whole day so far around globally the approaches that are being taken to define what is green, what's not green, what are green products, what kind of criteria do they need to meet. All of that work is still at a very early stage, of course it is, but it's critical, because without that, assets may be mobilised, but perhaps not in the right direction.
What direction might they be sent in then?
Well, I think it's more, thinking about the risks of greenwashing, in the context, and there's obviously a lot of discussion about greenwashing now, and there has been over recent years, and I think in that context, as a regulator, as a central banker, we see greenwashing as a very sizable potential significant risk that could damage things significantly. Because if you think about what greenwashing is, it's a form of mis-selling. So of course it's harmful for consumers and investors generally. If somebody is being sold a product that doesn't accurately reflect the underlying sustainability characteristics, if they're kind of misperceived perceptions about what a product actually is, and that's very worrying. But I think what's also worrying is the fact that greenwashing in and of itself, can undermine the development of the sustainable finance market, can undermine asset allocation if it becomes a problem. And I think we need to be really alive to that issue. And in that context, again, it's something we take very seriously at Central Bank of Ireland. We have a whole suite of work underway around looking at the existing architecture that exists. Like I mentioned, the SFDR, the Sustainable Finance Disclosure Regulation. That type of regulation has been designed in ways to prevent the problem that is greenwashing, by putting clarity to what we mean by green, by putting clarity to what kind of a fund, for example, can classify itself as green. So we have a body of work underway to actually look at those issues and assess whether funds, for example, are truly green when they say they are. But I think more broadly, beyond that, in a European context, if you can forgive me for speaking about Europe again, the European supervisory authorities have all been mandated by the European Commission to consider the topic that is greenwashing. They've been mandated to actually look at the issue, come up with examples, to take feedback, to publish consultations and the like, and that's a process that's ongoing at the moment. And there will be an interim report published around May of this year, and then a final report about a year later that's going to call out all of these issues around greenwashing. What does it look like? Why are we concerned about it? What does it look like? To what extent does the existing framework perhaps even present opportunity for greenwashing? To what extent does the existing regulatory framework potentially, to what extent is it sufficient to prevent greenwashing? All those kind of issues are going to be tackled. So it's a very alive debate. It's a very, pressing issue, and it's something that there's a lot more to come on over the coming year.
And as we heard in the panel just now, I mean, even issues like the terminology, like people don't understand what stewardship means. These are complex issues that need to be solved quickly. Michiel, we've opened the greenwashing tin, so let's dive straight in.
Yes, thank you, and I'm very happy to complement Ivana's comments here. So I'll be talking from an own reserve management point of view. I'm part of the investment team that looks after our non-monetary policy portfolios. So I'm not talking about monetary policy nor about supervision, but it's a similar story there. So why do we look into sustainable and responsible investment? I think the reasons are twofold. On the one hand, we want to anticipate ESG-related risks that could be of reputational nature, obviously, but also could be climate risks, as we've been discussing earlier today, transition risks, physical risks. And then the other side, or the other reason, would be supporting that transition. And as Yvonne was explaining as well, you want to do a proper job in order to support the transition towards a net zero economy. Examples of how that is then implemented at the National Bank of Belgium is, for example, the climate-related disclosures, which we will be doing in the context of the Eurosystem. European Central Bank President Lagarde announced this earlier this week, so over the coming days and weeks you'll see more disclosures coming from Eurosystem central banks, including the National Bank of Belgium. And then we'll also be making public announcements about our sustainable and responsible investment strategy. And I think that nicely links to being transparent, mentioning what labels you expect, how you go about exclusion, how you go about investing in green bonds, how you go about disclosure and building that trust, as we've been discussing before. And I think, well, going back to the question on greenwashing, it's through that transparency, through referring to international frameworks, well-known concepts, explaining it, that you build that trust and can mitigate the risk of greenwashing or being accused of greenwashing.
And yet for all the coordination and trying to have established standards. I mean, at ONFIF we do quite a lot of work with emerging market sovereigns thinking about doing GSS bond programs. We had a big issuer from Central Eastern Europe visit us to meet a large group of investors a couple of weeks ago before they do their program. And obviously they're taking their lead from a certain taxonomy, but it's also their own taxonomy. And then the investors talk about, well, you know, there's another 300-page taxonomy that we not only have to read, but we have to follow. How do we solve for that? It's a real issue, isn't it?
It is. Hence the importance of international cooperation, and that seems a bit of an open door, but as mentioned before, look at the taxonomies. There's the EU taxonomy well underway, huge effort as in other jurisdictions. China has its taxonomy, so now there's the International Platform on Sustainable Finance that tries to find common ground, and it's called the Common Ground Taxonomy. So that would be an example of an effort where you try to understand where there's overlap and hence facilitate investors or other stakeholders to come in and ease the job for them. At the same time, as we've discussed from a standards point of view, but also from a topical point of view, like biodiversity, the local aspect can't be ignored. So for some of these standards or frameworks, one has to differentiate across sectors and across geographies, and that's the reality. So that makes it more complex, but I think we'll have to live with it.
Please speak on this. I think it's quite interesting, China. Playing devil's advocate slightly, but I can remember when green bonds were kicking off in China, we'd see big Chinese banks doing $3 billion green bonds, and it wasn't entirely certain where that money might be applied. It seems like that market has developed and grown and matured. Yes. Perhaps you can speak quickly to that, but also one of the things people say about the Chinese market, we talk about transition and whether there's actually a taxonomy and a framework for transition finance in China, or whether that's coming along.
That's exactly the question I want to answer. Thank you very much. So I want to record about what Mikhail just said about common grounds taxonomy between the EU and China. So these common grounds is actually literally between China and the EU. And by the end of last year, according to the data from PBOC, the Central Bank of China, 80% of these two taxonomies has already harmonized, so which means they can explain each other, so which is a huge leapfrog from where we are 2 years ago, since this common ground was published in 2021. And on the other side of this green bond market, I already gave a number of how fast it has been growing over the last few years, 6 years. And even, let's give you an example, even during the COVID restriction period of China last year, before we lift all the restrictions, in October month last year, a single month, we helped Guangdong provincial government, Hainan provincial government, Shenzhen municipal government issued 3 offshore bonds. Each of that is no less than 3 billion Chinese yuan globally. So that was how actually the market is still growing. It's not always on the news, and it's not always reported here by the local media here because of the language, because of the focus, but the market itself has been growing really fast. So the first half of 2022, we have CICC, a single investment bank, has helped issuing 33 green bonds in China and abroad, so which is mainly focused on Chinese issuers. So that is growing fast. And what we look at is going forward with this aligned taxonomy, why can't we align the investors here more to Chinese issuers? Why can't we align more Chinese investors to the issuers here? I think we think there will be huge, not only for good for the disclosure, because the more we understand each other, the more transparency and the more trust build, and the disclosure become much more easier, because disclosure always a subsequent step based on trust. But also in the same time, from asset allocation perspective, it also brings in a very good differentiator, which is very small correlation between these two markets, as the big economic cycles are not really synchronized between emerging market and the developed market.
So I'm sure everyone in this room would be happy if China was more part of the international market and became part of the global market. I'll come to the floor for some questions in a second. So if you just on this topic of greenwashing, your views on that. I suppose the loans that you're looking at from the NDBs are pretty well qualified when you look at them. It's not too hard to know whether they fit the frameworks or standards or not.
That's right. I mean, they've been in the space for decades. They've been setting up standards and applying those standards for decades, and we are relying on those standards and reporting it back to our investors. I think there is two sets of issues here in terms of data. It's data that you have to report on the sustainability side, but there is also data on the return side, which is, I think, linking more to something that you're going to talk about later. So I'll hold on for that.
Okay, will do. Any questions from the floor at this stage? Do pop up your hand. Yeah, we have one right at the front here, please.
Hi there, Christopher Marchant, Net Zero Investor. I know this topic's been discussed a little bit at this panel and the previous panel as well, but looking at something like SDR or SFDR, is this going to be helpful to impact investment, or is it going to be a complication due to issues like overly broad categorization?
Who would like to take that on? Yvonne.
Yeah, happy to take it. I think, you need to have some sort of framework. You need to have something to actually aspire to or compare yourself to or whatever. And I think the important thing is that none of the regulatory, the kind of categorizations that are either under development right now, let's say in the European session, or ones that are already in existence are compulsory, right? So it's not the case that you have to be an Article 8 or an Article 9. You can opt out of those and be something different under SFDR, for example. But I think, it provides a framework to aspire to if you want to be in that market and you want to be categorized as dark green or light green or however. So I think, look, you need to have something. That's the first point. The second point is that, as I mentioned at the outset, there is a framework now within which there's a review and testing phase happening, and I think that piece is really important. There has been a lot of feedback on something like SFDR and Commission responses were talked about earlier on, European Commission responses, some questions on the SFDR. Similarly, when we talk about the EU taxonomy, there's questions and answers documents that could be quite helpful to illuminate on some of the issues that are outstanding in that space. But I think that the main thing is that we are in a moment of learning, we're in a moment of reviewing and testing, and the changes are still possible. And the taxonomy, the EU taxonomy, for example, off of which a lot of the further regulatory architecture is built in Europe, is well known to be a live document. It's well known to be something that market participants are asked to respond to on a regular basis. For example, if you have an economic activity that's not currently categorized in the EU taxonomy, there is a space within which you can, report on that and make a case to say that you think it should be part of the taxonomy or explain your experience or whatever. So I think that that's the main thing to say there, is that we need to have something to aspire to. We need to have a framework. There is no kind of push for you to be one thing or another thing, but certainly it's important that we keep a close eye on developments, that we continue to learn and review and improve, and that, as I mentioned earlier as well, is the next phase where there will be that opportunity as well within the sustainable finance, the platform on sustainable finance, for that feedback loop to happen and for further efforts to be made.
Thanks, well, I've already had the 10-minute warning sign flashed at me, so I know there are trains to be called at the end of this. So do we have the results of our poll? And we'll come to that. Should impact investors have to accept a lower return? 83% no. What do your investors want from this, Sophie?
They want a market equivalent risk-adjusted return, and there is no reason to accept a lower return for impact. The reality of our clients, who are, again, large pension funds in Europe, is that their core mission is to provide long-term financial stability for their retiree or their shareholders. And for them, they need that market equivalent risk-adjusted return. And in order to determine this, they need to be able to assess the risk. And again, it comes to one of your prior questions, it's what could be the role of the MDBs here? The MDBs and the DFIs have a key role to play here in terms of providing the data. These entities have decades of experience. They are seated on a huge amount of market data. And it started to come out. There is the GEMS database, which is the Global Emerging Market Risk Database Consortium, which has published a lot of the data on an aggregated basis, whether it's default rates of portfolio, but the recovery rates were not included. And that's something which is going to be very important if we want to mobilize capital of private investors, because there is a very big gap between the perceived risk and the actual risk in emerging market and in certain asset class, in ours particularly. There is a very big gap in terms of that. If you look at the history today in private investors' portfolio, infrastructure debt is a normal asset that they all hold. 10 years ago, or 10, 15 years ago, it was not the case. And what was the key change here was Moody's that came out and published all the data in terms of the default rate, the recovery rate. And that's exactly what needs to be done. More disclosures in terms of data so that investors can understand the risk, price the risk, accept the return, which is currently out there, which is a market equivalent return. They do not have to accept a lower return, and our investors do not accept a lower return. They want a normal return with impact.
One of the products that you mentioned earlier, Michiel, that's sort of starting to have some traction, particularly in Latin America, strangely, is the KPI-linked bond programs, which says basically that investors should get a lower return if the issuer reaches certain targets and goals, effectively, because the coupon will go down according to how they do. Is that a product that can sort of supercharge this market? I mean, we've talked about 4.2 trillion a year. We've talked about ILX sort of, you know, having $1 billion fund, but there's a lot of ILXs needed to meet the need. What is something like a KPI-linked market the way to go forward here?
So I think, well, we've got 5 minutes left. Discussion would last much longer. Just a few thoughts. So in theory, this sounds great because you align incentives, assuming that you put out the right KPIs, as we've been discussing, material KPIs for the business and the geography that you're active in. So in principle, yes, but then there might be some ethical concerns, as an investor, you get rewarded for failure on important topics, which on the one hand makes sense from a risk-return point of view, but equally you're incentivized for your investee company to fail. So there's a few elements there. But it does come back to what Sophie said on risk-return, and to get to the more formal question here, I'd agree with the no, knowing that there is a spectrum. So for most of the institutional investors or the sovereign wealth funds and the pension funds, I'd say there is investment opportunities. There are investment opportunities out there where from a risk-return point of view it makes sense. However, if you start shifting towards that concessional capital, if you look at philanthropic money or money public money that might come, for example, from carbon pricing, you might want to allocate part of that money for more innovative, more risky ventures, where you actually are willing to take high risk, potentially with lower return, but then you do so because of the societal impact. So that's that spectrum from focusing on financial impact within impact finance going to societal impact. So I think it's the story is more nuanced, but in general, I'd say no, you shouldn't accept a lower risk-adjusted return.
Okay, thank you, Michiel. Johan.
Yeah, I just want to add a bit in a couple of minutes' time, try to manage that. So this question is, I think this question itself brings in a dilemma of investment. Why is that? Because if we come back to the original idea of impact investment, actually on one side is actually charity. On the other side is investment for profit. And then in the between there is impact investment, and there is also sustainable investment. So there is actually a bit of gray area for us to say whether it's pure for profit, whether it's pure for return, or it's actual for charity, or for charitable purpose, philanthropic purpose. And also another perspective I want to bring into this question when we think about this is that when we talk about the low return, it's low return for how long? Because 2 years ago, we are in a zero interest environment. We were talking about how many times Fed needs to raise hike, right? So, but before, and that's how the private sector infrastructure investment, private debt, basically insurance-linked securities basically booming because we have an extremely low interest rate environment before. But now look at us, right? Where we are last year, yields almost skyrocketed to 5% for a couple of days, right? So right now what we look at is whether this impact of not only charitable, but also sometimes it's social, society, and for common goods can justify for longer higher return rather than for shorter higher return or longer lower return. So that's something I want to add to this question, because I do feel this question has been asked a lot, most frequent questions about impact investment, but the perspective to look at this question is really making more sense to me.
I think we're almost out of time, so Yvonne, I'm going to come to you for the final word on this.
It's probably, I mean, it's not really, a central bank doesn't overly take a view on whether impact investors, should accept a lower return or not. But what I would say is that, if you look at the research on, green financial assets and the general return, it's pretty mixed, right? So I don't think it's a given. That's my personal perspective, that this, even if there is an incentive or an impact investor is willing to accept a lower return, I just don't think it's a given. And certainly, during the COVID years, there was evidence that green financial investments did better. And I know, there just very recently, there was a reflection on German bonds, for example, and I think the green German government bond was trading more favorably than the conventional government bond. So I don't think. Just my personal perspective is I'm not convinced that is a given scenario, and there's evidence to suggest otherwise.
If we got into the famous greenium argument, we might be here for some time, but unfortunately we're running out of it. So what a shame we can't delve further, but what a very good discussion this has been. In a moment on the stage, we're going to have Alice Carr, who's Director of Public Policy at GFANZ, with Emma McGarthy from OMFIF. But everybody who's here and everyone online, please put your hands together for a fantastic panel. Thank you so much for that discussion. Emma, over to you.
Thank you to our last panel. That was a really fantastic conversation. So as Clive said, I'm joined now by Alice Carr, who is Executive Director of Public Policy at the Glasgow Financial Alliance for Net Zero, or GFANZ as we will call it from now on. So Alice, we've obviously had a lot today from central banks in terms of all the various activities that they're implementing into their different activities and how they're looking at climate. Your background before GFANZ has obviously very extensively been in central banks. So how would you assess progress over the last few decades or the last decade, and where do you think central banks should focus now in the run-up to 2030?
Thanks very much, and thanks very much for having me. It's great to be here. And I know that I'm the only thing that stands between everyone and drinks, so sorry about that. Nonetheless, so I have a couple of decades background in central banking, mainly in financial stability and crisis management. and then increasingly on the international policy side, and now with a very much a climate focus. And so my reflections today are kind of, drawing on my personal experience over that period. I mean, we've obviously come a huge way in the last kind of decade. As early as 2006, we had the seminal Nick Stern report, which made it quite clear that the economic effects of climate change were going to be significant. And I think after that, we've sort of seen a gentle nudging up of ambition on this topic. And in the mid 2010s, I think it was fairly transformative. And I'm not saying this just because he's my boss. That Mark Carney spoke about the tragedy of the horizon and the kind of challenge that we were facing that was at that time most evident for the insurance sector. But that was around the time that we began to use this kind of common terminology around physical risk, transition risk. These are the kind of measures of risk that we're still looking at today. And then we, of course, saw this building commitment from central banks and regulators with the founding of the NGFS, work on the TCFD, which was, recognition that climate risk is financial risk and that it needed to be measured and disclosed and so that investors could take it into account. And you'll have heard today that central banks are active, and the NGFS started with just a few members, and is well north of 100 members these days. But many central banks are working across their full operations, so they're looking at the risks to the banking system, in the insurance sector. They're looking at macro-prudential risks. They are thinking about their own market operations and how to take account of climate risk there. They also, increasingly thinking about the economic effects of climate change, or I think that's an area for further work, and has tended to lag the more financial side of things. And so we've got to the position, I think, where central banks are cognizant that this is a building risk, that it's relevant to macroeconomic outcomes, it's relevant to financial stability outcomes, and as such, it's well within their mandates to be thinking about these challenges. But the question then is, what should one do next? And I guess the thing for me that's important is we don't have very long left to 2030, and we know that the emissions reductions we need to achieve by then are really significant. We saw with the IPCC report earlier this week that we're not on track. So we faced, either a scenario where we fail to do what's needed and the implications are quite severe, or we have to quite quickly step up our policy efforts, and that's all kinds of policy, government policy. Almost every government department has a role to play. Central banks, regulators, private sector, everybody. And we really work together to try and do what we need to do. And so I think for me, the most useful area of focus in the next phase would be exactly that, kind of what is it we're going to do about the risk that we've started to identify? And I guess, with some perspective, having had a kind of year or so out of central banking, I think we'd be well served in pivoting to risk mitigation, even though we haven't perfectly sized the risks, and there's much more work to do on scenario analysis, which is a super useful tool. Nonetheless, if we wait until we have perfection there in terms of risk identification, it's going to be too late to mitigate the risks. So I would recommend that we kind of collectively pivot to the mitigation piece now.
Yeah, one of the things that we were talking about earlier on when we were talking about scenario analysis tools is the difficulty of implementing macro considerations and how kind of that is not necessarily being factored in properly into stress testing tools. Bit of a challenging question maybe, but moving forward now, how specifically can central banks enact that, and what can we do over the next kind of 7 years? What can central banks do in the next 7 years to work and to integrate that into what they're doing?
So here I would suggest, actually, just as we did with TCFD, I think the private sector has a useful role to play here, because I think you know, to an extent that isn't always apparent, I think the private sector has kind of moved to thinking quite hard about risk mitigation. And you know, at least in the case of GFAN's member firms, we have, you know, we're sort of founded under the UK COP presidency. And of course, therefore, we have a really good representation of UK firms in the 7 sectoral alliances that make up the kind of GFAN's family. All of those financial institutions, of which there are now more than 550, and they account for more than 40, or around 40% of global private finance by assets, have actually made quite strong commitments in that they've committed to supporting the transition to net zero across all scopes for their activities by 2050, in line with 1.5 science-based pathways with low or no overshoot. And as a result, they're kind of moving through a cycle of setting targets to deliver on those commitments, and then undertaking transition planning. And the thing about transition planning is, you know, it's kind of difficult and imperfect, and I'm not going to pretend that we're anywhere close to anyone doing it well. But the thing is that once you start to do transition planning, it kind of makes you engage with what are the sectoral pathways for the sectors that I'm financing, how far is public policy doing what I need it to do, how far are corporates doing what I need them to do, what are the barriers, how are we going to get them addressed in a timely way, et cetera, and it's actually a really important discipline for thinking about, you know, more specifically about how we get to 2030. And so I think that process is generating a lot of information increasingly about, you know, what steps will be taken in the, you know, and what changes will be wrought across the economy and the financial system in the period up to 2030 if we are going to get anywhere close to the kind of emissions reductions needed. And so you can kind of get a picture of, you know, what needs to happen to the energy system, you know, what kind of transformations do we need to see in transport, in cement, in steel, in all of these different economic sectors. From that, you can start to look at, you know, what's going to happen across all of the economic variables that you would normally worry about as a central bank. But I think it also is really important to think about transition because it, you know, these changes are going to take place over the balance sheets of financial institutions. And so I think it's really important to understand like what benefits this transition is bringing in terms of risk mitigation, because it is fundamentally the only way to mitigate the risks in any sort of conclusive way. And, you know, secondly, you need to understand these changes because they're going to become greater and greater through time unless we completely fail in our objectives, in which case you also need to know that. So I would, yeah.
Let's hope we don't completely fail. No, so I think you started to touch upon this already a little bit, but obviously we just had a session on impact investment and the scaling up or kind of the green market. So where is the private sector with its own efforts in kind of reaching net zero? You touched upon the fact that, you know, transition plans are being made, pledges are being made. But what does this mean in practice, and how is GFANS in particular kind of supporting those efforts and that transition?
So, you know, in some ways, we've come a long way in that we're still less than 2 years old as an organization. And so we've got, you know, I guess in the first year we had a period of kind of building out membership, encouraging financial institutions to make these commitments. And, you know, just to stress, like across the alliances, there are all types of financial institutions. So there are banks, insurers, asset owners, asset managers, but also lots of important kind of infrastructure providers, data firms, rating agencies, or, you know, sort of anything you can think of that matters in the financial system is represented in some way. And, you know, firms from 50 countries, so this is clearly something that has kind of global resonance. And, you know, it is quite early days. These firms have made this commitment. Then they, under the commitments, so the nature of the criteria that they individually signed up to were determined through the UN non-state actor process. And so those require them to kind of set targets after a certain period of time, to have those targets assessed by the alliances that are responsible for kind of monitoring progress. And then they have to kind of deliver on those, start delivering on the targets through transition planning. So what, GFANS exists to kind of help coordinate across the sectoral alliances and help build frameworks and tools that the private sector needs. And I guess critical things for us last year, which I'll flag, were, I think, working through our members, we spent a year thinking about what is transition finance. Because I think, over the last decade or so, we've spent a lot of time on green finance, which is kind of fine, and in the end, everything needs to be green. But right now, probably less than 10% of assets are very green. And so what we need to do is transition the rest of the system in an orderly way. And so we've been thinking about, the types of financing that financial institutions need to engage with across a broader spectrum. So not just, the climate solutions, which is kind of our reference for green, but also to think harder about which companies are already on a transition pathway, i.e. they're aligned with net zero, even if they're not green today, but they're on a pathway. Which companies are converging on a pathway, so they're kind of going in the right direction, but there's progress to make. But we're also encouraging them to think about how to deal with what will in the end be stranded assets. So, and I guess a particular focus for us has been coal, because particularly in emerging markets, there's very high coal dependency in Asia Pacific, etc. We need an orderly way to manage those assets out of the system. So we're trying to work with firms on what kind of a financing approach for managed phase out looks like that has the right guide rails, but that allows emerging markets to access the financing that they need to perform a transition. And then the other major thing we delivered last year is a globally consistent framework for transition planning, which is intended for use by financial institutions, but we also use the opportunity to set out what those firms would like to see from the corporates that they finance. And this is just to kind of speed up the process of transition planning, I guess make sure that it's as consistent, comprehensive, and credible as it can be. And for us this year it should be a year of transition planning, so we're strongly encouraging financial institutions to start the process of transition planning if they haven't done it already, and through time to disclose the results of that.
Yeah, next, and obviously we had the transition task force planning, which is being developed at the moment, and just as a heads up, SPI will be hopefully doing things with them in the future, so do keep an eye out for that. It's something that we're definitely exploring and looking to support as well. And so again, I think you probably already touched upon this a little bit, but just to go a little bit deeper into kind of what private finance needs from government and from policymakers to kind of enable the transition, and looking at the real economy as well, what the real economy needs to do this, and the kind of wider financial sector.
Yeah, great. So we had quite a bit of discussion about this last year, because in some ways the private sector have made quite ambitious commitments, but we're pretty clear that global private finance can't get the world to net zero on its own. So we tried to be a bit crisper about what it is that we need from governments. And so it's clear that the financial sector takes its steer from government level commitments to net zero. I mean, that's why so many firms have made their own net zero commitments, because this has been a feature of the global climate architecture. And every time governments are clearer and crisper themselves about how they're going to deliver on those commitments, and they follow through with policy, it has a really kind of catalytic effect on the private sector. And so there's huge demand for governments to be clear on how they're going to deliver on net zero, to make the policy that's seen as necessary to unblock progress in the private sector. And that's particularly so against the backdrop of an energy crisis, where inevitably, we all had to take short-term measures to manage those stresses. But it just increases the need to then have clarity about how we're all going to get back on track. in the run up to 2030 and 2050. We also looked at, as already mentioned, the fact that we need global frameworks for transition finance. We don't have those currently, just to be frank. We need firms to understand which kinds of transition finance are recognized as needed, and for them to feel comfortable providing that kind of finance. And the most extreme example is dealing with kind of the managed phase-out challenge, where, of course, most global firms, and indeed, the public sector financing bodies, are pulling back from things like financing coal and so on, new coal, etc., quite understandably. But the challenge is that if we overdo it, then countries that are trying to transition away from those kind of energy systems just won't have the financing they need to do it. So, we desperately need those kind of frameworks to bring greater clarity and confidence to get the finance moving. We also, it's quite, in some ways, it's going to be quite a slow process if we rely on financial institutions to speak to all the corporates that they finance, ask them for transition plans, rely on them delivering them voluntarily and to a high standard. And that's the way in which we try to get to speed things up to get to net zero. So, there's quite a lot of pent-up demand in the financial sector for more transition planning by corporates. And so that's why, one reason why the UK efforts to implement transition planning domestically are seen as quite positive amongst the financial sector here, because, it just speeds things up, and gives you the information as an investor or a financer that you need to consider transition. And I know we're going to come on and talk about it, but there's a huge swathe of things we also need to do to unblock cross-border capital flows for transition.
Yeah. You mentioned the energy crisis, and today we talked a little bit about carbon pricing. We're talking about impact investment, moving capital flows. Obviously, a huge part of that is putting more money into renewable energy and kind of shifting the current energy flows that we're seeing. So how should financial institutions approach financing the energy transition, and what specific challenges are faced, and how can the financial sector overcome these challenges?
Yeah, so we commissioned some work last year from BNEF, or Bloomberg New Energy Finance, to look at, taking the kind of the most credible scenarios that everyone in the system relies on, to look at what sorts of investment flows do we need to see, and that indicates that for every dollar or pound of investment into current energy systems, we need to get up to 4 in the energy systems of the future. And there's a couple of things about that. So firstly, it's not 0 in current energy systems, because we do need to transition, and we need to do it in an orderly way. Otherwise, there's a risk we lose support and we lose further time on the transition. But we clearly need to ramp up financing into renewables, etc. I guess from the work we've been doing, it has come to a point in the last couple of years that renewables are pretty price competitive in lots of parts of the world. So there's a nice map, I think an IEA one, that shows like for much of the world, renewables are now cheaper than the alternatives. But that doesn't mean it's straightforward to transition. And so I would say that whatever country is trying to perform the transition, you go through a sort of similar pathway, which is that many of your current policy setup, etc., is designed around the energy systems you've had for decades, and so it takes a bit of time to adjust that and incentivize the new energy supplies that you need. And you need public policy for that. The UK had some success with the contracts for difference, which really helped us ramp up renewables. But you need to plan for your energy mix, based on country-specific factors. You need to have the right grid infrastructure. You need to have the right storage, etc. Because renewables that have different profiles to some of the existing energy supplies. So there's lots of work to do. The economics of it are pretty encouraging, but it takes policy and policy signals, and then I think generally find that the finance goes where it needs to go. But
right. I'd like to maybe open it up to the floor. I don't know if we have any questions for from the audience. Yep, just at the back there.
Hi, I'm Adair Bentheim from Bearings. I know it was cited in a question earlier from one of the other attendees, but wondering how the increased politicization of ESG, I suppose climate change has always been a pretty politicized discussion, but how do recent moves in the US affect the work that you're doing and impact all of the different members of those different alliances that you lead? Thank you.
Yes, I think, I think it's, if you look at countries that have made real progress on transition, it tends to be helpful to have like a degree of political consensus. And so, it is challenging if there's a lot of disagreement on what needs to happen. I mean, that said, I think we've reached a point where, the science of this is so clear, and, I was looking at the stats for the IPCC effort that was put out this week, and, the number of scientists they rely on, the number of kind of citations they have, et cetera. We've got this process running now where we have this exhaustive, regular report that tells us what the science is, what needs to happen in terms of energy and investment, all of those things. So I don't think, in general, people are in doubt about what needs to happen. And so, of course, it's difficult if there's political pressures. But I think, on the whole, the financial sector is kind of minded to be on the right side of transition. So, that's both about kind of seizing the opportunities that transition presents and also mitigating the downside risks. And so I don't want to pretend that, all of the net zero commitments made are, in some way altruistic or whatever. I think, most of them are grounded in cold hard facts, to be honest, and assessments of the, of the opportunities and the risks.
Thank you. And we have another question over here, Dora.
Thank you, Emma. Thank you, Alice, for your very insightful thoughts. I know that it's probably outside your current framework or current mandate, but I would like your views based on your experience on adaptation financing. I mean, we talk a lot about the transition and everything, and that's part of what you do at the Alliance. But based on your experience now, how do you envisage and how do you see adaptation financing moving on in the next decades? Because we know that we're going to have to focus on that as well at some point. The impact is inevitable. Whatever we do, there's going to be certain effects that we would have to be adapting for.
Yeah.
Thank you.
So it is, the kind of, as you noted, the kind of mandate for GFANS is quite grounded in net zero transition. But we are thinking quite hard about, and I think this is particularly relevant in the adaptation case. We know that the countries on the front line of climate change are often those that can least afford to deal with it. So we're thinking really hard in general about how to get capital to where it needs to go. And it is quite a difficult challenge on a number of fronts. So, notwithstanding climate of any kind, whether it's mitigation, adaptation, or whatever, capital flows to emerging markets and developing economies took a big whack with COVID and reached quite low levels in the last couple of years. And so kind of jump-starting those so that we get finance to flow for all of the climate needs that there are is really important. I think we take our lead from the kinds of analysis done by, for example, Stern, Songway, et cetera, who have identified total climate financing needs of like 2.4 trillion a year for EMDCs, with kind of some of that being financeable locally, but at least $1 trillion of it needing to come from external sources, and that's, I guess, where we can partly play a role. And so we are working really hard to think about what is it that blocks capital flows, how can we unlock those through the lens of climate, and working at kind of all steps in the process in terms of, being clear on the policy objectives, being clear on the policy frameworks needed to attract the finance, working, how to jumpstart project development, how to kind of find new financing approaches that de-risk investments where that's appropriate and needed to get the finance to flow in. And my sense is that if we could unblock those capital flows, I'm not sure that there's always such a big distinction for some of the investments as we sometimes have on the policy side between transition and adaptation financing. Some of these investments might cover off both in a way. So I think if we could unblock the barriers and just get more capital flowing by improving each part of the kind of chain of investment, it will well serve both mitigation and adaptation purposes.
We have another question over here, but I had another question myself. I think you just partially answered it, to be honest. But and it's something we're exploring in a lot more detail tomorrow in terms of transition finance, capital market flows, especially in emerging economies. But my next question was how can we ensure transition flows are global? So looking at kind of emerging markets and developing economies, ensuring that they're well positioned to attract transition finance and external investment as well, to deliver their own commitments and to ensure that they're in the best position to raise that capital and to develop their own kind of sustainable markets too.
Yeah, so it's really important. I think, when we looked last year to see what the scale of capital flows had been in recent years and this was, with a particular focus on kind of energy transition, we were a bit shocked about how thin, if you strip out, strip out China and India, like the flows are very small. And so I guess our sense is that this is going to require new ways of working and new frameworks and new instruments as we go forward. So new ways of working, we've quite strongly advocated for more collaborative work across public and private finance. We know that the scale of public finance is just not going to be enough to fill this financing gap. The kind of financing needs are many multiples. So we need to unblock private finance. At the same time, there are good reasons why private finance doesn't always make it to where it needs to go. And so in some ways, supply and demand for this finance are not really meeting.
Why is that, out of interest?
Well, I think if you're a global firm thinking about where to invest, there are a bunch of factors that could deter you from a financing transition in an EMDC. It might be that you just don't have sufficient local presence. It might be that you don't understand well the policy environment. There might just it's kind of a well-trodden path that there are actually, the effort we need to go to internationally to ramp up the number of projects is quite significant, so it can be quite hard. There are funds out there that have been raised to invest precisely in EMTC transition, and they, and then they face the challenge that I can't find projects to put the money into. But it's also, there are other factors like scale of the project, so, really big global firms don't, always go after the smaller projects. So there's we need to think about how we pool projects and standardize projects and so on. There are lots of kind of other wider risks, macro risks and so on that can be a deterrent. And fundamentally, if you're a financial institution, you have a bunch of factors you have to think about when you're making an investment. And so when you take these together, it can be enough to kind of deter that flow of finance. But at the same time, we have an optimism around the fact that so many firms have made a net zero commitment and need transition assets globally, basically, to invest in. And so we feel that there's a way through this where public and private collaborate, particularly in country-specific initiatives where a government is showing leadership by setting a more ambitious transition pathway, is mobilizing its domestic resources to turn that into kind of planning and energy resource planning and projects and so on and so forth. that we really need to find new ways of bringing together public and private finance that, you know, de-risk for some of the risks that the private sector is just not going to bear, but at the same time don't crowd the private sector out by just financing the whole project with public money. And it does require new ways of working. It's not, you know, I don't think historically it's how we've done financing, this type of financing, but there are an encouraging number of sort of such funds or such financing structures emerging. And I guess one of our, you know, alongside transition planning, our second area of focus for this year is ramping up this kind of financing cross-border. The other thing I'd just say is, and you mentioned it before, is, you know, of course, a lot of financing needs to be local. So there are questions around how can, you know, as mentioned, if we had better global frameworks for transition finance, that benefits everybody. And so if you're an emerging market trying to attract capital, it's really helpful if it's recognized globally that, you know, your transition finance needs are not all kind of green assets. Some of them are about phasing out other assets. And yeah.
No, definitely. Marcus, you had a question.
Yeah, thanks. So I think you're making some excellent points about emerging markets, developing economies, that there might be a credit squeeze there. How about advanced economies? Do you think, I mean, so just coming from Denmark, pension funds are obsessed with green projects. I mean, it would be very difficult to convince me that a profitable green company in Denmark would not be able to get funding somehow.
Yeah.
But that's an advanced economy.
Yeah. No, I think, I mean, as I mentioned, I think like the economics of some of the things we need in the new world, particularly the renewable system, are quite compelling. And so we have, you know, I think it was a few weeks ago that the IEA really revised up their estimates of the share that renewables would account for in financing and over the next couple of years, because it's just become kind of, in some countries, a no-brainer to put your kind of energy financing into that type of activity. And I do think that we're seeing signs of progress. So I mentioned that we're looking for a kind of 1-to-4 ratio, and some research we commissioned recently that came out a few weeks ago shows that you know, it's about parity in advanced economies, but it was lower than that before, and the targets that big global firms have are much higher still. So you know, I don't want to overstate the progress, but it feels like there's a sort of an upward trajectory, and I do think that policy making in advanced economies is sort of accelerating a bit on that front. At least we've seen a kind of wave of incentives created for kind of investments in new technologies and so on and so forth that are needed for climate solutions. So I think you're right that I think it's possible though that in advanced economies, you know, you just need to keep the momentum up, because you can have a run of success and then you hit some kind of constraint, and then it needs policy to address that constraint, and then
Do we have any other audience questions? Yeah. Thank you.
Thank you, Angela Vieiro from AG Strategy. It looks like the last couple of years there has been a ping-pong. It looks like a ping-pong between you guys and the government, right? And obviously, and you are right, is the work of the government to take leadership and to bring sectorial policy for each of the different industries that the financial system works. But lacking that, and lacking a GPANS, we don't have a global public sector alliance, but we have a GFANS. And you have, across the institutions, just take the top 20, 30, for the 10 sectors of high GSG, huge expertise about those industries. Actually, they have the direct access to the top corporates and the top clients that they need, that industry sector. Why not to, or to what extent has been considered having an started for 10? And started for 10 towards the public sector, so you force the conversation. Put proposals of policies, you know, obviously with different options, with pros and cons, So that we do the consultation the other way around. Normally, public sector proposal and consultation, well, when it start with the consultation. But because it's in your own interest, in the interest of everyone, as well in the industries, and then even helps as well the public sector, because let's not consider that they have a lot of limitations themselves, knowledge even, right, on all these particularities, because the nitty-gritty is what matters. So has been that, possibility that is in the mind?
So I do credit the UN with recognizing that, as well as having the kind of governmental process of net zero commitment setting and policy, etc., that it was important to energize the private sector. And I think that, that was a really important move, because I think there are times quite genuinely where the public sector is moving and making bold policy choices and so on and so forth. And then that incentivizes the private sector to act. But I also think that, it works. There are times when it's working the other way around. And so having energized the private sector, there are times where the private sector is acting, making it easier for governments to act, because it's kind of already starting to move its financing to where it needs to go. And so it's a mutually reinforcing and disciplining mechanism. And I think that that was hugely important, and personally I feel a lot more optimistic about making at least a good chunk of the progress we need to by 2030, having all of these parties involved. I think for our part we try to surface the areas of policy that would most unlock progress in the private financial sector as frequently as we can. So we had a call to action ahead of COP26, which set out, we were quite a young organization at that time, so it was kind of our initial take on that. And then since then, we've refreshed it, and we put something out last year before COP that sort of dug down, based on our more recent experience ourselves of trying to move on net zero transition, what more specifically we need. But you're completely right that we have to keep going there, and as our understanding of what's needed gets more sophisticated, we should feed that back to government. And I think we've all realized that if you're trying to get different sectors to move, whether it's energy or cement or steel or aviation, when you drill down into what's obstructing progress, it's some kind of complicated, well, it's not that complicated actually, it's some kind of combination of policy, technology and financing. And so you kind of need these cross-sectoral, public-private sector efforts to just pull out what these barriers are and problem solve for them. And we have to do it more collaboratively and quicker than we would normally do with policy making, I think.
How can we encourage better collaboration between the two sides? Difficult question.
It's a good question. I mean, rightly or wrongly, I think we've been stressing that from our experience in the private financial sector of starting the process of transition planning, we realize what a valuable tool it is. And so I think, going forwards, a lot of our focus is on trying to do more of that transition planning, including by sectors, and pulling in relevant parties. And there are really good examples of where that's worked. So, some of the progress that's been made in India, for example, on electrifying transportation, has involved pulling, government, state-level government, city-level government, bus providers, bus operators, the public, the financial sector, etc. And we're here, we want to get to here. What are we going to do? And sort of intensive collaborative policy making, I think, is needed to bring about the change at the pace needed.
We are definitely out of time. So any final takeaways or remarks, and then I'll pass on to Clive to close.
No, I mean just to bring it back to the broader question of central banks and regulators and so on and so forth, and talking about the kind of collaborative efforts. It's sometimes suggested that there's lots of pressure on central banks to act well beyond their mandates, and and that would be quite a sort of negative thing. I just wanted to highlight that I don't think that's the space we're in. We think that we need more from government, government policy. Almost every government department has a role to play, as mentioned. We need more from the corporate sector, we need more from the financial sector. And I think it's just that, you know, all parties have to lean into this problem a bit and think about what tools do they have available, what role can they play in this. And I think it's, you know, it's clear that for central banks and regulators, that the change we're talking about here across the economy is pretty significant. And so you really need to lean into understanding that and thinking about how it's going to affect how you deliver on your policy mandates. But I think it's also important to think about your role in both facilitating that process and also not inadvertently slowing it down. And so, you know, so I think it's important to be thinking about what kind of shifts of activity we're going to see. How does that impact me as a policy maker? Do I need to do anything about that, or I don't? And so I don't think it's about asking people to do something that is outside of mandate at all. I think it's just the scale of this change is so significant that we all need to kind of apply our brains to how it's going to play out.
Yeah, I think that's a lovely place and way to finish. Thank you ever so much, everyone, for listening. I'm just going to pass on to my colleague Clive, who will be closing the day. And thank you so much, Alice. Really appreciate you joining us today.
Alice, turned out I'm the final block between everybody in the bar. But as my colleagues will tell you, I can be a good enabler on that front as well. I'll keep this short and sweet. Alice, I thought that was a wonderful way to finish a brilliant day. That was such an eloquent explanation of the challenges that we face, particularly on the role of public and private sector working together, which is actually the raison d'etre of ONFIF. That's why we're here, to encourage exactly that. A couple of hundred yards up the road today from this wonderful venue in Westminster, there's been a former UK Prime Minister trying to sustain his political career by arguing that the parties he attended weren't actually parties at all. I think we've had a rather better level of conversation here today. And actually, all of the conversation, I think, is marked by the level of candour and thoughtfulness of every participant that we've had. It really is so encouraging to see. No grandstanding, no defensiveness, everybody wanting to work together to achieve better outcomes. We've had a wonderful mix of central banks, policymakers, thought leaders, investors, banks, other financial institutions, on a whole range of topics that I won't recap now for the sake of time, but hang on, bear in mind there's more to come because we've got another day tomorrow. Let me just quickly give you the highlights on that. We'll start, if you're feeling like getting up bright and early, with a breakfast briefing on digital technology. We'll have a session on the geopolitics of climate and international cooperation. We'll have something on sustainable capital markets in the emerging markets coming up today, on GSS bond markets, on ESG data, and also finally in a cautionary but I think important session with a whistleblower on greenwashing and how to move sustainable finance forward. If I think about what we've discussed today, I got in my head, and I don't want to paraphrase Elvis Presley, but I'm going to. I think we should keep the conversations going, but we need a little more action, please. And if that's something that we can achieve as a group and people listening in today can help to do, then we will all feel much better and feel like we're moving forward. There's so much to do. The clock is ticking, as we all know. But for now, for today, ONFIF is leaving the building, but we'll be back tomorrow, and we hope you all will be too. Thank you very much indeed.